Good morning, everybody. Welcome back to another episode of the Market Open. It is Friday, August 2nd, 8:46 a.m. Thank you, everybody, for being here. The markets are red. They are red once again. They were red yesterday after hours, after we had Amazon earnings. We talked about Amazon earnings. We'll go deeper today in terms of why Amazon was not really able to save their stock yesterday, even though I thought they had a great earnings. And this morning, we got the number that we did not want to see, a number that was higher than most projections for what the number could be. And that was the unemployment number. And that is why you're waking up to a very red portfolio. We'll see what happens as the market opens. I think we're going to get some more pain, but maybe we find a bit of a base as the market kind of digests this news. But unemployment in the United States of America is now 4.3%, up from 3.4 a year ago and up from 4.1 a month ago. We added 114,000 jobs in July, below expectations of 176,000. These were the non-farm payrolls. There's no way to sugarcoat this. This is the data that I think implies what could be the start of things going sour. Now, look, I think there's a lot of nuance to this, and we'll get into all that nuance today. There's a lot of arguments around what a Fed rate cut does, what it means, why the Fed technically wanted this to happen. I mean, it's quite frankly going according to the plan for the Fed, and they don't really care that stocks are down because of this. But at the end of the day, Hershey's yesterday said the consumer's weakening. Wayfair yesterday said the consumer's weakening. McDonald's, Starbucks, Nike, all these companies have been saying the consumer's weakening. We finally got some real hard evidence with the unemployment rate going up 0.2% in 1 month because unemployment is going higher. That means people have less jobs. They have less money. If they have less money to spend, then boom, you have a consumer that is weak. And that's why the market's down. That's why the market is down. Now, granted, let me say, I do think there may be some potential to buy the dip today. I think the market's already recovering slightly. I say slightly because the absolute worst part of the dip is it did seem to so far kind of stop in the pre-markets. What do I mean by that? Well, Robinhood 1920 was in the pre-markets. Now it's 1950. That doesn't make it that much better, those 30 cents, but it does go to show, all right, at least the bleeding has stopped a little bit. So when the market opens, I think we'll have more pain, but intraday, because of how bad it was yesterday, it's going to be very curious to see, does big money come in and kind of take a step and decide they want to buy the dip, or do things just continue to get bad, which is also very possible. So maybe today has an opportunity to buy the dip. Maybe buying the dip today means you're buying a dip that's going to keep dipping. We're going to have to find out as the market opens in the next few hours. Let's see how bad it is. Amazon, we'll talk more about them. They're down 9% in the pre-market. I have a reason why they're down, but in general, given the jobs number that just came out, obviously the market is taking them down even a little bit more. What else do we have? We have IWM that's down 3.39%. Shout out to Tom Lee. This trade is not going that well. I don't know if it recovers, but 209 on IWM. Apple 216, that's down 1%. Snapchat $10.30, that's down 19%. That was from their bad earnings. Intel is down 24%. Intel just broke its major level of support at 23 in the pre-markets. Now it's at 22. Again, every stock got pushed lower in the pre-markets because of that jobs data. So that's why we got Intel going down. S&P 535 down 1.4%. S&P still up almost 14% year to date. So, you could argue, hey, that's not normal for the S&P to be up that much in any year, even in the first 8 months. So that one may have some more room to fall. The NASDAQ 450, that's down 2%. NVIDIA is at 103. NVIDIA below 100, I think, is going to be very hard to get. Let's see what the appetite is for the market. It was already at 101 in the pre-market. Now it's at almost 104. So it's, again, recovering a little bit in the pre-markets, which is why there may be a reason to buy the dip today. Derek Wall says, good morning. I love crashing market meltdowns. They always say the time to buy is when you are scared shitless. Well, that is one thing that I think is going to be tested today as well. The time to buy and the time to get the best deal is when everyone is scared and no one wants NVIDIA at 100. No one wants Robinhood at 19. No one wants the S&P at 535 when it was just at 565. It's just going to be a question to see how many people actually step in and take advantage of that. Palantir is down 5%, 24.79. On the bright side, if you have covered calls, your covered calls are probably going to be saved, or you can probably buy them back today at a much cheaper price, given Palantir is much below $27, $28. Again, I'm curious to see the rebound. A lot of this is not really a Palantir reason for falling. A lot of this is algorithms and a broad-based market sell-off. So if we have a reversal of that, things might go up. If not, they might continue to have some pain. Gold is up 1%. A lot of geopolitical tensions that are going on right now, so that's why gold is up as well. Tesla down 2.49 to 11. Maybe we see 180 on Tesla. Microsoft's at 409. Shopify's down 6%. Hershey's is down another 1%. Etsy's down 2.3 after being down 7% yesterday. Coinbase, ironically, the Bitcoin play is because Bitcoin is green for some reason. I don't know why money's going to Bitcoin amidst all this craziness, but money's going to Bitcoin. I wouldn't be surprised if Bitcoin melts down with the rest of the market because Bitcoin performs honestly with the Nasdaq. But look at this green candle. Bitcoin's at almost at 65. Bitcoin's kind of the safe spot, I guess, right now. TFC regional banks are down. Really, there's no safe spots in the market. I mean, let's check Verizon, typical value name. Verizon's safe. All right, so your value names are kind of giving you a little bit of safety. Let's try Berkshire Hathaway. BRKB. Oh, even Berkshire is down. That's probably because Apple is down. Apple is down about 1% in the pre-markets. Meta is down 1.6%, 489. What else do we have? We have Amazon. We have Microsoft. Well, we looked at all the Max 7. Let's look at the semis names. Let's look at the semis. Semis are all down except AMD. AMD got beat up so hard yesterday that AMD is actually in. Marvell is down 3%. Taiwan Semi's down 6%. NVIDIA is down 5%. Intel down 23%. ASML down 6%. Micron down 4%. Dell down 5%. ARM down another 4%. That's probably normal. ARM should be down. And then Qualcomm down 3%. It's red, folks. It's red. PayPal looked pretty safe yesterday. Yeah. Well, where's PayPal today? Also, SoFi back below 7. SoFi at 682. PayPal 64.15 down 2%. What are you guys thinking? What are your raw thoughts? I want to like I know today is one of those days where you want to lean into the fear and fear monger and all that stuff, but I don't know, man. This is kind of what the Fed wanted. It's part of their plan. For those that are just joining, the Fed wanted to see the U.S. economy add way less jobs than expected. They wanted the unemployment rate to go up. I think this all but guarantees inflation's coming down dramatically, and then as a result, we're getting the rate cut. The question's going to be, is that rate cut going to be enough? Is that rate cut going to be enough? I want to cry. Oh my gosh. I don't think crying is the most effective thing here. We're all big boys and big girls here investing money into the markets. This is what happens when you invest in the markets. It's been a good year. I know a lot of your portfolios are still probably up a lot, even with the drawdown today. And that's because, you've been in the markets for a while. And definitely if you've been in the markets since January, things have gone well. But my question is, how bad do things get? Do we go to 4,800 on the S&P? Does it really get that bad? Is it like, first of all, I think that would be one of the best buying opportunities in the world. Maybe no one has the cash to buy it. But, how bad does it get? 10-year right here at 3.84. Or is this typical August, September pain and we bounce as we get through the election and we have a melt up towards the end of the year? Maybe the melt up is not to 6,000 on the S&P, but maybe the melt up is back to 5,700 on the S&P, back to where we were at the top of July. I don't know. We're going to have to see. 10 years are falling. And obviously that's happening because of this unemployment rate that we got right now. The Fed is now starting to price in, or the market's starting to price in a rate cut. The market's also starting to price in a little bit of a recession, theoretically, given where the VIX is right now and given where the 10-year is trading at. VIX volatility index right now is at 21. So it's up 14% today itself. It's up 14% in the pre-market. Over the past 5 days, it's up 20%. Obviously showing that things are pretty volatile. Big boys can cry. Real men and women cry. Oh my God, dude. Just joined. Did we correct 10%? Yeah. So a 10% correction on the S&P from the top is 509. For the QQQ, it's 4. I did the numbers last night. It's like 434. I think it's 434. So we're looking for a little bit more pain actually on the S&P on the Qs for a real 10% peak to trough correction. But so far we don't see that yet. The shake is here. we're not poor enough where we can we can still afford the shake for now. So the shake is indeed here. Is this because of Harris and no cut? It's definitely because of no cut. Markets are pricing in a Harris victory. That is correct. You can believe that or not. The markets are pricing that in. Some of parts of the Trump campaign, including his pick of JD Vance, is not going that well. So that is another thing that's hurting markets, because obviously if Harris wins, not the best for Bitcoin, maybe not the best for taxes, regulations, etc. And that's another kind of overhang on the market. We'll get more clarity around that in September. But as of now, yes, that they are pricing in a little bit more of a Harris victory. The market has gone down ever since you wanted to switch to protein shakes. I mean, hey, dude, it is. I got to get healthy. So if I got to get healthy and crash the markets, let's just say I'm giving you guys a good dip. That's that's it. All right, let's get some update on these job numbers and keep going from there.
First one, I'll let Steve start a little bit. It's impossible always to figure out what the stock market's going to do, although we see the initial reaction. But the unmistakable reaction in the bond market, which really started yesterday or the day, well, actually before then, but really picked up speed recently as we got under 4. So there's no doubt on how bonds are taking this news, Steve.
Yeah, I'm very interested, Joe. The first thing I looked at here was how the Fed funds market reacted. We went into this, just to set the table, a few days ago, there was no chance of a 50 basis point rate cut in September. We went into this with a 30%, and I don't know if this is right or real or whatever. And as Rick points out, this market can...
So this thing that Derek just put in the chat, Japan stock market plunges 6%. We're going to talk about that after this, but this happened last night. The biggest drop since 2016. Kind of insane, the Nikkei index. So we'll talk about that right after this.
Can be very wrong. It can also be very right. A 72% chance right now of a 50 basis point cut in September. That's where the market is priced.
Now, 50 earlier today.
I caution,
because that can only,
Joe, this is one.
Steve, we went from 5 or 6 to 1 or 2. It's like, how do you get back to 5 or 6 when you only got, when it's already, getting toward, time is nigh? Well, you can get to 5 or 6 by doing 50 at one of them.
You could do it pretty quickly. And now I'm looking at the January 25 contract, Joe, at 413. So do you want to do the math on that? Is that 120 basis points of easing 125? That is 5 right there, right?
That's 5. That they can get right back to it.
Let me just very quickly. I want to get to I know you want to get to the panel very quickly. I think the story I'm seeing here, and I've just glanced at it briefly, and I think the story in the economy right now is not that there's a lot of firing or job loss going on. There's not a lot of hiring. This is a weak report when it comes to hiring, as you get down to what used to be a pretty normal level. 114 we'd be pretty happy with. A lot of the strength looks to be in the place where we had it, which is private education and health. And I want to just see here what the government number is. That's plus 17, so that's come off a little bit.
Damn it. Did I really? Okay. So this is the first time in like 7 months we did the muted. First time in 7 months. I had a fire analogy too, dude. I just had a great analogy. This is the first time in literally 7 months we had the muted, dude. You got to give me some credit. It's been a long time since we did muted. Remember last time it was like 2 minutes and 50 seconds. And I was using my hands. I was spitting fire and no one could hear it. Okay. What I was saying was, this protein shake might have some fucking crack in it, bro. I don't know what it's doing right now. But do you think this is the start of a recession, or do you think this is simply a normal correction? Because, and my analogy was, there is a difference, as what he said on CNBC, between not hiring as much, which is what this jobs report is, versus firing. So if you have a pizza shop and you're firing employees, it's because no one's eating pizza. You have less demand, therefore recession, right? You have to literally fire employees. If you're a pizza shop and you're just not hiring more waitresses, it's because business is okay. It's not amazing. You have enough demand coming in and you don't literally need that many more people, which means economy's not great, but economy's not horrible. Whereas if you're firing, economy's horrible. Let me make a poll of that in the chat. So based on that, do you think this jobs report, which is a little bit less on the firing side, more on the lack of hiring side, does that mean, hey, normal correction or recession? Or at least what is your sort of indication of what you think it means? Normal pullback or recession? Again, I think we're going to get a lot more data in the coming weeks to kind of let us know which one is happening. I kind of still lean into the normal pullback side. I don't think this is start of recession yet. I think this is more normal pullback. This is kind of what happens. We haven't had a 10% pullback the entire year. August, September is always volatile. Things tend to change. Markets tend to get excited as stocks get really cheap. And if that happens, earnings have been good so far for big tech. Now, if earnings suffer in Q3, then yeah, all hell could break loose. But if they don't, because we get the rate cut, maybe that's what kind of saves it from there. It's just panic selling. I definitely think there's an extent of panic selling. A lot of this also, remember, is algorithms. Like these stocks don't just fall 5% out of nowhere, right? A lot of these algorithms that manually control it from hedge funds, they adjust whether it's on the buy side or the sell side. So I do think that a lot of that is designed to get retail to, give up shares and panic sell and take profits or take losses prematurely. But that doesn't mean things can't get worse in the short term for a lot of these stocks. I'm going to be very curious. In about 20 minutes, we're going to see how the market opens and if shit hits the fan and things really get bad, or immediately buyers step in and they say, this is stupid to see Tesla at 210 when it was just at 270, or this is stupid to see a Novix. It was at 18. Now it's at 11, TFC was at 45. Now it's at 42. One of the biggest regional banks. Meta was at 530. Now it's at 485. We're going to really see how the market comes in. Robinhood, 1925. Maybe Robinhood falls below 19. I think that's a buy the dip. We'll see if the market steps in as well. Snapchat's still down 19% as well in the pre-market. 2452 is Palantir support. I don't know what Palantir support is, dude. For the longest, Palantir was establishing a base at 2627 for about a month, and then the algorithms took over. Palantir at 2470 is not a Palantir problem. It is a jobs report problem, macro problem. Also, I kind of like Palantir at 24 before earnings on Monday versus at 29. So we'll see how kind of that shapes up. But I don't know what the support is for Palantir. At this point, I don't know what the support is for a lot of these stocks. I mean, you would think the support on SoFi is $7. Nope, $6.77, right? You would think of Robinhood, it's at least $20. Nope, it's at $19.25. So I don't know. As the market opens, we're really going to see kind of how bad some of this pain becomes. Someone says, Amit, definitely we are in the beginning of a recession. The consumer sentiment has been telling for some time. AI bubble is bursting and consumers softening, looking at McDonald's and Starbucks. That's a valid bear case. We talked about this yesterday. I don't blame anyone who has a bear case that the AI bubble is bursting and consumer softening. I personally disagree with it right now, and maybe that'll change over the coming weeks when we get more data. But I think that's I can't blame a bear for saying, hey, this is my bear case, is why I'm out of the market right now. It's a fair argument for what we're seeing right now. The U.S. 10-year is currently still dropping 3.85. We haven't had 3.85 since February, but when we had it in February, it was for good reasons. This one is a little bit more of a weak reason. What does the poll say? 65% say normal pullback. Okay. 65% say normal pullback. Amit, can you please call Powell and fix this? Unfortunately, I don't have his number. I would love to call him. Dude, here's the thing about Powell, man. Everyone's blaming him for not cutting rates. I get it. I want to hop on that train and blame him as well, because when your portfolio is red, you need someone to blame besides yourself, right? So Powell's the easy target. I just don't know if he could have definitively cut rates in July unless he himself stepped up in that meeting, that private meeting with the 12 presidents, and said, guys, things are getting bad. We need to cut. He probably said that, but he said that in a way that was very nonchalant. He needed to step up in that meeting and be like, it is time to cut. And I don't think he had the political capital to do that with the other Fed presidents. Now, granted, that's what determines if you're a good Fed president or not. I did say on Monday, if Jay Powell lands the soft landing, greatest Fed president of all time. If he's late on the rate cuts, which as of now looks like he's late, but we'll see. Maybe he pulls it off. I don't want to definitively say that yet. Then he's the worst president of all time, because he was late on inflation being transitory, which I'll give you that because COVID, stimulus, all this. Like I'll excuse that. But then if you're late on the safety of that with the rate cuts, because of the same reason, because you're looking at stupid antiquated elements of calculating data like shelter as a 6-month lag. Like what type of? We are one of the most economically developed countries in the world, and we are using surveys where people from the Fed call people in their home where they don't want to be annoyed, and they're like, "Hey, do you want to buy a home?" And that's how they use the data to determine if shelter inflation is coming. Like, what type of nonsense is that? Like, how does the Fed, like, it is the most ridiculous way we calculate data. There's obviously a lag in it. And if that's the reason why we were late on rate cuts, it's just, you can never trust the Fed ever. You can never trust the Fed ever if this causes, a massive, horrible recession, the worst since COVID or since, 2022, at least in the stock market. So I guess we'll see. Oh, Kathy Wood. Yeah, thank you for this, BSoft. So Kathy Wood sold some Palantir and Robinhood yesterday. She sold 282,000 shares of Robinhood, 325,000 shares of Palantir. The weird part is she bought 150,000 shares of Moderna. I don't understand that. I really don't, but she bought Moderna after selling Palantir and Robinhood. BSoft says, I'm going to guess Kathy knew this. That's why she sold so much Hood and Palantir. There was no other valid reason why she did that. Yeah, I guess she predicted that the jobs report would be bad. And she sold off some of the growth stocks, which is, a fair calculation by her. But then buying Moderna, I don't know, is Moderna the flight to safety in a recession? mRNA, it's down another 3% in the pre-markets. Again, Moderna was down yesterday because they cut their outlook for COVID vaccines. But like, I don't know what's so exciting to buy, even if they cut their outlook on that. So the point is, she did sell some growth stocks, got into Moderna. But we might see a lot of institutional selling on a lot of different growth stocks if they believe a recession potentially is around the corner. Zocolt says, not only are they using archaic surveys, but the sample size is too small. I agree. The sample size is also very, very small. And like they're trying to extrapolate entire elements of data or entire narratives around where the economy is based on that, which just doesn't seem like it makes a lot of sense. Let's get another update on jobs. Actually, no, let me pull this. Oh, the Japan stuff. So let's talk about that. So the Nikkei index, it fell 6% last night. I looked at the futures and I was just like, this is not good. So let's talk about this. The Nikkei 225 ended 5.8% lower, the index biggest daily drop since March 2020. It extended a global stock rout that began following the release of weak U.S. economic data. The Japanese benchmark had already lost 2.5% on Thursday. It has now closed at its lowest level since January. So again, this is not a stock. This is an entire index in Japan going down basically 8% in the course of a week, which is not good. Now, why did this happen? Well, on Wednesday, the Bank of Japan raised interest rates by 15 basis points to 0.25% in its second rate hike this year, and announced plans to taper its bond buying by half. So they're going to buy 20 billion bonds a month versus 40 billion bonds a month from the United States. Traders expect more rate hikes to come later this year as the central bank tries to contain inflation. There is inflation in Japan, slight inflation, which is why the Japanese bank raised rates. But the U.S. unemployment numbers being bad as they are this morning and as they were yesterday with initial jobless claims, that also led to the collapse. The hike has narrowed the difference in interest rates between the United States and Japan, which has pushed the Japanese yen higher against the greenback, which is why they raised the rates to push the yen higher. The dollar has fallen by more than 4% against the Japanese currency since the middle of last month. So you've got all this stuff happening in Japan. You've got the United States with our own unemployment issues. And then you've got Iran swearing they're going to retaliate against Israel for assassinating one of the, they didn't exactly shoot him. They had a bomb. I was reading about it last night inside of the, I don't know how they got the bomb inside of Iran. He was hiding in some hideout and then boom, like he blew up for killing one of the leaders of Hamas, right? So Iran's like, we're going to get Israel for that. Then you've got all this stuff going on in Venezuela. I don't know if you guys are seeing some of that stuff. With Nicolas Maduro, who basically said he won in an election where he really didn't win. And so now people are revolting against Maduro because they want a free democracy. Like, there is so much shit going on across the world. And it's just a lot right now. It's just a lot. And as a result, we're seeing some volatility baked in. Matt says, well, I woke up this morning, so that's good. That's correct. At least At least we all woke up. At least we all have our health, right? That's what we can say in the morning. At least for now, we all have our health. So that's okay. Oh man. Oh man. He wants to fight Elon. Yeah, Elon wants to fight him too. Like it's kind of ridiculous, dude. It is kind of ridiculous, but a lot of shit is happening across the world. And then on top of that, obviously yesterday, the initial jobs claims are bad. And then the big number that a lot of people forgot is ISM. ISM was also horrible. ISM came in at 43. That was the lowest since 2020, and that was bad. We'll talk about Amazon in a second, but that ISM number just shows that the manufacturing is slowing down dramatically. It's the worst number since June of 2020. And because it's the worst number since June of 2020, there you go. That is why, things are taking a nasty beating right there. ISM manufacturing came in at 43, which means we are contracting worse since June of 2020. So the big theme that we had yesterday at the end of the market close was that bad news is bad news, not bad news is good news, which bad news again was good news. We had this weird toxic relationship with bad news it was like, it was stupid, dude. It's like, oh, unemployment's rising. Great. Inflation's coming down. Market goes up. It was the weirdest thing ever. Now it's like, no. Unemployment's rising. People don't have money. Shit's hitting the fan. Bad news is bad news. So this morning's job data was terrible as well. Correct. So bad news now is actually bad news. And as a result of that bad news being bad news, we are going to see more pain in the broader markets if we keep getting bad news. Okay, let's talk about Amazon. So we covered Amazon last night. Amazon right now is at 166 down 0.93%. I think at 150, Amazon gets to no, it's already at the 200-day moving average at 167. So it's actually already below that. So, I mean, if you're waiting for the 200-day for Amazon to buy the dip, you're there. Now, if they take the sucker down to like 155-ish, I personally think that's a great opportunity. But obviously, if we're getting into a recession, all bets are off the table, right? Do we go back to 100? Do we go back to 120? We'll see what happens. But overall, they had a fantastic earnings. Cloud, 19% year-over-year growth. Advertising missed by 200 million, so slight miss. And that was what the street was upset with. Along with the revenue missed by 600 million. I know 600 million sounds like a lot, but it's relatively inconsequential in the context of Amazon when you're dealing with the numbers that they're dealing with, 148 billion versus 148.6 billion. The reason I think Amazon is down is because of their operating margins. And I did a Twitter Spaces last night with a bunch of people, a lot of Amazon bulls, and they kind of agreed that, look, those operating margins going down to 9.9% from 10.7%, that's something the street doesn't like. Now, they beat expectations of 9.2%. Operating margins is how much money they make on like the actual business itself, not just AWS, but like all the $53 billion of Chinese crap they sell on the website. How much do they make off that? It was 3.7% 5 quarters ago, and you could see it started going up to 5.7, 7.8, 7.8, 10.7. It peaked last quarter, which is why I think the stock had a little bit of a run after the earnings, and then it went down again. Not the biggest deal in the world. I think it's a slight blip. Long term, this is not a big deal at all. But I think short term, if you're curious why Amazon is down, that and the advertising miss is probably why we're seeing some volatility, along with the fact that maybe we're starting to price in a recession. Now, one thing someone said on the Twitter Spaces last night that I thought was really interesting is that if Amazon can start selling more high margin products, aka medicine, pharmaceuticals, we know they have PillPack, which they're trying to do this whole pharmaceutical ship to your door, low cost service. That could increase their operating margins by a lot, because obviously medicine has way better margins than selling cheap water bottles from China. And that could get those operating margins closer to 11%, which I think the street would love. And they would definitely get this bad boy over 200 along with cloud and its growth. So maybe that's one way that Amazon can increase its operating margins. Now, Andy Jassy on the call was exceptional. I think his explanation of AWS, his explanation of the IT server build out, his explanation of how they're going to be monetizing AI, along with his explanation of how hard it is to create the correct AI cloud in a way that makes the unit economics profitable for Amazon, but also scalable for the end users that need the AI part of AWS's cloud. It was a really good vision that he laid out, and he was black and white. He wasn't sugarcoating anything. It was very clear. I thought the stock would recover a little bit when he was talking, just like when Satya was talking, because, one of the best calls I've heard all year, but the stock didn't care too much. And so I guess the market at this point is just not willing to give Amazon the premium yet. And we'll see what happens later in the future. But that's what we have right now. What you're saying makes sense, but if the expectations were below that, then IDK, if that's why it's down 10%, I don't think that's the only reason that's down 10%. Yeah, I don't think operating margins are the only reason it's down 10%. I think, the reason I think it's down, quite frankly, is the guidance raise was small, if not there on the guidance raise. Like, it either missed expectations or was very small. I think it like slightly missed, but also advertising was another reason people thought it was down. They wanted to do 13 billion. They did 12.8. Now, is it down 10% on advertising? Like missed by 200 million, or top line revenue by 600 million? Maybe. But I think under the hood, there's deeper issues around operating margins that get Amazon to be, or that gets the street to be a little upset. One thing I know for sure, if those operating margins were higher than 10.7, I think the stock would not be down, because I think they would have clearly shown cost efficiencies and their ability to make money in a way that's, what the street wanted to see for years. But as of now, down 9%, you could say for a variety of reasons. Biggest reason, I think, is because the jobs data this morning that obviously came in worse than expected. Palantir right here at 5%. Apple had a good earnings as well. Apple's down slightly. The only problem with Apple is they missed in China. That's it. They missed in China. And so because Apple missed in China, I think that's, but even Apple really wasn't down yesterday. I mean, Apple was up yesterday. I think the only reason they're down right now is because of this jobs data. 85 billion a year. iPhone did well. Mac slightly missed. iPad did well. Watch did well. Vision Pro, not really a real thing. They didn't talk about it anymore. And they said on the call, hey, the iPhone 16, we're getting ready for the AI rollout. The one problem on the call was that someone asked Tim Cook, hey, what is the real use case you think that is necessary for consumers to upgrade for AI? He didn't really have an answer for it. He just said, we're going to give the best consumer experience for AI. And one bear argument to think about when it comes to Apple is, if the consumer's struggling, who the hell is upgrading their iPhone? Right? I mean, like, this is where we figure out how real AI is, right? So for all the people saying AI is fake, I'm going to give you this argument right here. This is your bear case, and it might play out over the next 5 months. If the consumer is weak, which we're seeing with a ton of data, I mean, if the consumer is weak and the iPhone says, hey, you could talk to Siri and she can, tell you how awesome you are, and that's not a good enough reason to upgrade to the iPhone, which for now is the only reason I see is, a unique reason to upgrade to new technology via their AI phone, then people aren't going to upgrade. And if people aren't going to upgrade, you got to really ask yourself, is AI starting to be real in the context of the consumer? Now, I think it's definitely real in the context of the enterprise. I think it's definitely real in the context of humanoid robotics and FSD. By the way, Brett, CEO of Figure, he tweeted last night that he's going to have some big news today for Figure. So hopefully he puts it out during the market open. We'll see what he puts out. But in general, if it's not real for the consumer yet, people aren't going to upgrade to the iPhone. There's just no way. Who's going to upgrade to the iPhone if people aren't going to, if there's not a real use case for the AI phone, even if the vendors subsidize it, AT&T and Verizon, like, you still got to dish out 500. Like, AT&T subsidized mine, and I had to pay 400 to get this one, the iPhone 15. So, I mean, 400, it was way better than 1,200, but like, still, you're asking people to put up hundreds of dollars for a new phone to, like, talk to Siri, right? Like, what is the real use case? And Apple has not been the great at communicating that. They've not been the great at communicating that. So I guess we're going to have to see. Chat says, how are they a serious contender in the AI space? Yeah, I think that's also something that we're going to have to figure out over the next couple of years with Amazon as well. The one thing they did say that AI is helping them is advertising. So they said AI is fueling our advertising recommendations and our sponsored clicks and all this stuff. And like, AI is making that better, which is amazing. But the problem is they missed on advertising. Now, again, analyst expectations versus what they report, it's always like annoying, but you didn't miss on advertising, even though you're saying advertising, AI is a tailwind for advertising. And so I think that, again, compounded to why the street was upset, even though I feel the sell-off on Amazon was absolutely overdone because the quarter, particularly cloud, was exceptional. So we'll see if the street buys the dip as we get into it. We also had a bunch of other earnings. So let's talk about Coinbase. Coinbase is up a little bit. Coinbase really moves with Bitcoin. Coinbase up on revenues 100% year over year. Again, Coinbase earnings are relatively inconsequential because we need Bitcoin to go up for Coinbase to have any significance. So doesn't matter too much, but Coinbase overall had some good numbers. Snapchat had horrible numbers again. They lost more money. Revenue growth sucks. DAU growth is not that good. They're down 20%. This is like clockwork for Snapchat every single time. Mercado Libre had a great earnings. If you're long Mercado Libre, that's the Amazon of Latin America. They beat on the top and the bottom line, showed good guidance. So Mercado Libre was good. And then we had Intel. So let's talk about Intel. So I don't know how many of you guys saw the tweet I put out yesterday. We got 10 minutes till the market opens. But there was a horrible story that went viral on Wall Street Bets, and I posted about it last night. A junior in college got $800,000 from his grandmother for his inheritance. He put $100,000 in a high yield savings account. He put $700,000 into Intel at $30. So he bought 22,987 shares. He is now down about $165,000 as the market opens today because Intel fell 24%. So this was tough. This was tough to see. I mean, it's just one of those lessons of like, hey, don't go all in if you have a lot of money. It also is one of those lessons of, hey, when you have someone else's money, you definitely don't feel as much of a fiduciary because it's not your money. If you work to make 800,000, I could guarantee you're not going to dump it in Intel out of all stocks, just because you're like, oh, let's see what happens. It's like, no, dude, you got the 800,000 from your grandmother. His grandmother died 2 months ago. He said, I'm only a junior in college as a math major, and I don't really have any use for the money, nor do I have any debt. I'm very fortunate that my parents are paying for my education. Like, I want to feel bad, but it also feels like some rich kid who parents are paying for college, got a ton of money from his grandmother. He's a math major. This just goes to show you, if you're a quant, that doesn't mean you're good at analyzing the markets, and you just dumped it into Intel. I've always heard about people losing their inheritance by spending it on garbage instead of investing. So I told my parents, I'm not going to spend a cent of this money and I'm going to invest all of it. And they were proud of me. It's just, dude, it could have picked anything but fucking Intel, dude. So the good thing is, I mean, he said he's long for 10 years. So theoretically, he's not supposed to look at this for the next 10 years, right? So in 10 years, is Intel back at 30? I think so. I think their foundry business by 2027 starts putting up numbers and Intel comes back. I don't think it's dead forever. But it does suck. You wake up the next morning and although you're not supposed to look at it for another 10 years, you look at it and you're down, right? So yeah, but this is the stuff we're seeing right now at this part of the market where people are getting a bit exuberant. They're putting lots of money into certain assets. And even those assets that you would think Intel's safe at. I mean, even I thought Intel at 30, maybe it goes to 27. Intel's like not supposed to collapse. They collapse. And the reason they collapsed, and I couldn't have expected this, but Intel suspended their dividend in Q4. Starting Q4, they suspended their dividend. And as a result of that, yeah, like a lot of people were only buying Intel for the 1.72% dividend yield. Wow, Intel's at 2190. Intel broke a big level at 23. 23 was a decade low. Intel's now going further than a decade. You're going to have to go to around 2009, 2008 to see these levels on Intel. So getting rid of that dividend yield obviously was very bad. So this was the worst earnings we saw yesterday from the broader market. We also had Twilio. They did well. They're up 5%. Roku did well. They're up a little bit right now. Again, Roku and Twilio were beat up. DraftKings did great. Profitable, $1 billion of share buybacks, and revenue came in line with expectations, but they are down because they're a growth stock, and a growth stock's going to get hit in a recession if we're into recession. So DraftKings is down 4%. The Bitcoin stocks are relatively safe. MicroStrategy looks like they're going to raise another $2 billion to buy crypto. They said in their earnings report, we are agreeing to get a capital raise of $2 billion, yada, yada. So it looks like they're getting ready to buy even more Bitcoin. Square had a decent report, but they're down 1.83%. They were up 3% yesterday. DoorDash had a great report. They're up 6%. They were up 14%. A lot of people apparently are ordering from DoorDash. I don't know if that's just people that can afford to pay the crazy DoorDash fees, or if more people in general just don't want to go out to restaurants, which maybe could tell you something about the consumer, right? If people aren't going to restaurants, but they're going to DoorDash, even if, DoorDash is obviously maybe a little less expensive than going to a restaurant. But DoorDash did well, so they're up 5.92%. And then Cloudflare also beat on the top and bottom line. That's good for Palantir, good for broader SaaS companies. They're up 3% right now. But the big stories yesterday were obviously Apple and Amazon, and then Intel that fell pretty badly. Saving gas. Yeah, people save gas if they don't have to go to restaurants. SoFi at $6.85, correct. SoFi below $7. I do Uber and DoorDash. More people definitely use DoorDash. Yeah, I mean, it showed in their numbers. I mean, the amount of orders they got, I think they had the gross orders. It was like 30% higher or something than last year. I mean, DoorDash is definitely scaling. And that either tells you people don't want to go to restaurants anymore, or it tells you a certain subclass of the population that can afford all the fees and stuff and they don't care, they're buying DoorDash. Because with DoorDash, you have Uber Eats, DoorDash, you have a bunch of these different services. So it's a competitive business. The margins are tough, right? You'll just go to one or the other based on the better fee you get. It seems like people are picking DoorDash over over Uber Eats, at least right now. But it begs the question, what does that mean for the consumer? And I think now every earnings report we get, given we got this jobs report, we're going to try to see, are people doing DoorDash because they don't want to go to the restaurant, right? Are people doing this because they don't want to do this? Like now the narrative is, how can we try to infer something about the consumer from every single report that comes out as well? Half of those orders are from me. Shout out to Josh. Intel's a company that is losing market share. It is like GM Motors, but of semiconductors. Other semiconductor companies ate Intel's lunch and had dinner too. Oh, look, I don't disagree with you. I don't disagree. I just think Intel, remember, Intel was at 50. It already fell when it got to 30, which is why a lot of people were trying to park in there for safety. But obviously growth continues to slow down for it. I mean, they grew less. They didn't even grow 1%. They declined 1% year over year last quarter. And that was a tough thing for Intel. Now, again, at the end of the day, America's going to have to make its own chips. We can't rely on Taiwan forever. So I don't think you have to be bearish Taiwan to be bullish Intel, but you do have to believe that if chips are important, then Intel's foundry business eventually should be profitable. It's just they told us a year ago it's not going to be profitable. They told us in January it's not going to be profitable until 2027. So if you buy Intel, you have to have that understanding. Like you have to go along with the understanding of it's going to take 4 years. But if you don't, then in the short term, you're obviously going to see some potential pain as well. Palantir is down almost 6%. That is correct. So we will see. Amit, are you picking up any Palantir shares on this dip going into earnings? No, I haven't bought Palantir in a while. I need to see Q2 data, guys. At this point, I need to see what they're going to put up in Q2. Palantir's at an incredible run. I am overweight Palantir, so I have no FOMO to get more Palantir. Now, if we drop to 20, I'm going to load up a lot more. I've said that because I think 20 to 21 is a great price. That's what I did in May. That worked out really well. And I'll do it again if we get there. But I want to see the Q2 numbers. Oh, by the way, I have a new clip on Palantir from Dan Ives. I'll play that after the bell. I was listening to a podcast line with Dan Ives, and I didn't even know they would talk about Palantir, but they mentioned Palantir. Dan Ives put out a report yesterday through Wedbush who said Palantir is going to show momentous AIP growth. Like they basically implied, hey, we're going to see like customer conversion, monetization, all this stuff. I don't know if Wedbush is being super bullish or they know something that we don't know, but if they're right, then maybe the market rewards it. If they're right, maybe the market doesn't even reward it given the market, given the macro that we're in right now. But we got to see that. We have to see that. And if we don't see that, I think Palantir is going to, take a bit of a hit given the macro change. Same thing with Robinhood. I think Robinhood's going to crush earnings, dude. I think Robinhood's absolutely going to smash. But if Robinhood smashes and the stock is $18 and it goes to 20, it's like, it's like, thanks for getting back to $20, but it's not really a smash, right? So really it depends on the macro. Like next week, if things don't get better and Robinhood and Palantir report, both of them could still get nasty hits after they report simply because the macro is in a tough situation. Now, if the macro rebounds, the V shape on both of those, I think could be extraordinary, but that's going to be the big question. Are you willing to hold these things going into the end of the year? If the V shape happens or it doesn't. Palantir 2465, Robinhood at 1929, Snapchat at 1015. Snapchat, every single earnings it falls. Like if you're a Snapchat shareholder, an institutional shareholder, you've got to be like annoyed at this thing. It's rinse and repeat. You buy it at 8, you sell it at 13, you do it again every single quarter. That one down 20%. We'll see if that catches a bid. And then Apple slightly up in the pre-market. All eyes on Amazon as the market opens. Really curious to see what the hell happens to Amazon and if they can get some momentum right here, down 9.4%. Markets may recover from this point, given all the uncertainty of the week is over now. Yeah, potentially. I mean, we got all the data we needed. We took the big crash. I would say this is, a pretty red dip. And we have some geopolitical stuff, but if that doesn't come to fruition over the next couple of days, maybe markets recover from that. But now it's time to see. I think we can all agree the Fed's cutting in September. Now it's a question of, are they cutting by 25 or 50? Are they cutting by 75 basis points? Because, if the economy actually is slowing down, you need to cut. And you need to cut fast before things get really, really bad. All right, here we go. It is Friday, August 2nd. Thank you, everybody, for being here. 9:30 a.m. The stock market is now open. All right, wake your ass up. The markets are open. Amazon down 9%, pretty flat. No bids moving up or down on Amazon. Kind of just kind of just sticking there. Now it's down 10%. All right, now we're getting some selling. Palantir 24.72. Robinhood looks like it's going to go below 19.06 on Robinhood. Palantir 24.68 on the day. Snapchat is at 10.11 right now. Snapchat is at 10.11. Coinbase is at 2.13. Amazon 166. Apple at 2.19. Meta at 4.90. SoFi 6.92. Little bit of recovery there on SoFi. Got a green candle from 685 to 695. Palantir 24.75. Also a little bit of a green candle right there. Verizon is up 1.4%, so value catching a bid right now. S&P is down 1.4 at 535. QQQ at 450, down 2% on the day. Open Door down 12%. Open Door took a beating yesterday after earnings. NVIDIA 103. NVIDIA not falling below 100 yet. It's getting a bid right there at 103. We'll see if that continues. ARM down 7%. AMD is at 133. AMD is green. AMD was down 10% yesterday, so it makes sense that that's green. CleanSpark 14.89. CrowdStrike at 2.19. SMH Semi ETF, that was down 6% yesterday. It's down another 5% today. Carnival Cruise Lines 14.87. The cruises are not safe, unfortunately, from the recession. So those are getting hit. Square's getting hit. Tesla 2.13. That's getting hit, down 2%. Crocs are down 5%. Microsoft's down 1%. Amazon, Robinhood recovering right here, 19.27 from 19.05. Palantir 24.67 got a red candle. Intel down 26%. Intel is taking a shellacking. It's taking a shellacking right now. Amazon 165. Apple at 220. Wow, Apple goes green. Apple goes green. Looks like the sell side is coming out with some research to get people to continue buying Apple. On the Twitter Spaces I was on last night, we had a really good conversation about Apple, and there was a big Apple bear there, and he was just like, I have no idea how the sell side with this $285. By the way, Dan Ives raised his price target to $285. With all these crazy price targets on Apple, what they think people will upgrade to the iPhone for. You know, like, what is the reason? Like, why would people buy this new iPhone for all these AI-enabled features when, like, if I ask you to name one of those features, the only thing you can name is Siri, right? And it's a reasonable point. Now, I still think people will upgrade. I don't know if it's going to be the extent that Apple is planning, but I still think people will upgrade. But you're going to need 100 million people to upgrade for the Dan Ives of the world to be correct on this $280 price target theory that they have on Apple. Bitcoin at 65,000, S&P at 535, QQQ at 450, Palantir 24.54, Robinhood now falling again at 19.15, Snapchat 9.80, they're down 23%, Coinbase at 2.13. Amazon flat at 166. Amazon's not really moving too much. Amazon's kind of stuck. Defense contractors are green. Yeah, and it's weird. Palantir is not getting any of that. I guess Palantir is not really being considered as a defense contractor today. Lockheed Martin is green. Raytheon, I would imagine, is also green. Yeah, Raytheon's green as well. Yes, the defense contractors are catching a bid right here. Coinbase is down just a little bit. Again, Coinbase moving with Bitcoin. Bitcoin is doing okay today. CrowdStrike here at 218. Yeah, markets are red, but it's not. I mean, it's kind of the red we already saw in the pre-market. S&P is going down a little bit more. We're not seeing like 3, 4, 5% on really any stocks yet or indices. So I guess we have to wait a little bit more to see how bad it really gets. TJ will be on today as well. We're going to look at some of the blood in the public portfolio and see how to navigate that from an options perspective. So we'll talk about that. But yeah, a lot of these stocks are down. They're just not crazy down from the pre-markets. I've owned a Samsung S10 for 5 years and plan to upgrade to an iPhone for several reasons. AI integration is a big one. I like some of the use cases they address. Look, I agree. There's going to be a big upgrade cycle for AI on the iPhone. My question is, if the consumer actually does weaken by October, November, how much of those use cases are enough to like I upgraded my iPhone after 3 years because I felt it was time. It was 3 years. I was like, all right, it's time to get the new one. I know people have had their phones for a while, but outside of that, you're going to need a real reason to get people to think, hey, you can talk to your phone and it can type up your email more effective. Like, it's just, and Apple hasn't communicated that yet. Like WWDC was, like, in my opinion, horrible communication of what the benefit is of AI on your phone. They've got to make commercials that really speak to people about that. And so far over the past year, Apple has sucked at communication, aka the Vision Pro. They have not communicated any value proposition on that product either. So not bearish Apple, because I think at the end of the day, the only person that brings AI to the consumer is Apple. I would not short Apple, but they're going to need to figure out, if the consumer weakens, how the hell to get people to still believe they need these phones. Where's Palantir? Palantir, are we going below 24? 24, 25. Wow. 23 on Palantir would be something we haven't seen in almost 2 months. That would be quite the price level if we haven't seen that in a long time. So someone says, what do you mean by recession? I don't see people actually stop eating or purchasing that much less. Well, see, I agree. Qualitatively, there is an argument that like everyone's out. Like I was just at the Brooklyn Bridge the other day. Everyone was out there. They were eating their, $10 ice creams and like buying drinks and all this stuff. So yeah, I feel you. There's an argument that everyone's still out, but there's also an argument that maybe there's a bifurcated America and certain parts of America are not able to just go out and buy a $10 ice cream. So if I had 678, because shit is really hitting the fan. I know a lot of people in the chat are more of the people that invest their money, more financially literate, people that care about the markets. It's not saying you're the richest person in the world, but you do know about building your wealth and you at least care about building your wealth. But the majority of America is not like that, dude. The majority of America does not give a shit about even having an emergency fund, So if that's the case, that's the consumer that potentially is weakening pretty badly. Carvana is down 4%, Tesla to 213, Microsoft 412, S&P 534. Yeah, look, we're getting a green candle here. So that's what I'm saying. Like we're red, but it's not red more from the pre-market red. It's like flattish or greenish, catching a bid. Robinhood just went below 19. So Robinhood really red today, down 7%. Palantir 24.25, Intel 21. Intel looks like it might go below 21. Intel now down 27.5%. At least on the indices, we are seeing a little bit of green and potentially a bottoming out from that pre-market level. Wonder if Palantir could build an operating system for a phone that could bring AI to the consumer better than Apple. I just think Palantir is not focused on the consumer. I think they definitely could, but a consumer company is a different type of DNA. Like Palantir has always been enterprise. That's why when everyone thought Palantir could, build a consumer product, I never bought into that. I think AIP now, which is how like developers can download AIP right now and start like using it, that's a pseudo consumer product. But like a product that scales to billions of people, like an operating system for your health and your data, I think Apple is going to win that game very easily, And Palantir just, their culture is not building consumer products because, again, Karp doesn't like consumer products. He thinks a lot of Silicon Valley is, toxic in terms of how they monetize attention, all that stuff. So I think it's Apple's game to win. But the question is if Apple's actually going to provide a use case that's meaningful enough to win it. What Palantir needs to do is create a new architecture for calculating real-time data for the Federal Reserve. Palantir needs to get I don't know, call it a $200 million 5-year contract from the Fed to just fix the way they calculate data. I mean, what is Palantir? It's taking a lot of unstructured data and deriving insights from it at its core. You're telling me Palantir can't take the shelter data, the oil data, the consumer data, and then tell the Fed if we should cut or not? I feel like Palantir would be better than anything at figuring out those conclusions. And so maybe that's like the real use case in terms of the Federal Reserve, and that would help the entire country. That would help the entire world if you help the U.S. economy. But, okay, here we go. We got Chad from Palantir. We have that architecture already. So if anyone works for the Fed in the chat, can you please DM Chad? And can you please talk to your boss, Mr. J-Pow, and get him to realize that people calling people on the phone, S&P at 535, to figure out if rent is too high in the United States of America is an antiquated system to determine if we should raise rates or not. Like, it is so obvious Palantir could take millions of pieces of data that the Fed looks at, retail spending, consumer spending, ISM data, jobless claims, yada, 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 put them all together, ontologize them, and then be able to give you insights that maybe aren't perfect, but are way better than what Jay Powell and his little buddies are doing in their private meetings trying to figure out if they should raise rates or not. I think that's a huge use case for Palantir. And I wish Palantir, or I wish at least the Fed would consider that in the context of Palantir. Another name, thank you for the super chat. Yeah, your analysis of Palantir is correct. Very custom. They provide a custom instance created to meet your needs, from my understanding. Yeah, 100%. That's why they get compared to like consulting firms, because they're very custom. But at the end of the day, they're selling a software product that is, they help you. So that's the consulting part, but they're not really charging for the help. They're charging more so for the software itself. Here's Dan Ives on Palantir last night. So I found this. No one's probably seen this because you would have to watch this podcast. This podcast is where they talked about it with Scott Galloway. And they go deeper into Palantir.
Don't like them, but that's when it's transitioned from government to enterprise. Second would be Palantir. Palantir, it's the same theme. Like Palantir, very controversial. Some don't like them, but that's one that's transitioned from government to enterprise. And that's probably one of the best pure play AI names out there in terms of use cases from a software perspective.
Could you explain? I think Palantir is a very interesting company. I think it's unclear to a lot of people what Palantir actually does. Could you explain what the business is and how it's benefiting?
I mean, if you go back historically, Black Box, they work with a lot of three-letter agencies, in the US and as well as abroad. On the government side, massive, what's called big data technology. Think about it's like an enterprise algorithm, Black Box. It's an artificial, and what I view is probably one of the best AI platforms out there. Me and Scott work at a company. We want to use AI in our company. How we don't know what the use cases are. We go to Palantir, they look at our data, go into our systems, they come out and they say, these are your use cases. This is how you could use data. This is how you could actually profit from it.
And we got Palantir earnings coming up next week. I would assume that if Palantir is the key beneficiary, then we'd better hope that we're seeing some strength on their income statement. It seems like that might be a bellwether for the AI industry as a whole.
You want to see in Microsoft, you want to see in Amazon Cloud, you want to see it, of course, in NVIDIA in terms of what demand, Palantir and use cases. If you're triangulating,
Right.
Those are the ones where now they could guide conservative and the stock could sell up or stock can move up. But in terms of just like taking the noise out of the system for anyone watching, follow where CapEx, demand, spending. You could argue where the valuation is, but that's really what the focus should be.
So there you go. Dan Ives talking about Palantir. And again, this is, love or hate Dan Ives. That podcast, Scott Galloway's podcast, I'm sure a lot of people that listen to it, the Prof G show, they probably don't know what the hell Palantir is. So this is why you need people like Dan Ives, going across all these media platforms and talking about Palantir. And I thought he did a great job explaining it. Now we're going to see in Q2 kind of how this all plays out in the context of Palantir. We'll have TJ on in just a minute, guys, and we'll go through the public portfolio and see how we're going to navigate some of the options that are underwater. Robinhood right here at 1888, down 6.7%. Palantir 2451, down 6%. S&P is recovering a little bit. It was at 533. Now it's at 536. So finding potentially a little bit of a bottom. PayPal 6248. SoFi 686. SoFi is also up from 665. IWM. All right, let me get a reading from the chat. What is your current assessment of Tom Lee? What do you think is going on in Tom Lee's head? What do you think's happening? I'm very curious about this because I really don't want to see Tom Lee's reputation go to shit or for him to become, a pseudo Cathie Wood in terms of how he's perceived. And I think he's at such good calls. I don't know if he gets the IWM call wrong. Let's assume two worlds. One world is where the IWM call is wrong. He's dead wrong. IWM goes back to 180. He's dead wrong. Do you think that hurts Tom Lee's overall brand? I think it smidges it a little bit, but overall, I think, look, you're not going to be perfect, right? I get things wrong. Bill Ackman gets things wrong. Everyone gets things wrong. I don't think you can necessarily be bearish Tom Lee for that. I think the bears that hate him because he's been right for 2 years, they're going to use it as a way to hit back at him. But I don't think that means Tom Lee, the brand of Tom Lee is down. The other world is where Tom Lee is right and IWM actually does outperform because we're not heading it into a recession and we see the real rotation. It's one of those two things that happens, either one or the other. And I'm hoping it's the other, dude. I'm hoping it's the one where IWM rebounds, but I don't think he necessarily gets into a lot of pain if he's just wrong on this. What a crew. Tom Lee amid Bill Ackman. Was that narcissistic? Did I just put myself in the same sentence with Tom Lee and Bill Ackman? Well, Tom Lee was in my dream. I did talk to him in my dream. So he's liked a bunch of my tweets. So Tom Lee's mostly right. So if he's not always, but that's okay. Yeah, that's how I feel, dude. I mean, like, at the end of the day, he was right for a long time on this market. If he got the IWM call wrong, it is what it is, right? Like, small caps was a bit of a risky call to make. I still think there's a chance it outperforms. We just got to see what happens over the next month. Maybe this is just August volatility and September, October, this thing goes back up. But I don't think we can necessarily get mad at him for getting one call wrong, given how much he's gotten right. So let's see. I guess let's see. Tom Lee's usually right because he's usually bullish. That is also true. But remember, he's bullish in a world in which people are usually bearish, right? So that's the thing I think we have to give him credit for. It's like, especially the last 2 years when people were dead bearish, he just turned out to be more bullish, you know? So I guess we'll see. I guess we will see. All right, folks, let's bring on TJ. We got a public portfolio that's going through a little pain, just like everyone's portfolio is going through some pain. We're going to navigate it. I think this is going to be a good episode because we're going to try to figure out from an option, a wheeler's perspective, hey, when things go in the money, how do you deal with it? What do you do? Psychologically, what do you do? How do you think about rolling it? How do you think about getting assigned on some of these options? And so we're going to navigate all of that right now with TJ the Wheel Deal. What's up, TJ?
Yeah,
You got the boxing gloves on. We got it.
you got to come out swinging, baby.
Oh boy. Oh boy. Oh boy. Oh boy.
What's that?
What's up, man? It's time
Hey,
to.
we're in the business of buying stocks. Y'all should be fucking excited. There's good deals out there finally. This shit's been overpriced for a while, admit. I haven't heard your stream. I don't know what your thoughts are. Don't care. Bro, shit is finally attractive from a pricing perspective, and we got money. We got capital. We got conviction. Now we just need to make sure that the money's in the right spots. So we're in a really, really good spot here because we're prepared for this. When you aren't prepared, look in the mirror. You're the only one to blame when you're not prepared, guys. Like bankroll management is a big, big thing doing this, you know, selling puts, selling calls, collecting premium. It's all rosy. It's all hunky-dory until shit goes south. So now how are you going to manage it?
Yeah. Real quick, let me just give a shout out to Christian. Christian, thank you for the super chat. Tom Lee isn't shook. He also calls Bitcoin at 150K. Yeah. And I think another narrative is this Bitcoin narrative if it actually gets, you know, closer to those $100,000 levels by the end of the year. But we'll see. Maybe this is some short-term volatility, and maybe he ends up being right on a lot of things at the end of the year. So, TJ, before we get into it, I mean, you already said how you're feeling, but I'm assuming you're feeling good because now stocks that you wanted to buy are at better prices, and you're more excited.
Well, the first thing that I look at whenever there's a dip that I mean, truthfully, I didn't think it was going to happen until after the election, just to be honest with you. Like, let's call a spade a spade. The reason that you set your portfolio up accordingly is because you're looking 60 to 90 days out doing what we do. And you expect that the market holds certain levels. If not, why wouldn't you just wait for this to happen? But I don't have a crystal ball. And based on everything, the way that it was looking, pricing in the rate cuts and everything of the sort, I thought that we were going to be golden until the uncertainty of the election creeped up around, late October, November. That's what I thought was going to happen.
Right.
I am not a good prognosticator, bro. Just look at my track record on buying not at the bottom. You know what I'm saying? Because that's a very hard game to try to win. So anyway, now we just got to adjust accordingly. We got to look at the positions and be like, okay, now that we're here, is this really a high conviction play? Does it have the potential so that we can turn it into an investment? Or was it just a trade?
Right.
Or was it just a trade? And you have to be honest with yourself. By the way, do y'all see that my face looks a little skinnier a bit? I've lost like 15 pounds. Bro, I went on the COVID weight loss program.
Is that the Ozempic program?
No, I got COVID. I got
COVID.
You got
COVID. When did
we got COVID while we were in Anguilla in the Caribbean. So our vacation got cut short.
Oh,
and boy, it's a real easy way to lose 15 pounds, just so you know.
Yeah, I'd imagine.
Yeah. So anyway, let's you ready to see the carnage, bro?
I'm ready to see the carnage. Listen, again, shout out to TJ. I'm putting his YouTube in the chat. He's one of the most transparent guys on YouTube. So I know a lot of people have carnage in their portfolio. Today, we're going to see one of them publicly and learn how a professional wheeler is navigating it.
So here we go. So let's start out with the Project X scoreboard, if you will, if you want to do a little deal. So we have done a really, really good job here collecting premiums, but we have total open collateral of 967,100. And I just did this before went live. So this is actually pretty accurate as of about 10 minutes ago. Down $88,000 on shares that we have bought with that money, but that is not Amit's fault. Let me be very, very clear, because there's something that happened in this portfolio with monies that was allocated to Amit's project, but I had to take the bull by the horn, because a certain stock presented an opportunity that I have been looking for about 2 or 3 years. So that stock is going to be taken out of this equation. Amit is literally finding out for the first time. Do you know what stock I might be talking about?
Is CrowdStrike?
No.
I have no idea then.
Let's back up the tape a little bit, Amit. You're a smart guy. Remember, we had that episode where I got really, really excited when you presented a ticker to me, and I go, "You finally brought me a stock that I've been eyeballing for a while."
Oh, I think it's Intel.
Yes.
Yeah. Well,
Yeah.
I think we can keep Intel part of our kind of project, because at the end of the day, I signed off on that too. I was like, yeah,
we're big in it now. Then you heard it here on the chat, guys. You heard it here on the chat.
Yeah, look, I signed off at Intel at 30, so screw it. Now we're at, someone said Grinder. Oh, I wish it was Grinder.
This crowd is just.
Well, so what? We have 2,500 shares of Intel.
Anyway, let's look at the portfolio. So first off, let's just start with this. Do it where we're just right here.
Okay.
So everything's been hunky-dory since we started this project, right? We just go on, we're essentially busting out our chest, flexing our arms, and being like, hey, this shit's easy, right? So put so calls, collect premium. We showed them how to make 6 figures in a short amount of time, right?
Yeah.
But now we got a wheel.
Right.
Now we got to test our conviction. We've got to test the investment thesis, and we got to be very, very good stewards with money. We got to manage capital now, right? We have to be better capital allocators, if you will, because when everything's down, there's no reason to have a trade in your portfolio if you can have an investment.
Correct.
And Amit, can you define to me, for you, what does that mean? What is a trade and what is an investment?
An investment to me is at least 5 years. You believe there's a long-term thesis. You're willing to DCA, which means for the first 4 years, you might be red, So if we're going to go long Intel, we might be red until 2027 until they change. But given the ability to lower our cost basis along with selling covered calls, it can still make money, but you're not trying to get in and out of it. Whereas something like a path was obviously a trade. When it was
Facts. So whenever there's only a certain amount of capital to go around, what I do is, let's just say like it's 6 or 7 stocks. This is like fishing, right? Like you have like 6 or 7 poles in the water and you finally caught the fish that you wanted, but then you have to go deal with these other damn poles because they caught fish too, but you don't even care what's on the line because it's not a keeper. Those are my trades. So this is a good opportunity to cut those loose if it's a very minuscule loss, if you will.
Right.
So that we can have the money, so that we can have the money freed up for the investment, if that makes sense. And to me, that just goes under the COGS, the cost of goods sold, the cost of doing business.
Right.
Because if I knew which ones were going to bottom and they were just going to be investments from the beginning, doesn't it stand to reason that I would just wait to do that?
Right. And no one knows, like everyone can point fingers. At the end of the day, no one freaking knows. You're taking a hypothetical guess. When shit goes south, you have to learn how to navigate that. That's whether you're in options, crypto, real estate, whatever it is. And it's just part of life. And it's part of the nature of being an investor. And it's also the responsibility you get for actually wanting to invest your capital versus putting it in the bank. Like if you're actually going to take a risk with your capital, well, in a bull market, you might have some times where that risk goes south and you have to deal with that. So I agree. And we're going to have to figure out how to navigate a bunch of these positions.
So let's start with some trades that we would potentially like to cut off, if it's even necessary to cut them off to free up the capital so we can focus on the investments. And we can kind of take the episode that way if that works for you.
Yep, 100%. Yep.
So let me go this way, make it bigger. That's what she said. Okay.
We can laugh on a red day. We can laugh.
Okay, I lost the chat. Okay, there it is. So essentially, we have path. Let's just go over here. So you want me to show you what I did with Intel?
Yeah. So we had 2,500. Oh, okay. I didn't know you bought this much Intel. All right. We had like 2,000 shares.
Yeah. So we're at 27.55 average, and it gets. But wait, There's more.
You did this yesterday, I'm assuming. You did this
Again,
yesterday.
keep in mind, this doesn't have to be part of your allocation if it doesn't meet the risk threshold for you. Because at the end of the day, I take ownership of all of this. You follow me?
Yeah.
Because I know that this isn't easy going to 35 or 40, but it's not probably till the end of 2026, 2027. But when I do the math on it and calculate the amount of money I can make selling covered calls and also cash secured puts, I like the risk reward at these levels for me.
Okay.
I listened to the entire conference call yesterday and it was not good.
Yeah.
It was not good, but I do think that they're going to right the ship. The issue is it's a really, really big boat. So it's like, like when they were trying to like turn the Titanic, they saw the iceberg. They had plenty of time, bro. The issue is the icebergs, the Titanic is really, really big and the rudders weren't big enough and they couldn't get away from the iceberg. So they crashed and they sunk to the bottom of the ocean, right? So Intel is that kind of boat. They see the iceberg. Hopefully they'll be able to steer it and navigate away from the iceberg before the shit gets even worse, if you will. If not, I think that CEO is going to lose its job.
So we had in our challenge
2,500 shares.
Okay, so we would have been down basically 20 grand today on those 2,500 if you multiply by the number of dollars Intel's down. You bought another 7,500.
Right, so I'm going to walk you through all of it. I can confess my sins, right? So whenever we were I was at the house at South Padre, we rolled that covered call and we got 1,500. Remember, went from 31 to 31 a month out?
Correct.
That's that trade. And then we sold puts this was after the stream. So I sold puts at 32 because Intel started running up and I wanted to go grab money that I thought we were leaving on the table on these 31 calls. This is exactly what was going on in this little head of mine. And then I sold 25 more contracts at 31. I was like essentially positioning myself to buy these shares back so that we could just let them get called away. You follow me? This is like I'm walking y'all through the story, but then it started tanking a little bit more. And I was like, well, I want to get 2,500 more shares at 29 because assuming that I'll probably have to take assignment of these right here. And I want to maintain that average at about $30. So this is how it all happened. And then I was like, okay, earnings is going to happen. I think that Intel probably bottomed out last quarter. This was the thought process. And I was like, let me just go ahead and scoop up 2,500 shares because I want to graduate this from remember I talked about I have this 25, 25, 50 strategy where I invest 25% of the capital at a certain price. And then if it gives me another price, I invest another 25% of the total allocation to this position. And then if it gives me stupid prices, I invest 50% of the capital that I would have liked to have put in if it would have been at these levels from the very beginning. So I'm just following that strategy in real time. So I bought 2,500 shares outright and then and I sold covered calls on those immediately. So essentially I got like a 28.30 average on those, if you will, adjusted cost basis. But then Intel tanked after the earnings came out and I think they were expecting 10 cents and they came in with 2 cents or something like that. It was not just a miss, dude. It was like a golf shot of mine. Like I couldn't even not just stay in the fairway. I couldn't find my ball. It was that kind of a miss.
Yeah.
And then I bought 2,500 shares on the way down at 26.24, and I bought 2,500 shares at 24.19. So this essentially put us at 50% of the total amount of capital that I would like to allocate, and that is including the cash secured puts over here at 32, 31, and 30. So what did I just say there, Amit? This is 50% of the capital that I would like to allocate to Intel. So essentially, if you add all of it up, if you add the 10,000 shares at 27.55, that's 275,000 and some change.
Yeah.
Then you have to add the 7,500 shares potentially at 32, 31, and 29. That's 50% of all of the money that I would have ever wanted to put into Intel. So we still have 50% more that I would like to allocate to this, but it would have to be at stupid prices. And that's where you come in. So, I'm pretty sure you covered Intel.
But
What
here's
would
my
be a stupid price?
but here's my question. I'm fine with those 2,500 shares. Why do we want to make Intel a 20,000 share position? That's my question, because I don't even know why.
Because I'm trying to swing trade it, and I would like to have an average of, and when I say swing trade, it's an investment horizon from the standpoint that this isn't a swing trade of like buy it on Monday and sell it on Friday. This is a long swing trade, and it's a very safe place for me to hide money because I don't think Intel is going to 10. I certainly don't think it's going to 0. Matty Capital, shout out, right? So I think that the bottom has to be pretty close if you just start studying the ratios and everything. I mean, it's not like the company's going out of business, bro. They're cutting costs by $10 billion. They're laying off, unfortunately, a shitload of people. So they're trying to do some very drastic things to get on the right side of Wall Street. So I'm essentially just playing it for a bounce. And then if we can get to like 27 to 30 bucks, then we can offload half of those shares that we bought over here in the $21 range. And then now our position would be back at maybe 7,500 to 10,000. And we would ride those up to, I feel like 40 bucks is the target exit price. Like I've already decided that on the front end.
I agree with the logic. I don't have the conviction on Intel the stock. Like we bought those 2,500 shares just to sell some covered calls, and it's like whatever. But making it 20,000 share, I would have to do more research to like really feel.
Well, the things that I've been following the story for about 4 years, and I was in Intel previously.
Yeah.
And I don't know, like I don't normally time this thing, but I sold them at like 46, 47.
Yeah.
And then it went up a little bit, and then it just came tumbling down and kind of doing what it's doing now. So I've done this successful campaign once on Intel, and it's just like a 50 Cent song. If you could do it once, you could do it twice, you know? Like I just feel like at some point the market is going to scoop it up, and it's something that I want to be in. Like, okay, let me just ask you these questions. Do you think Intel is going out of business?
No, but I don't know if the stock's going back to 30 anytime soon. That's the problem.
And again, that's why time horizon is such a big thing. So it becomes, okay, what would I be able to do with that capital? That's the opportunity cost, right? These are real big boy decisions that we have to navigate through.
Yeah.
And it's something that you and I can talk about more offline. So
yeah, I think we just have to do a little bit more research and think, is Intel one of those things? Because let's say we do research and we conclude it's not the thing that we want to be on the next 4 years.
At that point, we keep what we have. We sell very, very aggressive covered calls. We lower our adjusted cost basis to where it's a break even, and we cut it loose.
So that was going to be my plan on the 2,500 shares. I was like, all right, we'll sell 25 covered calls at like $23, $24 strikes. It's aggressive, but we can navigate that. I don't know if I want to make this to 20,000 shares. But again, maybe you know a lot more than me on Intel, and we have to talk about it.
Right. So I think that one thing that we can do, and we'll do it off.
I'd rather have 20,000 NVIDIA shares.
Yeah, but I'm saying it takes, but dude, truth be told, I don't like NVIDIA at these prices. Y'all gotta, I mean, people have real short memories in this fucking game, bro. Where was NVIDIA before the split?
It was basically at these prices, at $90.
Exactly.
95.
So what the fuck? Everybody act like NVIDIA's at a discount?
I mean, it's a discount from 140.
I'm just saying you can't be a prisoner of the moment. You know what I'm saying? Like NVIDIA is the darling and all that stuff. But I mean, my goodness, this thing went parabolic for a really long time. I mean, guys, y'all got to realize that this price movement is very healthy for the market. I'm not talking about Intel. Intel, there's fundamentally something wrong with the company. That's why we're going to get these prices for a while. So we don't have to be in a hurry to allocate the rest of the money here.
Yeah.
I don't think Intel is going to 25 bucks tomorrow. You know what I'm saying? It's certainly not going to 30. But NVIDIA, dude, I want NVIDIA to come down to like 80 bucks. We'll talk about that position in a second because I go through the Twitter feeds and stuff, and they're acting like NVIDIA is like a great deal. AMD is a great deal. All of these other companies are great deals. I already have a prospect in mind for today. So I'm feeling amazing because this Paxlovid is working. Paxlovid is the new drug that they give you for COVID.
Yeah. Yep.
But I was using a pun there. I'm feeling amazing. There's a stock out there that is very amazing at these prices. And it kind of sounds like the word amazing. In fact, when I refer to this stock, I refer to it as the amazing.
Oh, I see what you're saying. Are we talking about Amazon?
There is a stock out there that I have wanted in this portfolio ever since the day that I sold it. And I think that it is finally at very, very attractive prices if you look at the Mag 7 from a PE perspective and all of those things. And I'm talking about Amazon. So that's one that, how do you feel about Amazon? Do you think Amazon's going to zero?
I don't think Amazon's going to zero. I just think given the jobs data we got today, we're going to need some time to see where these prices settle.
Agreed. We don't have to make those decisions today.
I like Amazon.
Put it on the radar.
Yeah. I think Amazon, going long Amazon is a no-brainer in my opinion.
I want to just put it on the radar. So anyway, guys, what we'll do is I will calculate offline so that we'll have it for the next one. Is we'll calculate the well, actually, this is not that hard. If we go back over here, what is the adjusted cost basis on Intel? We've collected 11,630 in premiums, Amit.
Yep.
And we're out the 277,000. So call it 265-ish. So you divide. So our average adjusted cost basis is about 26.50 a share.
26.50. Yep.
What is it? What is Intel trading at now?
21-ish. $20.90, $20.79.
Yeah, so I think that it's good now. The adjusted cost base is going to trickle up to about 28 and some change if we take assignment on all of those other shares. We don't have to do that. We can always roll these if we want and kind of let everything play out. We can roll these cash secured puts, kick the can down the road 30 to 60 days, keep the same strike price, play it for a bounce. That way the position doesn't get as big. Those are options that we have those are options that we have. You always have options with options. But at the end of the day, we can't act like those trades aren't on the books because they are. You follow me? Yeah. And then the cool thing is that covered call printed money. The reason that it's important to know your adjusted cost basis, guys, is because I already know that on the next round of covered calls, I can pick a $25 or $26 strike price on these 50 cash secured puts, or now it's going to be 100. I'm sorry, covered calls. It'll be 100 covered calls on Intel.
Right.
So that's what's going on with Intel, dude. I don't think Intel needs to dominate the.
That's the thing. I don't think it needs to dominate because at the end of the day, it's about opportunity cost, right? And Intel's fine. It's just, I have to do a lot more research to think if it's even worth getting to that big of a position, but.
So let's keep it going. We obviously know that Path is a trade. So let's look at that little stinker over here because that was me farting around and buying like 2,000 shares. So luckily, we're not down that much on this position. They say it's so bad that there was an error loading the chart.
I would imagine all the brokerages are having some errors today.
Right? Everybody's panic selling all crazy, bro. I don't know what's wrong with people. Yeah. So anyway, Path is at 11.28, and we're in it for, I think it's 12.15, and then there's cash secured puts at 12.50, I believe. Let me see. Yeah. So there's cash secured. There's 20 cash secured puts at 12.50. So that expire. Today's the 2nd, right?
Today's the 2nd. Yes, August 2nd.
Okay. So these expired today. So this, again, this is a decision that needs to be made. You cool adding another 22,000 shares, or let's kick the can down the road to 830 and hopefully there's a bounce there. That way Path doesn't have to become a bigger position in the portfolio.
Yeah, I would kick the can.
Yeah, I'm totally with you on that one. So we'll
go. So when things are, theoretically, we should be getting a somewhat of a decent premium given how red the market is.
Yeah. So here's the question now. The question is, we can roll from 1250 to 1250 a month down the road, 28 days, and we can actually pick up a little bit of money, 620, or we can try to take some risk off the table and we can go from 1250 to 12. And then now that would actually cost us $220, but we free up a little bit of capital. I don't think it's necessary because it's such a small position to do that. So I always want to take on credits. I'd rather just do a sideways move, but we're still bringing a little bit of premiums through the door.
Yeah, I would say so as well.
and then we'll have to just try to get it to where it fills, and we just have to wait. Now we have to wait because there's a real big bid ask there.
Yeah.
And that's pretty standard whenever you're underwater and you wait a little bit too long. I considered doing these yesterday, but I just wasn't I wasn't up to like reaching out to you yesterday because I was still trying to kind of like recover, if you will. So here,
yeah, I think the big question is going to be right now, real quick, guys. On the Intel, we got 2077. AMD's up a little bit. IWM's down 3.75. Amazon's down 12%, and S&P is down 2.1. So the question is going to be: is this pain going to continue for the next coming weeks, and these puts are going to have to keep getting pushed, or do we get a bounce? Right? Do we get a moment where we can have a sigh of relief, and that'll navigate a lot of the position sizing as well?
so the one thing is we have to look at the bankroll, right? So the individual cash 2.5, margin total is 2.7, open options collateral is 3.8. So it just comes down to also like how many more cash secured puts would we be able to sell, or are we stuck because I sold too many already and now we're forced to kick the can down the road or take ownership? Like if you don't manage your bankroll accordingly, then your options become limited, right?
Yeah.
So I have to look at all of these. Like we have, this isn't a lot. This is only $80,000, but like Neo is going to expire, even though it's like right at the strike price. I collected 2,600 here. So I'm just waiting for more theta to run off the clock. So maybe around noon or 1 p.m., if it hovers at these levels, this is probably going to be a 3 cent or 2 cent, and I'll be able to close that. And I'll be able to free up that $80,000 that we can now put into our project. So that's something that I know is coming coming off the books, and that increases the buying power a little bit, not much, but it's something. And then I just have this this path put that we're trying to kick the can down the road on. These put credit spreads aren't causing much stress with ELF. So
can we go to a big? Can we go to a hood? That's a bigger position. Let's look at that one.
Man, we were doing so well, dude. Guys, we were up like 50% on this position at one time early on.
So the good thing is we rolled it down from 21 to 2050. So we bought
21. We rolled it from 2150 or 21 to 2150 to 20.
Hood is at 18. So that's
we opened up more puts at 20. Just have so many open positions right now. I'm trying to minimize these by half, by the way. And I think those don't expire. Yeah, here we go. To the 16th.
Yeah. So the good thing is here we have earnings. We'll see if there's an earnings bounce. If there is an earnings bounce, then we can get out of the position. If not, rolling this one again, our adjusted cost basis would be like 18 on these shares, roundabout, or 1950 or something. So I would like to take ownership of these. I wouldn't be upset about that, but I think we can roll this as well after earnings.
Yeah. So that is something that you're a lot more familiar with. This position's not, I know it's big from the standpoint of a percentage of the million that's allocated to this project, but in the larger scheme of things, so the portfolio would be very small, right? It's $200,000.
Right.
So it's just not, honestly, I haven't even looked at this position until now. You know what I mean? And I mean, it says a break even just on this alone is 1898. Now, mind you, that might not be totally accurate because part of this was from the roll right here.
Right.
This was from going from 2150 to 20. So we took risk off the table there.
This would be taking ownership of 5,000 shares of Hood, right? If it
no, it's a
10,000.
Yeah, 100 contracts. So what is that? 10,000 shares. 10,000. Yeah.
Yeah, see, I am not worried about. I'm way more confident on this one than Intel as well because I think near term we have momentum here as well. But I
lied. But you see, this is real good stuff to talk through because we have two companies that are at about the same price.
Yep.
And do we see Hood going from 20 to 25 faster than we see Intel going from 20 to 25? Because neither one of those is going to zero. I think that's off the table.
Yeah, correct.
What's the floor on Intel? I don't know. Gun to my head. Do I think that it could hit 15? I fucking doubt it, but I wouldn't want to do the gun to the head thing. You know what I'm saying? No, but I'm just saying I doubt it, because at that point it becomes stupid prices, right? In my
The
opinion.
S&P guys is at 529, so we just hit a pretty. This is a red day. This is a bad day. It's red. So yeah, I agree. Like, it's a really question of, this is where your conviction's tested, right? I personally don't have a ton of conviction on Intel, more on Hood. You are a little bit of the opposite. So it's really just navigating your conviction.
No, I know. Let's clarify. It's not that I don't have conviction in Hood. I just don't know enough. The only reservation I have on Hood, guys, is one, it ran up quite a bit. So I think this is actually healthy for Hood.
Yes. I agree.
But two, the only reservation I have fundamentally on Hood. Oh, nice. We're able to roll the path. I just got a notification.
Okay, perfect.
Is I don't know how that credit card business is going to pan out for them, because that credit card business looks really good for the consumer. I'm failing to really see the metrics, how that credit card business is going to really be good for a Hood, aside from getting people really, really excited about their beautiful gold-plated card or real gold card, whatever the hell it is, and making a bunch of videos on X about it whenever they receive their card. There's smoke in the background. People are they're getting really creative. I think it's even like in a Louis Vuitton casing or some shit. I mean, people have really gone the extra mile on this thing whenever they get their Hood credit cards. But does that business make money for Robinhood, or is that something new that Robinhood is going to be navigating? And I mentioned it to you before. It's kind of out of their scope potentially. Like, I don't know. Like, that's where you obviously know more about it than I do.
Yeah,
but
I think it'll be fine. I think it's going to help their net deposits. The bigger problem with Robinhood is not the credit card to me. It's if we have a bear market, like, Robinhood's revenues go down, right?
And then also, didn't you say at you thought there was like a little bit of a correlation with the way crypto performed in Robinhood?
Yeah, I mean, if crypto goes down, which it's going inverse right now, which is hilarious, but if crypto goes down, like, crypto and the markets go down, Robinhood goes down, right? Because Robinhood is so contingent on them. Wow, Robinhood's down 9% today. So they're taking a beating. But in general, after earnings, I think we get to reassess, right? If earnings is really good and we get a pop, then, we get out of the position. If not, we roll it.
So here's another thing. This is another way that you can navigate, like Intel. Like, can we go back to Intel real quickly? Because I can free up a lot of capital here, Amit. I mean, dude, you're a big part of this thing, right? I'm not just going to take over this deal. I mean, if we're going to do portfolio updates on my account, I do those on my fucking channel every day.
Yeah.
So I really want you to learn from this experience. So there is something that I eyeballed doing, because I was studying your conviction and your mannerisms. And I feel like you're kind of wishing that money was in Hood. You'd be sleeping a lot better at night. Am I fair on that assessment?
Yeah, but that's only because I understand Hood more. It's not that it's bad in Intel. It's that I understand, if it was a Palantir.
Knowledge equals conviction.
Correct. Yeah, correct.
I mean, knowledge is powerful, guys. Y'all think money's powerful? Knowledge is powerful, because something happens to wealthy people when they lose a lot. They don't start at zero. They start at fucking experience. You know what I mean? And they're able to climb that ladder pretty quickly in most cases. So there's one thing that we could do is we could take some losses on those cash secured puts, free up all of that capital on Intel, and we can move some of that money over to Hood if Hood's a much higher conviction play. And the only thing that we're going to be giving back on those cash secured puts on Intel is money that we got back from the original wins anyway. We've already had 2 or 3 successful cover call campaigns. It really wouldn't be that big of a deal, and it would keep the position a lot smaller, and we would be able to free up that capital for a higher conviction play like Robinhood.
Right. Yeah, that's not a horrible move. We're basically giving back premium, so it's a net wash, and we're taking the collateral and we're putting it somewhere better.
We're reallocating it from lower conviction to higher conviction, this is where you know what you want to be in, guys. That's the teaching segment for you. Whenever shit goes like this, you look at the portfolio. In this case, it's like, oh my God, that's a drastic move, right? That's a lot of beta for a portfolio this size. 6, because I own a lot of shares, right? So I haven't even looked at SoFi. I haven't even looked at the big holdings like Palantir and so on and so forth. When there's a lot of shares owned, I mean, dude, $1 on 150,000 shares. You know what I'm saying? Like on SoFi. And well, that's going to be 150 grand to the no bueno in a day like this. Like I haven't even looked at SoFi today.
Yeah.
So do you want to look at doing that, or do you want to stay pat on that? Because I mean, if we liked it at 20, don't you like it? Maybe selling some cash secure puts at 15, or are you like kind of enamored with trying to time the bottom?
No, I would love to sell cash puts at 15. I think we need a couple days because the good thing is those are expiring in 2 weeks. So I think next Monday or Tuesday we kind of see, because I think we have to see where the bottom is on this market. Like I don't think we need to make any moves until pound just went from 29 to 23.8 right now. I mean, like, where does it stop? So to me, I think maybe we give it at least a couple days, and we have the expiration, so we don't have to worry about closing those anytime soon.
Agreed. So one thing that I am going to do here is Celsius. So I've been doing a lot of research on Celsius, and I love Celsius at like the $35 range. Like, because I started like really looking at it, and I'm like, dude, it wasn't even that attractively priced at like 46, 47. It still had a PE ratio of like 50.
Yeah.
So I mean, I'm just like, shit. I don't know why I thought that it was like a great deal. It was more like a prisoner of the moment from the standpoint, like it was recently approaching 100, and now it's like I would be committing to buy these at 45. So it sounds like it's a good deal. But like if you had a house that was worth $1 million, or you had it for sale at $1 million, but it was only worth like 500,000, and then it comes back down to 500. You reduce the price to 500,000. That doesn't really make it a good deal on the house. It's just going back to kind of what it's worth. You know what I mean? You had it overpriced from the very beginning. So I could free up some capital there too, and just take a small loss on Celsius, and move that money over to higher conviction. Or how do you feel about Celsius?
Yeah, I have not done enough research on Celsius, so I don't know about this one. I do know that the sales are going down from some like Nielsen study, and that's what really triggered them to get hit. There's some medical journals are saying too much caffeine, yada yada. I don't know. I think the growth is going to potentially slow down, and then people are going to question why is it valued 1/3 of Monster's valuation, which is doing like 10x more revenue.
Right.
But yeah, if it's a low conviction for you, then I agree. Taking a small loss on that and moving on is
it's just lower conviction, and I'm trying to free up capital. I do like it at those. I mean, again, we don't have to do anything. We're just talking through it, right?
Yeah. Yep.
All we're doing, that's all you do when you're dealing with the portfolios. You're talking through it. But now that Intel, I hadn't really looked at these cash secured puts. My idea doesn't really work because that's a bloodbath there. If you look at like these 32 puts.
So let me ask you a question about this. What is your philosophy on rolling this years out? Like if you rolled it to 2026 or something, you would obviously get a credit for that. The problem is your collateral would be tied in for a couple of years. But is that better than taking the loss and navigating that type of position?
Yeah, so I wouldn't do that. I wouldn't. I mean, I've done it. I've done it early on in my career. I mean, we can look at it. We can look at it because
I'm just curious if you're in a cash secured put and it goes really south. What is the philosophy on rolling it really far out?
Yeah, I don't go that far out because you want to give the market a chance to rebound. But I would consider going January 2025. That'd be my go-to move. And then keep in mind, we've got to make up $1,148.
Yeah,
so
you would have to keep this. You would just be collecting premium at this point.
Yeah, but not even a lot.
Well, right. But here's the thing: like, is there a philosophy on continuing to roll the contract every single week or month, even if it's super in the money, and just collect a little bit of premium every month?
It's really the same profile, Amit. Like having these cash secured puts on. This is a really good teaching segment for you guys. This separates wheelers from wheelers. This is the stuff that there's levels to this game, right? And I feel like I'm not top tier, but I want to approach top tier at some point. There is literally no difference from a risk profile from owning shares and having a cash secured put.
Right, because the collateral is there.
Because I'm just saying this cash secured put is not going to go away on its own.
Yeah.
So it's just you don't want the P&L. You don't want it to hit your balance sheet. This is shady shit. that companies do to make their books look good when it's time to report earnings, right?
Right.
Because if I don't take ownership of these shares at 32, I don't have to show $11.5 down on those shares right now. I can just say something like on the conference call, oh, we're just navigating those rough waters on these cash secured puts. Everything's going to be okay. Our trajectory is 6 to, you know what I'm saying? Like I sound like one of these bullshit CEOs. But the reality is you got to treat it like you're underwater on these cash secured puts. And where are you going to get your money back faster? Are you going to get your money back faster by doing that? Or would it make more sense to take ownership of these shares and sell very aggressive covered calls against those shares to get your money back? That's why I rather just take ownership. That's why the golden rule is only sell cash secured puts on stocks that you're willing to own. Because if I take ownership of these shares at 20, this is separating TJ the Wheel Deal from your average Joe that's trying to do this for a living. I'm not looking at 32 anymore. Dude, I've already surrendered that fantasy. That's getting caught with my hand in the cookie jar. And now I'm going to rely on my skill set to navigate the technicals and keep studying the fundamentals of the company. And I'll be selling covered calls on this thing at like 23 and 24 bucks to bring as much premium as I can through the door, because now I have to play the game called lower my adjusted cost basis. Now, this is something that on every book that you read, it's going to say you never want to sell covered calls below your cost basis of your shares. And that's cool for them. But I don't follow those rules. I'm writing my own fucking book. You know what I'm saying? Because I'm not going to bag hold at those levels for that amount of time. I would rather sell very aggressive covered calls and hope that I get caught with my hand in the cookie jar on that, because then that means that the position is recovering as a whole. But if it doesn't recover, well, I'm bringing more money through the door to lower my adjusted cost basis. That's why I'm not a fan of rolling so far out of it. Because now I'm not bringing any money through the door with that same amount of capital that's tied up. So I'd rather just tie it up on the shares, because now I can sell covered calls against those shares. If I kick this can down the road, let's just play your game for a second, right? These are really, really good exercises, guys. I hope y'all get value. Give us a thumbs up if you're getting any value here, because I'm giving you guys some shit that you're probably facing right now in your portfolio. And this is – go ahead.
Let me summarize what TJ's saying right here as you're pulling this up. TJ is basically saying, hey, instead of a cash card put that's underwater by $12, 32 versus 20, and rolling it out to hopefully one day not get assigned on it, instead you get assigned and then you sell covered calls at, let's say, $23 if the stock is 20 and you got assigned at 30. You're going to pick up more premium, but you have to watch it like a hawk, because obviously if it goes past 23, then you get sold at 23 and then you lose $7 a share because you got assigned at 30. So it is a way to capture premiums in a risky environment, but it is something that is way more lucrative than just rolling the actual contract itself.
Yeah, because now I'm going to look at what does it look like if we already own those shares, right? Because I already showed on the options chain that you can go out to January of 2026 and you're still not making any money.
Right.
You're still not making any money. So let's just say we took ownership and we sold them a month out. Now there's a little bit of money here. I'll sell them at like $23. And we got to obviously go find people on the dance floor. There's obviously that as well. There's some people at $24 and it's a 21 delta. That's good news. That's good news. And there's a good news here that there's a little bit of open interest, etc. The volatility is kind of high for Intel. So the premiums are pretty decent. So now I'm like, okay, there's 7,500 shares that I'm going to have to look to take ownership of, plus the 1,000 or the 10,000 shares that are already owned. So help me out with the math. Amit, is that 175 contracts?
Yeah. Yep.
Okay. So now I'm like, well, let me pick 24 as a strike. And then now let's just see, what does 175 contracts bring in? That brings in about $6,500 a month. So to me, that's way more lucrative taking ownership of the shares and then just selling covered calls and actually hoping that these covered calls get underwater, because I would gladly be okay navigating that, because then that means that
your overall
the shares have improved.
Right. No, I think that's better than than just rolling the contract. I agree. I think it makes more sense to do that.
Well, because now you bought the rental, bro. Bottom line is we overpaid for the fucking rental house. So what are you gonna do? You're just gonna sit there and mope and cry and be like, yeah, I overpaid for the rental, dude. Suck it up. Put a fucking renter in there, and let him pay you for your mistake, right? And eventually the market will go back up, hopefully. But that's what people do in real estate all the time, dude. They're not sitting there constantly trying to like time the market, because they got 20 and 30-year horizons. That's why statistically, people that invest in real estate make a lot more money than people in the stock market, because going in, they already had a proper mindset, which was a lot more long-term than people trying to just gamble here on short-term stuff. And,
All right, let's answer this last question on Intel, then we'll move on. Akshat says, what if we sell Intel, do the same strategy on a different stock, take the loss, but try to recoup the losses on that's something like NVIDIA? What is the philosophy there?
Yeah, it has to be something that I feel like is more attractively priced. And is NVIDIA a better company? Yes. Is it at attractive prices right now? Let's look at it. I don't know. We haven't looked at NVIDIA.
It's not going under 100 yet, which is interesting. It's getting a little bit of a floor at 100. Right now it's at what, 103, 104?
Yeah. I mean, it's still, where was it? When did it, was it 3 months ago? When did it do the little deal?
The split was basically at this price. I mean, 140 was the top, but the split was essentially around these levels, or maybe at like 115-ish. That was the split. So it's down from the split, still up year to date. Look at this, 133%. I mean, that's just...
I'm just saying, like, you got to put me on something that's a good deal. Yeah. Because I'm just saying that this story has been very, very hunky dory for a little while. Again, it's got to be super high conviction, and it's got to be a good deal. And I mean, I'm not saying that Intel is like a great deal. I think it's a good deal from the standpoint that I think it's going to find the floor very, very soon. But if this whole sector continues to get hit, I mean, this guy right here, man, it's gonna be the poster child for that too. Just like it was the poster child whenever it went up.
That's a good point. I mean, I know everyone loves NVIDIA right now, but you're right. If the semis take a collapse, Intel's already down 30%. Maybe it falls another 20%. But NVIDIA is going to hell if the semis take a real collapse, right? So it's not like NVIDIA is that much better yet. But then it begs the question, do you just want to be in the semis in the first place? So
yeah, so there's this Diaz, Jeff, can you pull that comment up? That's a really good point, guys. There's companies that come to mind like Cisco. There's companies that come to mind like IBM. There's some companies that just don't rebound because they just don't recover either fundamentally, or they were just so damn overbought that they're just reverting back to the mean. You know what I mean? So you can't just look at price action, dude. Intel, to me, I just think it's going to be a turnaround story. And I think the biggest turnaround with Intel is going to happen when they fire the fucking CEO.
Right.
Because he's missed on earnings like 3 or 4 times since he's been CEO. And he hasn't been the CEO that long. So I think he only has probably 2 or 3 more quarters to sell this bag of goods to us. And if he does it, I think the new CEO, new energy is going to bring a lot more excitement to Intel. I think they're doing really, really good things. They're like cutting the dividend. They're making very hard decisions, but they're necessary. Like they're necessary. They should have probably let go of that fucking dividend a year ago and just dealt with the pain. But I think that they just didn't want to pull the Band-Aid out for whatever reason. So, dude, don't get me wrong. NVIDIA is very attractive compared to where we got it. But let's also rewind the tape a bit. I mean, didn't we know that we were kind of like buying at the top when we bought the 300 shares?
Yep, 100%. Yep.
But then we also have 7 cash secured puts that we're navigating at 118 already. And we have 10 cash secured puts that we're navigating at 105. So there's already Intel type money over here in NVIDIA.
Yeah, and I think those after earnings, we can either roll them or get assigned. I think the thing about earnings on NVIDIA is it's going to be good. We know it's going to be good because of the CapEx.
So but we may be able to take advantage of a real small bounce or a real quick bounce because the numbers are amazing.
Correct, like we did with Meta, which we'll talk about in a second. But the only thing is the market going to be willing to give them a multiple if they think we're heading into a recession, even if the numbers are good, right? And so that's what we're going to have to see with NVIDIA. Now let's go to Meta because we did a good thing on Meta yesterday. You called the top on that at 525. We closed those puts, which was good because this thing tanked right
Holy
after.
shit, dude.
Thank God we closed those. That was
so I got lucky yesterday, guys. My technical analysis is not that good anymore. Yeah, so right around here, I closed out those cash secured puts. Let's talk about it.
They were at 480. So
well, I didn't close them out. I reached out to you first, and you gave me you told me it was a good idea.
Yeah, I mean, it was up 80%. I was like, yes, let's do it. We're done.
So it was right here. We had sold the cash secured puts on July the 15th to 480, and they expired. They would have expired a couple Fridays from now. Collected 89.25, and then at 8:44, shortly after the market opened, gave back $2.30. So we locked in a pretty nice win there and freed up quite a bit of collateral because you're talking about $48,000 5 times over.
Yeah.
That we would be navigating right now because now it's essentially at that strike price.
Well, so what we did here, I think, is very important. I think now, if the market is getting into correction territory, it's going to be about bounces. And whatever thing has a bounce, when the RSI hits a certain level, you get out of it, even if you take a small loss, and you navigate it versus, waiting until shit hits the fan. If you get the opportunity, like Palantir. So let's talk to Palantir. You have a $26 put there.
I told y'all I was going to tank the stock moment.
You absolutely helped us tank the stock with doing this. So this $26 put, it expires right after earnings. I don't know what earnings is going to look like, but this macro is not friendly right now. How do you feel about rolling this one on August 9th? Because I think eventually Palantir will be back above 26, and I think we'll get paid a very good premium at 26 as we roll it, I think, week by week, unless Palantir goes to like 18 or something, maybe then.
Yeah. So that's a really, really good question. And that's where not every cash secured put is different. So before we talk about the cash secured put, we have to talk about the actual position. So this position, I feel, has been underweight in this portfolio for a long time. And I've been wanting Palantir to go to like $20 for a long time so that I could essentially almost double the position. So I actually have a target to double this position if Palantir gets to $20 a share. And that would put me at an average of about 17 and some change.
Right. Because you also have a bunch of shares getting called away at 12.5, right?
Yeah, well, I'm gonna keep those by rolling them. I'm just been waiting for a scenario like this to give me that opportunity because this thing is gaining value today, right?
Right.
Because covered calls do well whenever the market tanks. It's your little hedge to the downside. So that is a very, very interesting situation for me now because I finally have an opportunity to cap off this position right here. But I don't want to be in a hurry. So I'm going to keep those on, but I'm only wanting to roll those out a couple of weeks at a time and maybe go from like 26 to 25.50, 26 to 25. And start approaching my acquisition price target. And my acquisition price target is $24, which is kind of where it's at right now for that batch of shares. And then if it gets to 20, then I'm going to, wherever the position is at that point, I'm going to try to make sure I have the money to essentially double the position at that point. That way I have that 17 or 18 average. And then from there, I just think that I can manufacture the win. And it's a company that I've been underwater on before when it was like at $7 or $8, and it never stressed me out. I was just always pissed off that I wasn't able to like acquire more shares.
So would you want to get assigned at that 26 level, or would you roll that?
No, I 24 is my acquisition price target on that batch. I don't want to pay more than 24 a share on Palantir. I'd prefer to pay 20. I don't know. Palantir has proven to be such a resilient stock.
By the way, real quick, TJ, I just got a text from Steve. He just bought Amazon, Google, NVIDIA, and Intel. So for anyone who wants to know what Steve was buying, he bought those for. Okay, go ahead.
Well, tell him we bought a lot more Intel than you
thought. So that 26, you would just roll it then?
I would roll it. I want to get them at 24. So I'm not that stressed out about it. But I also I'm going to utilize the buy right strategy. If it gets to 20, I ain't fucking around. I'll just buy shares.
Me too.
I just buy shares because I want to own those shares, and that's the thing. It's like if you have a time horizon that's like 5 years, 3 to 5 years, if not longer. In your case, you've talked about willing these shares to kids that aren't even alive yet.
Yeah.
What does it matter if you get them at 26, 25, 24, 23, at 20, or at 18? If people are more enamored by their entry point, the big players are more enamored with share accumulation.
Yeah.
If they believe that it's going up and to the right over a longer horizon. And again, this is where a company like Intel, it's very interesting, right? Because again, it's a very similar price to Intel.
Yep.
And I do think that with just a couple of pumps, a couple of good news, whatever the case may be, a couple big contracts to this Palantir community, you guys have proven to be like a band of brothers, if you will. You know what I mean? And this thing, I mean, if you just want to play price action, which is what we're doing when we're selling cash secured puts and covered calls, you're playing price wars with the market. For me, it happens to be on investments because I'm not a traditional wheeler where I'm not always trying to get back into cash.
Right.
So I just want to accumulate more shares that I'm not that stressed out about. Oh, I don't want to sacrifice my my average cost of $14.61. You know what I mean?
Right.
I'm more concerned about how can I get that to 50,000 shares, because then I don't have to worry about 20% of the portfolio because it would be in one of the highest conviction names that I have,
right.
which is Palantir. So
can we look at Tesla? Because your covered calls should be doing better on those, right?
I would imagine so. And I'm looking at this shit for the first time, guys. Like I just got out of the shower before I hopped on here. So here's Tesla. So, oh wow, Tesla's holding up pretty strong. So Tesla's at 211. So that part's all good. And then we have some put credit spreads that I sold at 175 and 170 that I'll turn into regular cash secured puts if they get challenged. I don't think they will. That's why I picked such low strikes. And
you got a decent, you got a 80. How much did you get per those 500 of collateral? You got how much average?
No, I got more. It's 15 contracts.
Yeah, but the spread is $5. So you got 10%. You got 55 cents for putting up 500 in collateral.
Yeah, so 825 is what we got.
Yeah, 825. Okay, perfect. Yeah, so that's 10%. That's not bad.
Yeah,
that's not bad.
And I think that Tesla at 175 signed me up.
Yeah.
Sign me up. Like I won't even you close the long put, you make money there, and then you obviously need the collateral. So 17,500 times 15 contracts, it's a shitload of collateral. And I essentially position myself to almost double that position. Because again, this is another company that I have felt underweight on a long time. So this is where your conviction gets tested, guys, is whenever stocks go to levels that match the bullshit that you've been typing on your X account. How many of y'all have said, if Palantir goes to 20, I'm loading the fucking boat? How many? Put yourself on your shit right now. How many of you guys have said on a midstream, because I can go roll the tape, I got some artificial intelligence that I just bought. I do. I have artificial intelligence, paid $105 for it. It takes my 1.5 hour long video and it gives me like 50 clips real quickly. And the chat's on there too. And I can go quickly tell it what to do and call all of you guys out that said, oh, I'm going to buy Palantir at these levels. I'm going to buy Tesla at these levels. Well, where's your conviction really at, or is it all bullshit?
No, it's a good point. I mean, and it's just, I don't even blame anyone for saying it and not doing it, because I do it as well. It's like, it's human nature, right?
Well, everyone wants to commit to something you don't have to do right now.
100%, 100% agreed. Christian, thank you for the $2 super chat. TJ helps us understanding VIX implication, or he's asking you, TJ, help us understand VIX implication. So the VIX is up, the volatility index. That is why some of the market is, or all the market is crashing. Another comment real quick, and then I'll let you talk on that, TJ. Someone said, Amit, I was traveling for 2 days. What happened? Then if you're just joining, unemployment is up to 4.3%. That is the reason for why the economy is slowing down. That's why the stock market is kind of pricing in a pseudo recession. So if you're just joining, it's that unemployment rate that's bad. So TJ, what do you think about VIX going up and how you navigate that from a options perspective?
VIX going up means that equities are going down typically, but as an option seller who manages his bankroll pretty efficiently, like that's the thing that like people will think that I'm good at like a lot of things. What I'm really good at is temperament control, emotional control, and bankroll management. Because when I played poker, I only had a certain amount of money to work with, so I couldn't like let my emotions get the best of me and have a couple of bad hands and sleeping on the streets in Vegas. You know what I'm saying? Like I had to manage my bankroll and I got to manage my emotions. So that really prepared me for this game right here. So that means that the premiums are all going to be elevated. This is almost like having a binary event at your disposal just about on every stock that you look at. Like the premiums on any company you want to sell cash secured puts on, they're just going to be a lot higher than they were, say, 3 or 4 weeks ago.
Right.
But they gotta, again, you can't just play price action, dude, because the market can be irrational longer than you can be solvent, right? We've all heard these things before. So you gotta pick a stock that you're genuinely excited about. And if it gets to levels that you, based on your homework, and maybe look at the chart and stuff, because the chart will show you when to get in, right? A little bit. But the fundamentals are going to tell you whether or not you even want to buy the company to begin with. Then you have to start placing your bets very, very aggressively, because I always ask myself this question, Amit, if not now, when?
That's a good point. And it's hard to time the bottom. Can we look at the covered call on Tesla? Because I think that should be up nicely. I know you rolled it, but 225 for January, right?
Yeah, so I'm approaching break even, but I know I didn't collect all of that on the roll. So you just need theta decay to do its thing. There's there's some theta decay. So it's going to take time. Again, that's why I'm not a huge fan of doing all of these things. Now, there's another thing that I could do now. There's, we always talk about rolling out and up, right? Well, you can always roll down and in as well. Like if I want to create more of a hedge for the downside, because I think Tesla can maybe go to like 200 or 170 or something like that, then I can look at trying to roll this out, try to roll it in so that I can eventually control these shares a little bit sooner. So we're sitting over here in January. Maybe I can look to free up the shares a little bit earlier, like over here in November. And I got to make up $29. So keep that in mind. So I can maybe, if I want to break even on it and I'm willing to get very, very aggressive with the strike price, I can essentially shave a couple of months off this contract and lower the strike from 225 to 210. And I did a little bit better than break even. And I positioned myself to take control of these shares a little bit sooner.
So you would be reduced. So that would be November. But then the question becomes, do you think Tesla's under 210 by November?
Well, that's, those are the things though. But also if I am right, it helps me to be able to start eventually selling covered calls again, because all of this right here, this is dead money for a while.
Right.
And dead money is whenever you have money that's parked there and you're not able to make any more money with it. That's why I'm not a fan of kicking these cash secured puts on Intel way down the road, because I could at least make money over here selling risky covered calls versus just parking freaking $200,000 or whatever it is, $250,000 out for 2 years just because I don't want to show it on the P&L.
Right.
So I'm like, so that's something that I won't consider doing on Tesla until I'm probably at about 30 to 40% profit on this covered call. Because right now it's not causing me any stress. It used to cause me stress. And Tesla is also one of those stocks. I mean, you got to know how your stock moves, right? Like Tesla is one of those stocks that, when it moves really, really big in both directions. It's kind of like crypto. So the other thing that I'm looking at is I got to navigate these put credit spreads for one. I got to make sure that I'm okay there, because that's for 920. And that's a lot of capital that I potentially have to allocate there. And also have to look at, these leaps have done really, really well. They're not doing as well now, but at some point these were up at like $125,000. And I remember thinking, man, I wish I had more leaps. So now I'm like, well, let me just keep an eye on this thing, because if Tesla does go to like 170 or something like that, then maybe I want to buy 10 more of these bad boys. That way, whenever it does bounce again, you know, I have a much larger win that I could potentially lock in. So, you know, you just got to look at all the aspects of the portfolio, man. And at the end of the day, if there's an opportunity to go from a trade to an investment, then, you know, you should probably do that.
Let's answer this question. Bsoft, thanks for the $5 super chat. I like Hood, don't mind it. Followed y'all at 816 $20 puts, 130 average contract. Thoughts on selling more for 275 a premium? Personally think good earnings for Hood. Yeah, so if you are long Robinhood, which I am starting to become more long Robinhood than just a trade over the next 10 years, and like actually long, not just like bullshit long, but like legit long, because I think they can get to $500 billion AUC, 35 million accounts, then I like the $20 price range. I also like those $20 puts because I think earnings is good. Now, the nuance here, and I think TJ would agree, if they crush it on earnings, but the VIX is up like what, 20%. If the VIX has another crazy day, then it doesn't matter, right? It's same thing with Palantir, same thing with Nvidia. Like they can crush earnings, but the macro is not going to let them move forward. Now, if the macro subsidizes, right, like it relaxes over the next couple of months or weeks, and they have a good earnings, I think that earnings momentum will get baked into the stock, because once the macro chills, the market's gonna be like, oh, holy fuck, Robinhood's going 50% year over year, blah, 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 blah. All the numbers start making sense. So if you're selling those puts for premium, I think your average would be closer to 17. I like that adjusted cost basis, but Robinhood could fall back to 15 if shit really hits the fan, and you just got to be prepared for that.
Agreed.
Do we want to look at SoFi?
SoFi. Somebody told me it was in the sixes. Is that true?
Yeah, I'd hit the sixes.
Holy moly, look at this guy.
SoFi. Oh,
so boy. I sold 20,000 shares.
Outright.
Here we go. I sold somewhere over here. So I sold 20,000 shares at 783.
Oh, it's a good sell. It's a great sell. There you go.
And then earnings came out, and the market didn't receive those earnings well.
Right, like it always does.
Right. So I started selling backstop trades. I started selling puts in the distance. And I sold 200 contracts at $8 for January 2025. Another 20 contracts at $8 for 2025. 200 more contracts at $7. Another 200 at $8. This is all for 2025 January. 80 contracts, 100 contracts. And then I sold one covered call as a feeler at $9. Should have sold 1,500 of them. So that is what's going on with SoFi.
So essentially, you sold some shares, took some profits, wrote some puts. You thought earnings were good. I thought earnings were really good as well. Market didn't receive it, and then sold a bunch of covered calls on those shares you bought at $9, and you still got paid $15 a contract for $9.
I only sold one contract.
Oh, one, just to check.
I wish I would have sold a lot more, because I'd be sitting really, really good on those covered calls right now. So,
why'd you only sell one? You thought SoFi could go up to $9? You had a feeling?
Yeah, essentially my bet was that SoFi was going to go up, and then I would sell the rest of them and collect more than $15. So evidently I was wrong. So I've got 1,000 covered calls. So let's look at the whole position, right? So there's 150,000 shares, 774, obviously underwater, because $1 is 150 grand. So that's the reality of it. So it makes sense because SoFi is at 674, right?
Yep.
So there's that. But then I've got that one doesn't count. So I've got 1,000 covered calls at $8 expiring on 8/30. So we can look at that one real quickly and see that up 80% on those.
Wow, you're up 50 grand on those. Holy shit.
Yeah. So,
and you don't think we get to $8 by 8:30, so you're going to collect the remaining 12 grand.
Well, I'm going to at least try to get 6.
Yeah.
I'm going to try to get 6. At that point, it just doesn't make any sense to hold it. And then I've got all these puts in the distance, 1,000 puts at 8, 1,000 puts at 7. So there's a lot of capital there, $1.5 million.
Yeah. Yeah.
And I feel like it's easy money just to be, that's where I'm at. And then I also have 1,000 leaps, 600 at 10, 200 at 7, and 200 at 5.
Right.
So I don't have covered calls being sold against 50,000 of these shares, and I don't have any covered calls sold against these leaps right now. So there's a lot of money that I could be bringing through the door, but I'm playing SoFi for a bounce, and SoFi has to be above $8 for me to sell those covered calls, because I just don't want to get in a position to where I have to navigate so many contracts, because it's proven very difficult for me to roll that many contracts. Because on Robinhood, if you're going to collect more than 25 cents a share, it only allows you to either sell puts or calls or roll 200 contracts at a time.
Yeah.
The only thing that you can do for larger than those quantities when it's above 25 cents a share or $25 a contract is buy to close.
Right.
Like you can't even sell to open. It's just Robinhood has that limitation. We already talked to management, bro, and they're not going to change it.
Well, the 200 contract.
Yeah, it's
why do they have that? Do you know?
I don't know, bro, but it's an absolute bullshit thing. Talk to your boy Vlad. I don't know because on Webull I've done 1,000 at a time. They don't give a shit. They'll make it happen.
It's very weird.
They'll make it happen. So I don't know. I think that Robinhood, when they started, they were catering to the $2,000 to $10,000 account, and then now there's people that have some money and they want to use it, but there's a lot of limitations on the platform.
Right.
So anyway, so that's what's going on in a nutshell. Can we talk about something that I'm super excited about?
Yes. What do you want to talk about? Amazon. Yes.
So I've got some put credit spreads on Amazon that are underwater. So how do you feel about buying to close the long side and turning these into regular cash secured puts and navigating those, and then eventually positioning ourselves to take ownership of these shares in the 160-ish range?
Okay, so let's break this down. This is a good one. So I talked about this a little bit a couple of days ago, but let's actually break it down. So what TJ did, I'm gonna explain it, and then TJ, you correct me where I'm wrong. Is a put credit spread.
Mm-hmm.
A put credit spread is when you buy a put and you sell a put at the same time, different strikes. The sell side of the put is higher than the buy side of the put in terms of strikes, same expiration. Now, why do you do this? If you sell a cash secured put, let's just go you and me. We're selling it at 165 on Amazon. You need $16,500, 165 times 100 to collateralize the put in order to appreciate the premium or receive the premium from the cash secured put. When you do a put credit spread, you're buying a put in this example at 160. So if Amazon goes from, I think you did it when it was like 185-ish, 190. If Amazon goes down to 160, or even if Amazon goes to 170 or 173, that put increases in value. When you buy a put and a stock goes down, the put increases in value. You're buying protection. You're buying insurance at the end of the day. The long put. When you sell a put, the short side of it, you are trying to get the stock to stay above that strike. It can go down. It just can't go down below your strike, because then you have to pay for those shares if you get assigned those shares. So when you do a spread between them, my understanding is you buy the put, you sell the put, you create a spread. In this case, the width was $5, 165 minus 160. So you have to put up $500 in collateral, and you get paid a premium for that 500. In this case, I think you got 50 cents, 70 cents, whatever it was. The premiums on the put credit spread tend to be way better than the premium on a cash secured put. And because the reason for that is because you're buying one leg and selling one side against each other. The catch is that if the stock goes below the strike price, you don't just get to buy the shares as a normal cash secured put. So you're technically kind of safe, because at the end of the day, you can buy the shares and hold it forever. You just lose your collateral. So that 500 you put up, it's gone. And so you keep the premium. So if you got 100 in premium, you lose 400 technically, right? But that's the downside of it. So what TJ wants to do right now, and what we're going to do is because Amazon fell 11%, the buy side of the put, the long put, should have appreciated. We can close that, capture the profit there, and then just turn the sell side of the put into a regular cash secured put.
So you can see that the long put is printing, right?
It's up 300%. Yeah, there you go.
So essentially, if I want to lock in that win, it's going to ask me for the collateral necessary to turn the other short put into a cash secured put, because you can't do anything naked on Robinhood except trade from the comfort of your home. You follow
Which
me?
means you will need to have 82. Yes, which means you will need to have $82,500 ready to go if you're gonna collateralize the CSP, because 16,500 times 5 contracts.
Right. So essentially, if you want to close out this long call, you're buying a long call, so you have to reverse the process, and you essentially need to sell to close, right?
Correct.
So you go and it's 5 contracts, and say, like, I'll give you guys, I don't know, 415, and then you hit review, and now it's going to ask me for collateral. You see that collateral right there?
Yes. So it's asking you for the 80 grand to capture the credit.
Right. Well, because now I have to turn the short put into a cash secured put. Because before we do that, let's look at this right here.
Yeah, I was gonna say, do we like Amazon at 165? That's the question.
Yeah. Well, there's that, because this is a defined risk trade, meaning the maximum that I could lose here is the $2,500 in collateral.
Correct.
That's why people like it. And then I got paid $240 for doing it. So it's essentially about 9% return on your capital.
And again, remember, guys, the 2,500 came from $500 times 5 contracts of collateral. The $500 came from 165 minus 160. That's $5. 5 times 100 shares. A contract is 500. So you put $500. You got paid times 5, 2,500. You got 900 something or $240. So you got 9% on your money in a couple weeks, which is not bad.
Right. But I mean, bottom line is, if you lose one, it wipes out 6 or 7 wins, right?
Correct.
So you got to be careful. That's why I do these way out of the money in other words, when a put credit spread gets challenged, if I'm not excited about that, because this is way out of the money in most cases, bro, you have no business messing with that stock, because you don't like it at any price at that point.
Yeah, you picked a strike that's way too close to the money. And if
it's one of those, like, I'm begging the market, I'm playing chicken with the market. I'm like, dude, if you give me at these prices, like, I can't give you my money fast enough.
Right.
And that's how I felt about Amazon, because you got to go back to the origins of everything, right? So I had a position in Amazon, and when I sold this position, it was immediate regret, guys. It was immediate remorse. But pride kept me from getting back in. So I bought these shares, 1,200 of them at 129. Then I started selling covered calls. They got underwater, had a freaking roll. Sold more puts over here at 120, blah, blah, blah. Bought more shares at 152. And then I'm selling covered calls. But then over here, I don't know what happened, but I started becoming an idiot. And and people are like, oh, you've been that a long time. Okay, cool. But I sold 300 of these shares at 172, and then another 1,200 at 172. So now I have an opportunity to buy, for whatever reasons, the stock market God's Amazon edition is shining down on me today. And he's like, hey, you remember that time you acted like an idiot? We're going to give you a hall pass. You can actually buy these shares right now for less than you actually sold them.
Right.
And then I made some money along the way, also trying to sell more puts over here. You'll see I sold puts, collected 76.50. This is before we were doing this deal. And then I bought to close those puts, gave back 2,500. So I locked in about 4 or 5 grand there. And then, I gave, I guess I don't know what happened here. Yeah, so I collected 7,600 and 4,200, then I gave back 25, and so it looks like I made about 7 or 8 grand. And then this is the put credit spread that we're in right now, where it collected.
Basically, you're fine owning it at 165 if you get it, and that's why you're doing it at the end.
Yeah, I'm just like, I feel like it's not as good a deal as I had before, but also Amazon just had earnings, I believe, yesterday. I'm a little out of sync as far as when earnings are, because it seems like a lot of it happened this last week or so. But I think Amazon might have been yesterday, and I thought they were pretty good, dude.
I thought they were some of the best earnings I've seen from big tech. It was amazing.
Yeah, so I'm just like, and it's only 5 contracts. I had 1,500 shares before. So again, it becomes like, if not now, when? And then I look at the stocks in this portfolio. I'm going to put it on equity. I mean, bro, if there's $1 million tied up in SoFi, how the hell is there not at least 100,000 tied up in Amazon? You know what I'm saying? I mean, just calling a spade a spade. So I just feel like the portfolio could use a little Amazon and maybe not have Path because it's low conviction. We could cut this dog with fleas loose right now and probably lose no more than $2,000. Not a big deal. I can say I tried and I failed. It wouldn't be the first time. And I could replace Path with an Amazon. I mean, I'm not saying I have to do that, but I'm just saying if we chose to, it's not that big of a deal. Because we've collected quite a bit of premium on Path, believe it or not.
So I think let's close out the put credit spread on Amazon first, and let's get that out of the way. Because I agree with you. Amazon at 165 to me is a no-brainer. Could it go down to 140? Of course, if we have a recession.
But then we buy more shares.
Yeah.
And people will say it like, you know, I don't want people to think like it's all nonchalant. It's because you have all this capital and stuff. And I'm like, no, it's because I manage my bankroll. You have to do the same. We are all playing the same game, dude. It's just it's X's and O's. It's just the number of contracts is going to be different, but you still have to manage everything accordingly. And dude, I love Amazon at 165. But you got to also keep in mind the short put is getting this ass kicked. Look at this short put right now.
Yeah, well, it's because it's below 165. Yeah.
Look at that. 300% that you're down. You know what I'm saying? That you're up over there, you're down over here. That's how it works.
Right.
So let me go over here to the long put side. So it'd be this guy right here. So
Powell speaks August 16th, I think, at Jackson Hole. I think it's like a couple weeks from now he speaks.
Bought to close. So it'd be 5 of those.
Guys, Figure just released a new video. Me and TJ are about to be done, and then we'll watch the video live on stream. So we're closing these. And so now it's going to ask you for the collateral.
So it should have filled. So there we go. So now have these puts, and it stands to reason that I'm going to be underwater those puts, right?
Yeah, because we're at 163. Yeah.
Right. So that's why it's going to show as a no bueno there for a little while. So, dude, I feel good about it. You know, I feel really, really good about it because now I've got something that I'm excited about. You know, like I have this one here that it's like I can't wait for it to get to like 80% so I can close the shit out, right? I have plenty of shares in NEO. That was a cash grab that obviously went wrong from that standpoint because NEO is actually getting challenged at these levels, which I just didn't think it was going to happen. So I can't wait to free up that money. And then, you know, now I've got these Path puts that we shot out in the distance to 830. So I don't have to deal with that for a little while. But then we also have these covered calls that were expiring, and those should be doing pretty good. I'm trying to find them right here. So these covered calls are doing pretty good. So it can essentially give back $200, close out the covered calls, and sell out of the position completely, and then only navigate the cash secure puts that we just kicked out to August.
Right.
You know, that's a possibility. You know, we don't have to do it right now, but I'm just saying that's something that's on the table if we want to clean up the portfolio. Because I guess if there's a teaching segment for you guys is I use these types of situations to clean up a portfolio. Like I'm like, okay, I was fishing on Celsius. I'm fishing still on NVIDIA, CrowdStrike, Path, MicroStrategies. There's really no conviction there because all these prices are a lot more attractive today than they were when I first got into them. And I'm not excited about it, then it tells me where my conviction is on those plays. So like here with Celsius, I'm in a position to take a small loss with Celsius. That wouldn't hurt me that much because I've made some money with Celsius along the way. And it's so that's a little soul searching that I have to do there, because again, it's like it could be one of those companies that never sees $90 again. You know what I mean? Hell, it might not ever see 50 again because it's still not exactly a deep discount at these levels. And now I just have to look at these positions here and be like, okay, like Open Door is something that it's a very big position, if you will, but I also have a pretty decent entry point at 189 on 35,000 shares. So maybe it's one of those that for whatever reasons, I just kind of got lucky on the bottom there. You know what I mean? So I'm not going to let go of a trade that I'm not underwater on. So what do you see here, Amit? I mean, let me minimize it here. I played this game yesterday on my stream. Let's play a game. These are the investments. 1, 2, 3, 4, 5. These are the investments. And if I wanted to graduate 5 of these right here, starting from right here. Let me go a little bit bigger. Here we go. Starting from right here, if I wanted to graduate these 5 of these to investments, and we can obviously use Amazon as well, Meta, stuff that we've dealt with here in the past. And I wanted all of the positions in the portfolio to be at least $250,000 of this list, also adding Meta and Amazon to the mix. Which 5 would you be targeting?
Yeah, I think
Hood as well.
Yeah, we'll wrap up on this. I think it's Amazon, Meta, CrowdStrike, Nvidia, and Hood. I mean, those are the 5 that I would easily do at those levels to make them like big positions in the portfolio. Just because long term, I think all those 5 are going to be good. But the other ones I don't think are bad, like American Airlines, MicroStrategy, just Bitcoin exposure, not horrible, but not the ones I would love to, make top 5 positions.
Yeah, they're really like I don't like it maybe to the tune of $250,000, but I really like American Airlines at these levels right here.
Right.
It's just very easy to sell cash secured puts and covered calls on. So anyway, man, I hope you guys got some value. I could have easily played sick today. The portfolio is not looking good.
Oh, dude, everyone's portfolio is shit. It's not like anyone who wants to make fun of anyone in the chat. It's like, dude, everyone's taking a beating. So it's hopefully helping people just learn how to navigate some of this stuff and look at how other people are, doing what they need to do.
For sure. I got a lot of trading that I got to do, my man, with the fund. But it's always a pleasure, man. I hope that you're getting value out of this thing.
Absolutely. Let me put TJ's Twitter in the chat. Please make sure to follow him there. TJ, you're growing on Twitter, dude. People are loving your jokes that you make about your wife.
Speaking of Twitter, can we have a 1-minute candid conversation about social media and YouTube?
So
how many people are on the chat? Forget about them for a second. I've been wanting to ask you this because it's really starting to bug me. Bro, I'm starting to get like daily, like 1 or 2 trolls that like starts getting under my skin a little bit. How did you navigate it when you started growing your presence? Dude, one guy asked me for my tax returns yesterday, and I actually engaged him. And I'm like, wait, who the fuck is this guy? First of all, go talk to my wife about it, and she's like, cut that conversation off. Like it's a fucking troll.
Trolls just mean you're growing. As you grow, you have a lot more people that are trying to poke at you. You either just block them, you can't be afraid to use the block button, or you ignore them. At the end of the day, they're engaging with you, so it's helping the algorithm, quite frankly. Yeah, look, it's tough. It gets under my skin sometimes too, but like, you got to move forward. I mean, you're gonna be a big account on Twitter over the next 5-10 years, right? So it is what it is. You got to move on. It sucks, but like, those are people that are really scared of their lives or they're insecure if they want to see your tax returns, right?
Yeah, because my wife was like, hey, we need to get on Twitter, because I was like, I get a lot of valuable. There's a lot of really good insight on Twitter on my feed anyway. And she was like, just don't be mean to people. Don't, like she just gave me this lecture because I tend to like be an asshole when I get angry, right? And I was just like, so I was like trying to like keep my cool with this dude, but he kept like going at me. And I was just like, and he was like, you're being disingenuous and you're misinforming people because only about 25 to 30% of my net worth has come from wheeling. And I'm like, I don't think I've ever said that 100% of my net worth came from
Yeah,
wheeling.
TJ, it's not even worth, dude. It's not even like they're dumb. Like you got to just personally.
I just needed that because you're obviously grown to levels that I can't even imagine. So I feel like you deal with that shit. I've heard of people going at like Meet Kevin and stuff, and I'm like, dude,
think about Elon. The whole world is
it bothers me, and I don't even know why, bro. Like, because it's so inconsequential to my fucking life. But for whatever reasons, it did bug me. Like I'm just fessing up, straight up, it bugged me a little bit.
No, it should bug you. I mean, like it means you care about your audience. You care about being authentic. If someone calls you a scammer, you want to like say that's not true. But Elon and Zucks, I mean, the whole world hates them, right? They have to deal with every media. New York Times, who has a lot more distribution than this troll, is saying Elon's the horrible. So it's like if they can deal with it and smile in the morning and not care, everyone else has to be able to as well.
Word of the day, brother. Appreciate you.
All right. Word of the day is fractitious. Word of the day is fractitious. This is an interesting one.
Like a fraction or what?
Unwilling to comply.
So I was
market is being fractitious.
With the troll on Twitter yesterday.
Yeah, the troll being fractitious. That's all right, TJ. Thank you. We'll see you next week and keep this going.
Man, appreciate you guys. Let's talk on a personal though about Intel.
Yeah. I'll call you after this.
All righty.
All right. Bye-bye. Talk later. All right, guys. Market's still crashing. We'll talk more about it in a second. We got this new video by Figure. I want to take a look at this. So we have the Figure 02, the second version of their robot. Here we go. It's coming out on August 6th. I don't know, guys. They're kind of teasing it. They're not showing the exact full thing, but they're showing the new agility of it. I don't know, man. Are they trying to beat Optimus? Are they trying to get better than Optimus here? Let's watch it one more time. Put the volume down. The big thing about it is how agile is it? How ambidextrous is it? Can it move obviously by itself without being attached to too many things? It does feel like humanoid robotics are getting bigger and bigger, dude. Getting bigger and bigger and bigger. And if they show some videos in the next coming months where this thing's actually working and doing stuff, then it would be pretty fun. The software is powered by OpenAI. We saw it talking a couple months ago via OpenAI's LLM. Looks like a vacuum cleaner. They're not a public company. They're private. They're a startup right now. All right, there you go. There's Figure. All right, so that was pretty cool. Let's look at the market. Yeah, guys, this is a bad day. This is one of the worst days we've had in a long time. S&P is at 529, down 2.46%. Robinhood down 10% on the day. 1806, 10.8%, basically 11%. Palantir 7% down. Snapchat's down 24%. Intel's down 26%. Look, I don't love Intel, which is why I was a bit hesitant on buying a ton of Intel in the public portfolio. Like we bought 2,500 shares. We'll live with that. Like you can never time a bottom there. So it's like, whatever. We bought those 2,500 shares. Buying another 10, 15,000. I don't know. Cause I would rather just like sell covered calls on those 2,500 and slowly make our way back up. But Intel right here at 21, I've got to do a lot more research to see if there's any magic there. I know a lot of people just think they're behind in the landscape, which they are, and obviously spending that dividend is not good. They are cutting 25,000 employees. Maybe that helps, but this one looks like it's going to take a while to recover. So not the most bullish on Intel at these prices. I would rather buy Amazon at these prices at 164. But here's the problem. If shit hits the fan, like really hits the fan, Coinbase now down 5%, Amazon at 165 is not going to be looking fun. Like Amazon at 140 is going to happen. Meta at 484, Meta at 410 or 350 is going to happen. The question is, do we think it really gets that bad? That's the question. Moderna down another 5%. CrowdStrike 213 down 5%. Where's the NASDAQ? It must be down 3%. NASDAQ, yeah, down 2.95%. Do things really get that bad? I think that's the question. Figure debut is on August 6th. So we have 4 days until Figure puts out, I think, more information on that O2. So that's going to be exciting as well. Figure might end up being my best investment out of everything I have because the stock market obviously is not complying. Palantir right here, 24.11. I do like Palantir at 24 going into earnings before. When I mean I like it, I mean I like that it's at $24, not at $27 into earnings. But yeah, Palantir is getting schmacked right now. Has the S&P 500 corrected? No. From peak to trough, it needs to go to 509 to correct. Right now we're at 528, so we still have more pain on this one. Mike says Qs won't come back for another year. I don't know. Let me Qs go back to. So you're saying Qs won't come back to 500 for a year? Basically, I mean, look, dude, if that's the case, then we're in a full-blown recession. Like, there's no mistake about it. Like, this is 2021, NASDAQ 16,000, everything collapses. That's what it is, if that's what's happening. And the thing is, the markets are up so much, I still bet a ton of people. Like, my portfolio is still up at the end of the day. I'm sure a lot of people are still up. Like, is it taking a beating today? Of course. But, like, it's still up. I imagine a lot of people are still up because the S&P still at 528. It was at 4,800 when the year started. The question is, how bad does this shit really get? Really, really get for it to take a nasty, nasty hit. Market is forward looking. It will come back once the path is clear. Well, see, that's the other thing. I'm still not ready to give up a bull market narrative yet because the jobs data was bad, but now the Fed knows what it has to do. It knows what it has to do. The question is it doing it from a pure sign of weakness? And I don't know. And also remember, the Fed doesn't need to cut 25 basis points. Do you guys remember 2019 where the Fed cut a bunch of rates? And they cut it pretty quickly, and the market actually, let me read the stat to you. Nike at 72. Let me read the stat to you guys because I was reading this last night. Okay, so here let me read this to you. Okay, so when the Fed cut rates and what happened to the market? 1998, the Fed cut rates 3 times between September and November to deal with the Russian financial crisis. The S&P rallied 28% from the September lows. Now, granted, the S&P already fell in 1987, right? So just keep that in context. 2001, the Fed cut rates, 11 rate cuts in 2001 after the dot-com crash from 6.5 to 1.75. The S&P fell by 13%. So although the Fed cut rates, it fell because the dot-com crash was really bad. Maybe this is a pseudo dot-com crash. We'll see. 2007 to 2008, the Fed cut rates from 5.5 to 0 by December 2008. The S&P collapsed and then it rallied. The S&P fell 50% from 2007 to 2009, so a year after, but then it rallied 27% in 2009. So we had to have a decline before the increase. Now in 2020, the Fed cut rates to 0%. That was the pandemic, but the S&P went up 16.3%. So the question's going to be, and then 2019, the Fed cut rates 3 times from July to October, and the S&P then rallied 29%. 2019, if I had to guess, feels more similar to now because I'm saying that because 2018 we had a little bit of a correction. You could call it more than a correction. We have not had more than a correction yet. I mean, we're still barely touching on correction. We need to really see 10% on the index. And then the Fed immediately raised rates, and then we took off. That might happen again if the Fed cuts rates by 50 to 75 basis points in September, not just 25 basis points. If they choose to only do 25 basis points, this feels more like 2001, where they're slowly coming down. and the market will melt down slowly as the Fed is doing that. I don't think, as much as Jay Powell says he doesn't care about the market, he wants to ruin the stock market. Why? Because people own assets in the market. If you screw over the market, people feel less wealthy. People literally have less wealth. They stop spending. That creates even a worse recession because people don't have the money to spend if their asset prices deflate. So I still think Jay Powell is going to have a lot of pressure to save this market. And the way he's going to do it is by cutting rates, which is what was his plan initially. He really honestly, Jay Powell wanted to see this market meltdown the way we're seeing it right now, like 8 months ago, but he didn't get it, right? He didn't get it because like AI, earnings, like you can say whatever you wanted, market kept going higher. I don't think it was hype because obviously companies were putting up numbers, but the market kept going up higher even though shit was hitting the fan. So now shit's hitting the fan. This is what he wanted to see months ago. And because it's hitting the fan now, I think now he gets excited to use his magic tool, which is rate cuts, NVIDIA right here at 105, and help save the market. But I think you're going to need more than 25 bips in September to really get shit to have a dent in mortgage rates, automotive loans, etc. We just have to see if Jay Powell does it. What do you think of Walgreens? Good dividends. Don't like Walgreens. Not good management. Stocks down at this point, 15-year lows. Dividend is not worth it. You could get 8% somewhere else versus Walgreens. I mean, you can get a little bit lower than 8% at TFC and regional banks, which are taking a hit as well, but I'd rather be in a much more secure company than Walgreens. KRE is down 5% today. Makes sense. The regionals are taking a hit. Why are the regionals taking a hit? Obviously, a rate cut is good for the regionals, and that helps them go up. However, if we get a rate cut, if the consumer stops spending and stops depositing and banks stop having capital activity, at the end of the day, it's a bank, right? That's why SoFi's down. If the consumer's weakened and banks are going to do bad, even if they have loan losses come off their books. So rate cuts will help them, but still going to get a little tough if the consumer obviously gets hurt. Crossroads had a good tweet today. Let me pull that up. The VIX is up 56% today. Correct. Whoever was trading the VIX, you made a lot of money. If you traded the VIX. VIX is up. Let me pull up Crossroads' tweet. He highlighted 3 quotes from earnings that I thought were important about the consumer. So PayPal said, we are also seeing ongoing normalization of loss rates with our off-balance sheet U.S. consumer revolving portfolio, i.e. loss rates are ticking up, which means consumers weak. Visa, in the U.S., while growth in the high-spend consumer segment remained stable compared to prior quarters, we saw a slight moderation in the low-spend consumer segment, consumer slowing down. Amazon, consumers are being careful with their spend. We're seeing signs of that continuing into Q3. So consumers are spending, or consumers are not spending as much as before. And all 3 of those companies kind of signaling that. Derek says, word of the day should be soft. You guys are soft humans. I'm imagining Derek is buying the dip because Derek's been preparing for this moment. Derek, I just got the email from our buddy. I think you probably got the email right now. He said, please view the new Figure 02 model. Dude, that was a dope video. Let's fucking see what Figure puts out on August 6th. But that was a dope. Figure's going to have to save my whole portfolio, dude. Figure's going to be the only thing that goes up now. The market's going to, whoever knows what the market's going to at this point. But yeah, look, okay, here's the question on this whole point about being soft. Who's buying the dip today? Who's buying the dip? Douglas says, it ain't the market, bro. Jay Powell needs to be afraid of Aunt Pelosi. Look at what she did to Biden, a sitting POTUS. Imagine what she could do to a Fed chair. Yo, Pelosi bought the dip on NVIDIA as well 3 days ago. So it's not like Pelosi's not bleeding either. Okay, we got a bunch of people buying the dip. So a bunch of people not being soft. Emergency cut. I don't want an emergency cut because an emergency cut to me means that we're actually in a recession. I want the Fed, and maybe we are, but I want the Fed to be able to cut appropriately in September and navigate this versus like coming out and saying, oh my God, everything's ending. We have to cut rates, because then the market's not going to care, in my opinion. The market's going to think the Fed lost. And if the Fed lost, then what does it matter if they cut even more, you know? Unless they cut like 3 or 4 basis points, like there's not basis points, like 3 or 4%. Like imagine the Fed funds rate goes from 5.5 to like 2. There's no way that's happening. But if that did happen, markets would rally immediately. It's just a question of, would we have inflation if that happens? Is inflation moderated enough to keep that happening? They're going to take the Tesla Thunder on the 6th before Tesla on the 8th. Yeah, literally Figure's going to have the Tesla Thunder. I mean, look, that video by Figure, it might prove that they're ahead of Optimus. Now, granted, Tesla maybe is working and they're not trying to show Optimus because they want to keep it under wraps, S&P at 529. But it looks like Figure is coming for the throne right now, and we'll see what they do. I'd be so scared if they did that. Yeah, I would be scared too, man. If they come out and say emergency rate cut. I was watching a video yesterday from 2020 where Jerome Powell cut rates in March, and he was nervous in that video. You know, he was like, look, like it's time we cut rates. Things are getting bad. The pandemic might be horrible. We are at pre-pandemic, we are at pandemic level ISM manufacturing levels, and there's no pandemic. So, I mean, you could make an argument that like shit is hitting the fan. I just don't know if unemployment at 4.3 it's definitely enough of a reason for the market to like take a nasty tumble, especially on a Friday, which is what we're seeing. I don't know if it's like legit a real recession. Therefore, Amazon needs to go back to 80. We got to remember as well, 2022, if we just look at Amazon's chart, we kind of had the recession in the stock market, maybe not in Main Street, but in the stock market, Amazon went from 2021 to 2023. Look at this V shape. It went from 180 all the way down to $84. I think it was the low. $83 was the low. We had this from 2021 all the way down to January 2023. So basically a year and a half. And then we recovered. This V shape, do we have another V shape back down to 80? I mean, I don't know. Like, is Amazon that much worse of a business? Is the consumer getting that much worse? I guess we'll find out. But if anything, I feel like we have some pain, some pullback, a correction, which is supposed to happen every year. We're supposed to get 10% pullback at least at one point of the year. And then we bounce back higher because the narrative is still intact. But I think we're going to have to see. Amit, I see some green here. It looks like some stocks are being bought. NVIDIA went from 103 to 106. AMD is moving now. Yeah, I see some green as well. The NASDAQ, it was down 2.9. Now it's down 2.8. Palantir was at 23.85. Now it's at 24.37. Robinhood was at 17.90. Now it's at 18.12. Broadcom is down 2%. Grindr. Oh, this is the one we've been waiting for, right? Grindr finally is below 11. Look at Grindr still holding up. It's still not even at $9 yet. It's fucking holding up somehow. We need Grindr at 9. Then we go long. Then we go long the gaze. But we got to see if we gets there. Well, Derek, remember Optimus is wait, is Tesla doing an Optimus event? No, Tesla's Robotaxi event is on 10/10 now. It's 10/10. Unless Optimus puts out something on the 8th of August, which I don't think they are. Yeah, so the FSD Robotaxi Cybercap thing, that got delayed from 8/8 to 10/10. So now we have to wait until October to see what the hell Tesla does. But we don't have any updates on Optimus yet. And maybe Figure ends up stealing that shine. Gays don't stop seeking hookups in a recession. Agreed. They don't. So like, I mean, I don't understand why you buy Grindr out of all the stocks there. I don't get the thesis on buying dating app stocks. I haven't bought Grindr. It's an argument in my head that I'm still trying to make sense of around an asymmetric opportunity. You know, I found a Substack yesterday of a guy who felt the same thing, like a investing Substack. I can't believe I found an article on Grindr. And he wrote about it. And I was like, damn, like there's at least someone else in the world who's kind of thinking maybe there's a thesis here. I just don't like the valuation. Of course, Amazon's better. Nvidia's better. This is one of the more of those like, hey, maybe this thing like triples in a couple of years because there's something here that the market doesn't see. But no position in it yet. Still waiting for a cheaper price. No personal experience. The app kind of sucks, by the way. That's the thing about the app. I downloaded the app just to look at it. The user experience is not good. Like, it's like you would not think a Silicon Valley tech company built it, but people still use it because there's no other option. That's another part of the thesis. It's like no one goes anywhere other than here when it comes for this specific need, even though the user experience is like less than adequate, right? So that's another reason I kind of like the overall argument. IWM getting schmacked today, down 4%. It's down worse than all the other indices today. Let's go to CNBC, dude. Are they freaking out? What are they right now? I would imagine they have to be freaking out a little bit. Yeah, let's pull up a couple of different things on CPC. Let's just go to the beginning. Let's see what let's say right here. Let's see. Oh boy. Oh boy. Oh boy. Oh boy. Is it 4 p.m. yet? Oh my God. It is time to close the markets. Here we go.
It's weakening on this idea of a weaker economy and potentially more Fed interest rate cuts, especially against the dollar yen, which everybody watches. We're seeing an almost 2% drop there. So that's a massive unwind of this trade that was the most popular trade, sort of underpinning the market rally all year long. It's really going the other way. And as that has reached the lows of the day, we've seen all sectors in the S&P lower. We started off the last hour where we had some of the defensives rallying, like Staples as a safe haven and utilities and real estate. They're all in the red right now. No one is getting hit worse, though, than consumer discretionary. And that's in part that's Amazon. Big Amazon weight there and a big story. Amazon down almost 11%.
Second worst S&P-er. The only one worse is Intel, on pace for its worst intraday performance in its history. And then you got to mention quickly the VIX. A couple of days ago, closing above 19 was seen as a big deal, highs of the year. Now 28, as the cost of hedging is getting awfully expensive.
Yep, goes up. Volatility goes up as the market sells off. You have a few factors going on. So not a great market to have a mixed quarter. That's the story with Amazon. And certainly to have a very poor quarter like Intel, you're getting punished for that. But the backdrop here is the economy is showing greater signs of weakness than the market was expecting and economists were expecting just after the Fed chair left interest rates on hold, even hinting at a September meeting. Well, guess what? Now the market is telling the Fed you need to do more, a double in September. That's the odds for that have gone up past 70% right now on weaker jobs. And I would put in.
Wow. Odds for a double cut are higher than they ever been for September. So markets are ready for more rate cuts, I guess.
Yesterday's weaker manufacturing too.
PMIs, it's been a series of weak prints. For more on the sell-off today, let's bring in Regions Asset Management CAO Alan McKnight, oversees nearly $60 billion in assets under management. Alan, appreciate the help today. Good to see you.
Great to be back. Thanks for having me.
Alan, do you dare buy into this strength?
I think we do as we get past earnings season. I think that right now the market is still trying to deal with the reality that earnings aren't quite as good as people has expected. They're maybe a little light, but the reality is when you look at 75% of the S&P having reported, we're still looking at approximately 11.5% earnings growth this quarter, which is pretty strong.
Yes, although people were beginning to talk about whether that earnings growth would come from Mag 7 or the rest of the market and even small and mid caps. Is that now in doubt?
I think it is, and I think that's what you're seeing with the sell-off in the Russell 2000 today, as people are pulling back from the trade that has worked through the last couple of weeks with a slowing economy, with a bit of a concern around rates. Small cap is definitely getting penalized.
So what are you telling your clients about what to do right now? Is it really worth rethinking everything as the market appears to be doing just in the last 48 hours?
We don't think it's a time to be rethinking or completely reallocating or rebalancing. What we would say is continue to reinvest in those names that are delivering growth. What we saw with Meta, what we've seen thus far with some of the consumer staples names and even some of the other healthcare names. So earnings are still good. They're just not great. And so I think right now the key is to try to stay calm, carry on, and really watch to see how we look at through the course of this year from an economic perspective.
Speaking of economic perspectives, we just had a discussion about yields and the Fed and not moving this week, even after Canada did and the ECB did and the Bank of England did. Do you think this is the market's way of punishing what they might view as a policy mistake?
We think to a certain degree it is. I mean, what we would view from an economic perspective and an employment perspective is it's cooling but not collapsing. We're seeing a slowing in hiring, but we're not actually seeing a full-on layoff situation. And so I think the market is just trying to process through it. We've had a relatively benign market, as you noted earlier, with regard to volatility through the year. So now the market's just playing catch up a little bit in terms of reacting.
Yeah, there was some discussion coming out of the
perceived to be a little bit of a slow move.
There was some discussion coming out of the print this morning that it wasn't so much about job creation weakness as it was a healthy dose of labor supply. Although that might also tell you something about what the consumer's thinking right now.
I think it is. I mean, I think that the reality is the consumer has pulled back a bit from purchasing from a product perspective and now a service perspective. We heard that from the airlines in terms of really a transition. I think the consumer's a bit on a wait and see mode in terms of how do my job prospects look? What are the opportunities going forward? So we do see a little bit of that coming through. But again, we don't see a collapsing. It's really just more of a cooling.
Very important to watch, given what's happened to the unemployment rate now, up 9/10 from the cycle low. Alan, appreciate it. Important market day, as you can tell. Thanks, Alan McKnight.
Oh boy, oh boy, oh boy. Market's starting to bounce a little bit, guys. We're getting a little bit of momentum here. Might just be a little sympathy bounce right now, but recovering just a little bit. Let me pull it up. Here's the thing. Let's paint another picture. Let's paint a little bit more of a bullish picture while keeping into context what's going on. Why are things red? Things are red because unemployment is going up. Unemployment is going up, therefore the consumer is struggling. Consumer struggling means company earnings are being priced in as being worse for the next couple quarters, therefore things are going to be bad. The bullish argument, NVIDIA right here at 107, Palantir 2453, Robinhood at 1820, Tesla 210, SoFi 674, a little bit of a bounce we're seeing. The bullish argument is we needed a pullback because shit got way too intense. S&P was at 565, right? Even Robinhood, although I love Robinhood at 2450, I mean, like Robinhood was going up aggressively and they didn't even put up earnings, right? Same thing with Palantir. I love Palantir. 29, it was almost $30. Like, didn't put up any numbers. It just came there. The bull case is this was a very healthy, needed correction. Markets are still up phenomenally year to date. Palantir is still up 40% year to date. Robinhood's still up, I think, 40 to 45% year to date. Robinhood was $10 at the beginning of the year. Palantir was $16 at the beginning of the year. So although it sucks to see the decline, they're up. They have performed. They have done what they needed to do, and they put up the numbers to get those results. Having a nice 10% pullback in all these stocks, which are basically all down 10% right now, I don't know. I don't know if that's unhealthy. I think that's actually like what the market has wanted to see for a while. And the bears might be taking the victory today in a world in which this is actually something very normal that happens in any bull market. Now, obviously the bear case we've talked about extensively today is a recession starts becoming real. And that's where the bears are 100% correct and shit's about to hit the fan. But the other argument is that if there's not enough indications of a recession, then I don't know if the bears are right. I think this is just a normal correction. It's not the beginning of a recession. If it's a correction, why did unemployment go up surprisingly? Well, here's the thing. Unemployment is not, it's not a surprise that unemployment is going up. It's a surprise to no one. It's a surprise to no one that we're seeing unemployment go up. Unemployment needs to go up to quell inflation. Like this is the nature of like the economy that we live in. You either have high inflation, when inflation gets really high, right? You either continue to have a high inflation. At one point it was 10% in June 2022, or you have low inflation. But to induce lower inflation, you have to get people to stop spending, stop growing, which is why we raised the rates in the first place. I don't think it's a surprise that unemployment is up. The problem is the bad news that unemployment is up, which is bad news because obviously the economy technically slows down, is not good news anymore. Even a couple months ago, that would be a great number because the market that was looking at a 3.5% headline CPI that's like begging for a two handle on it would say, man, we need more unemployment to get inflation to come down. Therefore, stocks would fall because inflation was still tricky. Now stocks are falling, not because inflation is not falling, but because the broader market's weakening. So the navigation of that situation, I still feel is possible, AKA a pseudo soft landing, because you've got the rate cuts and because we haven't had a 10% correction yet. If it is not navigated correctly, all shit hits the fan and we get a recession. We get a 30% pullback in the NASDAQ like we did in 2022. But I'm afraid to say that's going to happen right now when we haven't had a 10% correction and we're supposed to have a 10% correction. And this is what Jay Powell's been waiting for. This is the moment he's wanted. And as a result of that, now that's what we're getting. Let me call Steve. Is he how is he doing? Let me see if he picks up. Let's see. Kris, I just see you in the chat. Kris, are you available? I can get you there as well. Steve.
How are are you?
I'm live right now. Do you have a minute?
For you, sure.
Wait, you just texted me. What did you text me? You can't make the market close, or what did you just text?
No, I can because I took off today.
Oh, you took off today. Okay.
I took off today.
Oh, you took off today. Okay. So everyone, okay, great. So why'd you take off today, Steve?
I felt like taking off today because I have a ton of vacation time and I had no meetings, so I figured today was a good day to take off.
Oh, I thought it was because of other things going on.
Why? Because the market's down and people are overreacting and Steve bought more? Yeah, all good. Keep going down. Keep going down.
Okay, so let me, Steve. So if you're home, I'm about to send Kris the WhatsApp, the StreamYard. Can you get on StreamYard? You don't have to show your face, but can you join through StreamYard?
Of course I can get on StreamYard.
Okay,
sure.
that's all right, folks. So we're not going to do the market close today. We're just going to turn this market open into a podcast with Steve and Kris. So I'm sending you the link right now.
Okay.
Get ready to tell us why you bought Intel, because TJ bought a lot of Intel as well. So
Did he really?
dude, he bought fucking 7,500 shares of Intel.
Great minds think alike. Look at that.
All right, I'm sending you the link. I'll send you the link.
Where are you sending it? Email or?
No, Steve. I'm gonna put it on a pigeon and fly it to your house.
No, I don't know.
Like, yes, I'm sending it to your email.
Twitter
like,
okay.
Yeah. All right. I'll see you
Jesus.
soon. I can only mess with Steve like that. All right, folks, we got a podcast, baby. We're doing a emergency market podcast. Kris, I just sent you the link, and Steve, let me email it to him. And we're gonna keep talking. So yeah, guys, I don't think we'll do market close because honestly, there's not much to analyze other than everything we've looked at. But I'd rather have this be the pseudo market close because we'll get joined with Steve and Kris. And we'll get to break down everything going on right now. Okay, let me get Steve's email. Here we go. All right. Okay, so here we go. Let's get into it. Steve should be joining in a bit. Kris Patel, you are live. What's up?
Hey, what's going on, man? Yeah, I've been tracking the markets just, and I was really looking through the labor force. The unemployment rate. One of the things that I think people are missing. So here's a couple of scenarios. Number one, I think that we are likely to get into a recession, but it's going to be a very, very mild one as of right now. The Fed has a lot of room to cut interest rates, right? So one of the good things that we have going on right now is that, we're not in a situation where we've got, a recession on our hands and interest rates are already at zero. And now the Fed has to just go ape shit and buy like a bunch of treasuries on the open market just to support the economy, like COVID. Right. So the Fed definitely has a lot of tools to deal with this current situation, and I don't think that the Fed is not going to use them in this scenario. The other thing is labor force participation is starting to recover. So one of the things, and let me just
what do you mean by labor force participation?
Okay, so let me share my screen and you'll see. 1 second. Okay, so can you see my screen?
Yeah.
Okay. One of the things that we have to keep in mind is that before COVID, certain subset of the population was actively looking for work and working, right? That peaked in December and January of 2020 to be around 63.3% of the population. So basically 63.3% of the population was working, so the other 40% is usually kids and older people, right?
Right.
COVID happens, everything drops off. And now, you have all this stimulus from COVID. So, people are choosing not to work, or people have a lot more optionality. So they might be taking, less full-time jobs. They might be taking part-time. And one of the things that's been happening is that now more and more people are starting to get back into the labor force. It's still well under the labor force participation that we had prior to COVID, where we still got about 2-3 points left. But the one thing that I think a lot of people are missing here is that, when more people have jobs, that just creates a better economy. It creates growth in the economy. So over the last 3 years, basically we have been coming back, but we're not in an overheated market. So a lot of people think that, hey, we're going to get into a recession and everything. And to some degree, maybe they're right. But I still think there's ample enough room for further growth.
Yeah, but Kris, how does this number reconcile with the unemployment number we got this morning? How do you compare both of those?
Well, number one, the number of jobs that grew just at a slower pace than what people are expecting. So it's not like we were losing jobs, right? If we're losing jobs, that's really bad. Like imagine right now there was a print and it said 50,000 jobs were negative, you
Right,
know?
right, right.
So the thing is expectations might have been a little bit higher than what people are thinking. But
Got it.
so we have to take into consideration that recessions happen when people lose jobs en masse,
Right.
not when the number of jobs that we're expecting all of a sudden don't hit the number that we want. All it means is that the growth rate of jobs is slowing. It doesn't mean that we're going negative on jobs, you know. And unemployment, remember, it's not just, oh, you know what, this many people, you know, are unemployed. It also means that how many people are actively looking for a job also. Post COVID, with all the stimulus, a lot of people dropped off the job market. Now you're starting to see kind of a return of a lot of people with all that COVID stimulus kind of pretty much all done now. Now the economy has to kind of function on its own without all that additional stimulus and everything. And I think there's plenty of room for people to be okay in this market, you know.
So, what is your reaction to the broader stock market sell-off? Steve, by the way, guys, he said his camera's not working, so he'll be on in a second.
I think it's healthy because to some degree we had just so much bullishness, especially in the tech side with AI and everything, that we did need some level of correction. And this is how typically markets correct. There's never a gradual slow decline. It's usually a fear comes in and then, you know, people just sell things off and then you have another leg of going up slowly. So, you know, there's a saying in the market, when things go down, they're like an elevator, and when things go up, they go up like an escalator, right? So look at your chart right now. Look at what happened in October to what do you call it? From last August to October. You had this giant decline, and then all of a sudden you had this nice gradual ride up. That's exactly what's probably going to happen again. So right now we're seeing this quote unquote correction, but I think the markets are a little bit oversold right now, and we'll get a chance to basically bottom feed on a lot of great companies, and chill. You know, one of the things that I love, and this is something I think Joseph Carlson put on Twitter. He said, when fundamentals are improving, but the stock price is going down, that's amazing. That's the best.
Yeah.
So when you see numbers like you see like companies putting out, you know, huge free cash flow numbers, huge operating income numbers, and then the stock price is going down, it's like, wait a second, that just gives that company optionality to do crazy things like a lot more share buybacks, you know, or return capital to shareholders via other means, or invest in certain things at a cheaper rate and end up growing the business. So right now, I think we all kind of just need to just relax. I mean, yeah, the market's down, whatever, it'll recover. You know, being a long-term investor means you got to deal with some of these red days as well. So it's all good.
Okay, let's bring in our good friend onto the show, Steve.
What's up?
Steve, enough with the green screen, man. Just where are you right now?
What do you mean?
This stupid green screen, man. Like all these people, whoever put up the green screen, like pretending like we don't freaking know. You know, like.
So I have stuff on my couch behind me that I don't want shown, and I'm too lazy to move it.
Okay.
Is the Pokemon cards or something?
You got to get a good streaming setup, Steve. Come on, man. You're on these pods more than a lot of people. You know, you got to get some books behind, some fake plants, a couple of lights here and there. You know,
that's too much work.
Yeah.
All right, Steve. What's your reaction to the meltdown we're seeing today?
I hope it goes down more. I'm just going to keep buying. I don't get scared. I don't have paper hands. I think this is a complete overreaction, and especially Amazon. Like, this is crazy what's going on.
The consumer is weakening from a variety of different metrics. Companies, Hershey's statement, Amazon even said the consumer is spending low. Do you think that's a reason enough for a 10% sell-off if the consumer is doing that? Why?
No. So the fact that people that Amazon came in with a mixed bag of earnings is crazy. Like, I would love for people actually to look at what Amazon guided for and then what they actually generated. Because their guidance for Q2 was 144 billion to 149 billion. What did they come in with revenue?
148 billion.
Okay, that's at the top end of their range. The fact that analysts that don't work for the company came up with a number that was at the high that they wanted to see, Amazon made their number. They came in at the high end of the range that they guided for. They shouldn't be punished for that. Free cash flow is high, profitability is high, and even if the consumer is weakening, I don't think that necessarily is going to translate to Amazon because more people will probably buy items on Amazon rather than going to the store.
Yeah, but Amazon stock would still take a hit, right? Even if
Short term, maybe, but I think that this is the cheapest Amazon has been in pretty much its history on a forward EPS basis. Like, this doesn't worry me at all. I look at the actual raw numbers that they're producing, and do I think that they're going to be more profitable in 2 years from now? Yes. So if I liked it at 180 and I was buying at 180, why am I not going to buy at 161? And oh, it's now 167, 168. Looks like it was a good move on my part.
Kris, your thoughts on Amazon and big tech writ large and these earnings? Did we survive big tech earnings now that they're basically done?
Yeah, I think so. I think overall the market right now is just a little bit, there's just fear running through the market, in which case people are selling things off a little bit too soon. I actually called Matt this morning around 10 and I was like, hey, Matt, I think we're done with the TMF trade. And we basically sold off all of our TMF position and we bought TQQQ to ride the thing higher. And that's actually working out so far. So, so just do the 1 day chart and you'll see how big of a reversal TQQ had today.
Yeah, there you go. 57. Well, yeah, because it came down from, I see what you're saying.
Yeah. So this is what happens, man. A lot of times people are, people get a little too complacent. The VIX jumped crazy high today. I don't know if you've been checking the VIX.
57%.
Yeah, we're all in super fear mode right now. And usually super fear mode is when people over rationally sell great companies that are doing well. I think for me, I look at the cruise lines as an indicator of the general health of like the people that are at the top and how are they doing, which is pretty good. So I don't think that there is as deep of a recession where it's like a general people recession. I think at the bottom level of the population curve, like at the lower income spectrum, they are definitely struggling. But their struggles are gonna slowly go away as the Fed starts to lower interest rates, because one, they're more dependent on credit, in my opinion. And when you cut interest rates, you're actually loosening credit. So when you loosen credit, you're going to have, the ability to spend more and do more things. And I think that will definitely help out. I think also shelter is coming down nicely in a lot of areas. And hopefully that trend continues, because the one area that I think a lot of low income people and even middle income people are getting squeezed by is just higher shelter costs. So as shelter costs moderate, but wage growth, ticks up slightly, it just brings a lot more balance into the economy. So I think this is a great opportunity that, we get a little bit of a pullback, but then there's also like a chance that we see, some recovery also,
And keep in mind, I don't necessarily think individuals are necessarily selling companies like Amazon. This is probably a lot of high frequency trading. This is probably a lot of stop losses. This is a lot of algorithmic in the market, and big swings become bigger because of different algorithms. Like it is what it is.
Steve, it's this motherfucking index market that I fucking absolutely hate. And I hate fucking Warren Buffett. I'm sorry to curse. I don't give a shit. I'm just going to curse. I hate that Warren Buffett, that son of a fucking bitch, comes out and says, just buy the index. Just buy the index. Indexes are the best. Don't even like price discovery doesn't matter. Just buy the index. And now all of a sudden, every fucking idiot on the street is buying the fucking index. Right?
Yeah,
what's wrong with the index? What's wrong with the index?
To be fair, Kris, most people don't want to get as in the weeds as you or me or Amit, and the index is great for most people.
No, it is good for most people, but the problem is now everyone, including institutions, are doing the same thing and not even relying on fucking real price discovery anymore. So now all of a sudden, if the index is what happens, you have amplification of the stock going in a certain direction. So now the stocks, especially among big tech, they're trading more on momentum than actual fundamental reality. So that's like true. if you think about it, did Amazon deserve to be down 10% today?
No.
Fuck no. Did
No.
these other companies deserve to be sold off this much? And this goes into my hypothesis on why Meta took a huge 70% drawdown in 2021. If you guys remember that should not be possible. But because of index investing, what ends up happening is you've got people and companies being bought by the index because it's like, oh, look, the stock price went up a little bit. Now the indexes all have to buy the stock. And because that index bought the stock, another index has to buy the stock. And if another index buys the stock, another one has to buy the index stock just to keep tracking this fucking thing. And now all of a sudden the market cap jumps like crazy. And then you've got overvaluation. And then the same thing happens on the opposite end when the stock goes down slightly. Now this index, to rebalance itself based on market cap, has to sell off that company, even though the fundamentals are right. And now you've got a magnified move down. So I think index investing is a good idea, but if everyone does it, it's the most retarded thing on the planet.
Steve, okay, so I actually agree with Kris on a lot of this. The big thing here is like, why is Apple up right now? Kris, I think you would agree. Passive index flows are coming into Apple, and that's why it's up right now, even though the entire market's kind of down. I mean, that's not the only reason it's up, but that's why it's elevated. Like, Apple probably does not deserve to be at a 36 PE with 1% growth, but the index, multiple indexes, keep buying it, right?
Yeah.
And so if they keep buying it, that'll keep it elevated. What do you think about NVIDIA right now, Steve? Start with you.
Bought more this morning.
Kris, your thoughts on NVIDIA?
No, I mean, NVIDIA is NVIDIA, man. They caught the tail. They caught a huge tailwind of AI. And the thing is, as AI growth spend moderates, I think that there's going to be a bigger retracement in NVIDIA. So once again, I think this is how basically markets become irrational. And I think to some degree, NVIDIA is irrational. The reason why I think it's irrational is because, one, they did really well in earnings. So now all of a sudden, all these people are buying. The index started buying. And then all these people FOMOing in, they started buying. And all of a sudden now you've got NVIDIA growing like crazy, going higher and higher. The problem is, this is a cyclical business. If there is any indication that a slowdown is coming, you're going to start to see NVIDIA come down. The problem is when NVIDIA comes down and its market cap shrinks, all of a sudden now these stupid indexes are going to sell this thing, and it's going to be a magnified sell going down.
Yeah.
You know? So this is one of the reasons why if you look at Jensen's selling, right? Look at Jensen's like insider sales. Jensen hasn't been.
It is scheduled though. It is scheduled.
Doesn't matter. All these people, they can change their schedule at any time, by the way. That's one of the dirtiest secrets that is in Wall Street that no one acknowledges, that all these like compensation plans that have like pre-planned sales, you can change your pre-planned sales as many times as you want. You could change it last Tuesday and say, you know what? It's a pre-planned sale. No, if it is a real pre-planned sale that you haven't changed for like the last, like 5 years, that's one thing. But these people can change that shit at any time,
I think that NVIDIA is going to continue to grow for the next 2 to 3 years, and then it's going to significantly decline. I could be wrong on that, but when you look at what's actually being said on these earnings calls, the biggest companies in the world are not slowing down on their CapEx spend. They're not slowing down on their
what if they do if we get into a recession? That's the
They're
question.
not going to stop. The recession doesn't matter for Meta or Google.
No. But if we get into a recession and Meta's ad business takes a hit, they need to be cost efficient. Why would they be buying more GPUs that they technically don't?
So if we go into a recession, that's actually going to be probably positive for Meta because people will only advertise with Meta. And
I get that argument, but overall advertising will come down. Like the broader pie. So Meta's still going to take a hit. Make no mistake about it. Isn't the first place they look to cut expenses besides their employees this CapEx shit that they're not really using yet because it's not monetizable? Their word.
This is going to be what drives the next iteration of growth. Whoever slows down, if everybody else doesn't, they're now at a disadvantage. These companies aren't slowing down, especially when you look at their balance sheets and their free cash flow. These aren't companies that have to worry about interest rates or have to worry about a recession.
Okay, let's say they don't slow down. What if they negotiate with NVIDIA to give them a better deal because they're not paying $40,000 for a chip anymore? That still hurts Nvidia, right? I'm just putting the argument out there, right? Like
It would hurt Nvidia's margins, but at the moment, it doesn't look like anybody is slowing down anytime soon on a build out. And when Zuckerberg comes out and says that Llama 4 is going to take 10x the amount of chips to train, and then you have Microsoft coming out and Alphabet coming out saying, we're going balls to the wall with spending, and it's better to spend than not to spend. Everybody else who wants to be in the conversation is going to have to do the same thing. And is not slowing down at the moment. And you're talking about a company that has over 50% profit margins. Even if their profit margins go to 45%, doesn't matter if these companies are still spending like this.
But Steve, you have to remember one thing. At the end of the day, these companies are still publicly listed with shareholders. The last thing they want to do is have another metaverse-like flop where they're investing all this capital and there's no tangible return. And then eventually the shareholders take a hit and they say, no, you need to stop doing this crap, right? Board of directors get together and say, look, we get that you think AI is the future, but moderate your spending. So it's not always like, oh, the company wants to keep investing. Yeah, the company may want to keep investing in a certain sector because they're very bullish about it. But at the same time, they are answerable to a board of directors who will say, you know what, maybe we need to at least moderate some of our spending. I mean, the other thing to remember also is that, each one of these guys is trying to get off of the NVIDIA tax. No one wants to pay the NVIDIA tax forever. And one last thing is, I get when you invent a car and it's a really good car and it like gets you from point A to point B in X amount of time. And then the next generation of car gets you there faster. But eventually you're going to hit speed limits. That's the problem with AI, in my opinion, where I think the theoretical improvement in AI is going to be a lot more limited. And the number of use cases hasn't necessarily panned out to the degree where it justifies all this additional spending other than, hey, my competition is spending money, so let me spend more money. Like, I don't think that these companies can survive with that kind of business model, or at least they can survive, but they're just not going to be
spending
great stewards of capital. So I think overall NVIDIA is going to be fine. But I do think that we are due for a retracement in NVIDIA, probably at a drop down of about 50%. But that's just my opinion on it.
And Kris, I agree with you. At some point, NVIDIA is going to, and when that happens, it's not going to be a small retracement. I just don't think we're anywhere near Amazon, Microsoft, or Alphabet utilizing their own silicon. I think that we're at least a year or two away from that. And they are trying, and they're probably getting more efficient. But that's not stopping them ordering from NVIDIA now. That's a down the road couple of year use case.
But Steve, that's the whole point. The market is forward looking, right? So anytime, even a slight bit of slowness means that the market is going to overthink it and say, oh, wait, what a second. Maybe next quarter, they're going to have even less. I mean, look at what happened with Celsius. Okay. Celsius is a good example of how things can flip on a dime. Basically, they were growing their business like crazy. All these people were buying Celsius, they were doing good. One or two what is that thing called? News reports came out from Beverage Insights that, their growth rate is moderating from 100% to less than 30. And now all of a sudden the stock gets cut in half, So this is where I say, yes, be an NVIDIA all you want to be. But at the first sign of any sort of slowdown, you best either have some puts ready to go, or you better sell out of your position. Otherwise, you're going to get caught up in a downward move. And remember, I have to keep saying this because it's only going to make sense. Semiconductors are a cyclical business. I know some people are going to say, well, what about the software revenue? NVIDIA is making software revenue. Yeah, what percentage of their revenue is software? What percent of their business is software right now?
Software revenue is not enough to make it down with NVIDIA.
Exactly.
And you're right. It is going to be a cyclical business, and it'll probably mimic DRAM the way we got boom bust cycles, but not for at least another year or two from a profitability standpoint.
Yeah, but see, that's the thing. Why even try to risk it? Why try to risk playing musical chairs when the collapse comes?
Because NVIDIA right now, and it's also herd mentality and psychologically. Because
can you zoom in on this thing?
Can
you zoom in? Is this an NVIDIA argument you're trying to make on your screen?
Oh, I mean, you look at NVIDIA, it's trading. This thing has grown into its multiple. It's trading cheaper than Apple. I mean, it's...
But Steve, where are you getting these forward PE numbers from?
These are
You're
what the
getting-
street is calling for consensus estimates.
Right, but that's what I'm saying. When has the street ever called shit right? Otherwise, if the street always got everything right, we would never even have any sort of price discovery ever. The
But
street
keep in mind,
always
NVIDIA has continuously beat all the forecasts. And the end of August on the 28th is going to be a big deal to see if they're keeping up with these growth rates and what the forward guidance is. But
Right,
if
but that's
they
what I'm
do,
but that's
this
what I'm
looks extremely cheap for growing EPS 60% over the next 2 years.
But Steve,
If they
that's the
don't, we're
point.
going to shit.
Oh,
But
if they don't, it's 65.
But Steve, that's the point that I'm trying to make. The expectations that they're going to grow are so high, which is why their PE looks so attractive. I mean, that is the definition of a value trap right there. Saying, oh, look, next year they're going to perform really well, so their PE is going to be really low relative today. They don't perform, and now all of a sudden, all these idiots have to change their price targets to a much lower number. I mean, we just literally said about 5 minutes ago, right, with Amazon. All these idiots on the street thought Amazon was going to grow this much. The company said, no, we're going to grow this much. And because they missed some no-name analyst, their target, all of a sudden, Amazon is getting a 10% haircut today. Right?
That is fair. That did play out exactly like Kris said.
Yeah, I
today.
mean, look, Amazon guided for between 144 and 149, and they came in at 148 and a half, wherever they came in at, and missed some ridiculous number that was on the high end and took a 11% hair point. Crazy.
Right, but that's what I'm trying to say. Like, why are you trusting the analysts for NVIDIA, but not trusting them for Amazon?
The reason I'm trusting the numbers somewhat is because of what NVIDIA. But mate, you're yawning. You never yawn.
You're right. I always
He's
have
getting
energy.
old, bro. That's what's happening. He's getting old.
Dude, Kris and I got this. Go to Starbucks, help out my Starbucks. Go get a coffee.
I can't afford Starbucks today, dude. I'm down like 50 grand. You think I can afford Starbucks? What are you talking
Yo,
but-
I pray for your hood calls every day, Amit. I'm
Oh,
like,
dude, the crazy
God.
thing is, dude, they're still profitable.
Yeah?
Because I got them that low. Well, the 2026 ones are going to be fine. 2025 ones are still up like 30-40% because
I pray for your position every day. I'm like, God, if you do one thing for Amit, make sure that his 2025 calls go in the money. Like,
we're going all the way, bro. We're fucking going all the way. We're doing
Don't
it.
do that to Amit. Don't take away his gains, right?
Well, look, but here's the thing. Speaking of hood, right? Kris, by the way, you said you wanted to get in hood. This is your dip, bro. I mean,
I'm tapped, bro. My cruise lines are killing me right now, so I'm pretty tapped.
I see your Discord. You're like, I'm ready to get in hood. I just need below 20. Here you go. You got it, So this is one of the hard things, right? Like, do you buy the dip on a date like today? So let's talk about the cruise line. So is this something that's recession proof, or what do you think happens to these guys? And what are you doing with your position? Because I know you have a lot of this. How are you navigating this?
I'm just holding it. I think it'll come back to normal again. I mean, the company's earnings all beat. Norwegian did a 3 quarters in a row. They beat and raised guidance. Okay. So a lot of people are selling off the cruise lines right now because they're like, oh, well, look, if we're getting a recession, that means that future demand is going to be lower. And if future demand is lower, that means that profitability is not going to be there. This is the part about price discovery that I think people mess up on, which is they don't do the fundamental analysis, or at least at the company level, to understand what this means for Carnival and Norwegian. Not so much for Royal Caribbean, because Royal Caribbean's on a different boat, but Carnival and Norwegian both took on a lot of debt to survive COVID. Now, a lot of debt, if you do an analysis on their debt, especially Carnival, their cost of capital right now is about 8% per year. Okay. And they've got about $28 billion in debt. Okay. I mean, they're the largest operator of cruise ships on the planet. So they've got a tremendous amount of debt. But what's good is that on an EBITDA level, their EBITDA has recovered significantly. But a lot of their earnings now is going towards paying interest on their debt. So if you go back to pre-COVID, they were paying about $200 million a year in interest charges. Right now, they're paying $2 billion a year in interest charges. So yeah, that's going to impact them significantly. The good thing is, if recession does come, quote unquote, what you're going to see is the Fed cutting interest rates like crazy. And if the Fed starts to cut interest rates, these guys can refinance a lot of that higher yielding debt that they took on during COVID for much, much lower prices.
Okay, so I have a question here, and Steve, I'll get you in this as well. I'm going to start with Kris, then Steve. So if the Fed cuts rates, right?
Mhm.
And we're in this little like correction pullback territory right now, whether it's Robinhood, Carnival Cruise, Nvidia, Palantir. Is the Fed going to effectively be able to cut rates for this market to go back to where it was 3 weeks ago? Or is this rate cutting going to be bearish because the market's going to be like, well, it's a recession and these rate cuts are reactionary? And then cruise lines, like people can't afford a cruise at the end of the day if we're in a recession. Like, how do you navigate all of this based on this rate cut that we now think is inevitable?
So a couple of things. Number one, you have to look at the core demographics that go on cruises. They're usually people with a lot of money and a lot of time.
Yeah, but Kris, the
Okay?
perception is still going to be like,
Right. No, the perception,
discretionary spending, right?
right.
From the market.
Perception is always going to be one of the aspects that you have to take into consideration when you're trying to determine what value you want to assign a specific sector. My thing right now is that with the Fed rate cuts, it'll be easier for these guys to service their debt far more than a pullback in demand for cruises. Which, by
Correct.
the way, is really high.
But what does that mean for the stock? That's my question. You're right about this fundamental debt refinancing, but like, do you think the stock will have enough juice to reflect those fundamentals? If we're
Yeah. Over the next 2 years, I think they have a good opportunity to delever and also grow their top line, and at the same time, it'll just be like they'll grow their earnings. One of the things that I think we'll see over the next couple of years, and this is something that I think Tom Lee kind of keeps bringing up, is that you're going to see this rally kind of broaden out. A lot of what we've seen in terms of growth over the last couple of years has been led by the mega cap 8, right? So a lot of what you're seeing at the top in the S&P 500 is mega cap 8 getting tons of attention and getting tons of people buying into them, and the rest of the stock market has kind of just been hanging out and growing, but not growing at the same pace. So I think now is the opportunity to actually look for a lot of value plays that have a tremendous amount of debt on their balance sheet that is going to be able to be unlocked and unlevered over the next couple of years, and those sectors will end up actually helping readjust the market higher. So
okay, Steve, we get a rate cut. How do you think the market reacts? Do you think the market's like, all right, Robinhood back to 23, Nvidia back to 140, or do you think the market's like, we want to see if shit's really going to hit the fan now that the Fed cut? What do you think happens?
Before I answer that, Kris, guess what's in the green today?
What's in the green?
Altria, baby.
I can't deal with the smoking thing, dude. Can't do it.
It is. It's up. Verizon also, Kris, is in the green.
Yeah.
Value's in the green.
Well, the thing is with Verizon, look, you right now you're going to get utilities doing really well because regardless whether you have a recession or not, people are going to need electricity. So utilities are going to do well. You're also going to see companies like American Tower, Crown Castle, and Verizon and AT&T. They're going to do well. Why? Because all of them are in the telecommunication space. Regardless whether you get a recession or not, you're not going to cancel your cell phone plan. So those companies will be fine. So I think a lot of times people are just moving their money into the areas that have been traditionally safe during recessions. And once again, I think this is just people buying up indexes without realizing, or selling off companies and sectors because they're like, oh, their rotation is naturally going to be in this sector, so I'm going to park my money here, without realizing that, hey, there's actually value opportunities among certain names in the unloved sectors.
So, Amit, before I answer your question about Hood and whatnot, I'm going to amplify what I've been saying for 3 to 6 months.
Okay.
You are going to see when the Fed cuts rates, money come off the side and go into income producing assets because investors are not going to be able to recreate 5% yields that they become accustomed to on their cash. Some people don't need to generate a 10 to 15% return every year.
Right.
Some people are using it for other reasons, and you're going to see a segment of quality income producing stocks catch a bid. And when you go a level further, you're going to see derivatives of the AI catch a bid, such as, I would say, Enbridge, NextEra Energy, utilities, and pipelines. Because with the spend increasing, you're going to need more natural gas and more electricity. That's just a fact. And these are quality companies. And when you look at the charts look pretty good And when you look at the spends that all these companies are doing, the amount of energy that's going to be required for the expansion in data centers, these are probably going to be with the amount of capital. And I still think a lot of these investments are undervalued because the news cycle caters to big tech. Now, when a rate cut occurs, I've been telling you for a while, my biggest concern was we hit 4.1% on unemployment. Today,
Correct.
we hit 4.3%.
Correct.
So we are 20 bips away from the indicator that has not failed since 1948. However, unemployment increases by 1%. We are either in a recession or recession immediately follows. The Fed,
So we have 0.4% till we get to that 1%.
no, 0.2%.
Why?
Because we were at 3.5% last July.
Oh, 3.5. I thought we were at 3.4. Okay.
No, we're at 3.5. We're at 4.3 now. The Fed's been late. The Fed should have cut it, and shouldn't have been March, but it should have been May. The bottom line is that they have always been late, and they wanted to, I think, stay restrictive as a just in case because things looked like they were doing well, but they're playing chicken right now and they don't have to. And when they keep rates restrictive, like Kris said, you have a lot of companies that are going to have to refi their debt in 2025, some of it then to 2024, rates to come down so the profit models still stay intact. And
so when they cut rates, you think the economy, you think the market's going to like it a lot?
I don't know if it's going to save the market immediately. I think it's going to create a better business environment because now companies may actually start expanding again instead of taking a restrictive stance. I mean, all we're seeing is restrictive stances across the board. And now with Intel cutting 15%, other companies, I mean, there's more of a reason to reduce rates now than there was a week ago. And I wish the Fed meeting was next week.
Kris, what do you think about an emergency August cut?
I think it's a possibility.
They're not going to admit they were wrong. Come on.
They're not going to admit they were wrong, but they said that they were going to be data dependent. Well, here you go. The data is here.
But
so
isn't the data's not that bad? It's bad for us because we're in the stock market, but the Fed wanted all of this. Like,
the problem is
No,
unemployment.
they wanted this last year or 6 months ago. They didn't want it now.
But regardless, they got it, right? So
Yeah.
Aren't they happy that unemployment's up 1%?
It's up 2%. Actually, it was up 2 points today. It wasn't just up.
No, 0.2. We're talking about from 3.5 last year.
Yeah. No, I mean, we're still in a good labor market. It's just that the one thing you don't want to do is let labor force participate. I mean, you don't want unemployment to start like what's the word? Like rolling down a hill. Because what happens is it starts to really negatively impact the economy. And then now you have to come in much, much harder just to get things to recover. So when you have, like, let's say a 4-person economy, like let's say Amit, you have a job, I have a job, Steve has a job, and another person has a job. All of us buy goods and services from each other. But the thing is, if one of us gets laid off, now there's a gap in between that 4-person economy. If 2 people get laid off, there's even a bigger gap. These gaps end up adding up to what could be a giant recession. Usually the Federal Reserve has to usually come in and do spending, or at least create an economic situation where borrowing costs are easier so that, someone like Steve can pick up the slack, in which case the next round, another job can be created instead. So right now the Fed still has the opportunity to kind of like save the general economy from going into like a deep recession. I think that they have been waiting for a moment like this, and I think the market is giving them the signal. I think that especially the bond market, if you really want to find out where all the smart money hangs out, it's in the bond market. And the bond market is clearly signaling rate cuts, and they should have took that and started with the rate cuts this month. If they had started this month, I think today's numbers wouldn't have nearly impacted the what is that thing called, the stock market, as much, because it would have been like, okay, the Fed is on the ball. Like, they understand that the economy is going into a bit of a slowdown and that they're ahead of it. So
okay, so then the question is, do you guys think 50 basis points is or 75 is on the table, or do we get stuck with
No.
25 and the Fed still?
50 is highly unlikely in my opinion, but it's still possible. And
Wait,
especially
why is it unlikely? Why?
well, that would set the wrong tone because they would say that, oh, you know what, shit is really bad.
But then
You
why
know?
why do you think an August cut would be good? Wouldn't that set the wrong tone too?
No, because this way, at least with the August cut, they could justify it by saying that, you know what, the data is actually showing that there is market weakness, not weakness, that there is a slowdown in inflation, and we wanna, be data dependent. The thing that you want right now is credibility. If you've been saying for the last year you're gonna be data dependent, then be data dependent. You know,
Right.
the numbers the numbers have gone in your favor. So now you can use that as the excuse to start the cutting process. And the thing is, you don't want to do too many large cuts at the same time because that really messes up the confidence of the market. And the other thing is you only have really 3 rate cut possibilities left for the rest of the year. So you have to take that into consideration. If they come in and do like a 75 basis point cut, we got a problem on our hands. You know, you don't want to spook the market. So I think an August rate cut wouldn't be bad in my opinion.
I don't think it would be bad. I just don't think they're going to do it. And look, I've always said I don't subscribe to the sentiment that they were putting out. They have a dual mandate, and they really have taken the other side of this mandate more seriously. Because at the end of the day, if people are going to spend 103 instead of 104, that's a better alternative than massive layoffs. So I would rather see unemployment lower and going down and have to spend an extra $1 or $2 on my purchases than seeing other Americans get laid off.
Yeah.
They need the cost of capital to come down. They need business expansion, and employment should be a bigger mandate than price stability, because you'll get price stability when you let the free markets work themselves out, because competition breeds lower prices. It always has.
It was actually very toxic for the better part of a year, right? Where unemployment went up and we were happy as investors, like people losing their jobs, but we're happy because inflation's coming down.
I don't think anybody should be happy with anybody losing jobs. That's
no, not that. It's just like you would not want unemployment not going down if you're an investor, because then inflation would be going up and then you're screwed. So you had to call it happy, call it whatever you wanted to see unemployment go up so that growth would slow, inflation would come down, we would get closer to our rate cut. Well, that happened and we had a big rally, but now it is completely going the opposite, right? Bad news is just becoming bad news. It's not becoming good news anymore.
Yeah, that whole notion that bad news is good news was ridiculous.
No, it wasn't ridiculous. It was real.
Ridiculous.
How was that ridiculous? It was real. You wanted unemployment to go lower to 2% when we were at 3.5? Inflation would have shot up like crazy.
Not if you actually have a business environment that's pro-business and allows competition, because then you'll get price stability. I would rather more people be working and more people spending money and the economy be better for small businesses.
Kris, your thoughts on this bad news, good news thing?
Yeah, I wasn't a big fan of it, but I understood it. I mean, that's what you have to do in the market. Like, you have to take the morality sometimes, pull some of it out and say, look, right now we have an overheated labor market where everyone can get a job and demand really high wages just to work, a simple position. So you feel for them because you're like, yeah, I want everyone to have a great job, but in reality, not everyone can have the greatest job on the planet that pays, a great wage. Some people end up having to work in a menial job with a menial wage so that the rest of us can afford to have a higher standard of living. I mean, that's just how things are. I mean, you know what? I just realized I sound like an asshole. It's really like,
but that's what I'm saying. Like, that's the whole point of this whole thing has been so toxic. You have to sound like an asshole if you're an investor, right?
Well, I mean, as a person, it's like, yeah, I want my cheap latte. Yeah. I want my cheap food, like I want someone to have a minimum wage job, below survivability so that I can have a discount at the, at Burger
that's what
King.
Robots are supposed to fix, hopefully.
I don't know, man. I think the economy works the way it works. The free market tends to do what it's supposed to do. Sometimes the Fed comes in and plays God, and that kind of like disrupts things. But then, I don't know, man. This is one of those times where I do feel like now Bizarro World has kind of just flipped over the last 48 hours. And now good news is actually good news and bad news is actually bad news again.
Oh, and even if the Fed cut on Wednesday, it wouldn't have mattered because it wouldn't have changed the unemployment print. Like they really needed to cut in the freaking spring.
Well, the thing is, like, one of the things, and this is something I mentioned, Steve, before you got here. Have you been checking labor force participation?
I have.
You know, it still hasn't gone back to. Can you bring up my screen? It still hasn't gone back up to number one. It's not back to historical levels like we had like during the 1990s. But remember, that was also when we had a younger working population as well. Right now, with so many baby boomers, I don't think that we'll ever get back to that 67, almost 68% labor force. Right now, we're at 62. We're probably still maybe like about 550 basis points away from normalization. Prior
Does that
to
mean 62% of people have a job? Is that what that means?
That means 62% of the people in the country are actively working right now.
Okay.
Or they're
we do have more retirees than ever now, though.
Yeah. So we have a lot of retirees right now, and the thing is, people are not having as many kids either. So that's a pretty good setup for a demographic issue. And the thing is, like right now, the only thing that's keeping our population above replacement is just this immigration, and even immigration to a certain degree is negatively impacting us, because remember when there is a level of immigration that does help, but then there's also a level of immigration that all it really does is add to the national debt, because what you're essentially doing is you're subsidizing a lot of people coming in, and if they're not working, you got a problem, So, and also remember, they're competing for lower wage jobs. They're not competing against the higher wage jobs. So yes, immigration is good, but usually high skilled labor is the one that you want a lot more of, because the total output that you're going to get from someone who has like a PhD already in another country, they come here and they invent, the next Google, you're going to get tremendous more productivity out of that person versus someone that comes in and, may end up having to subsist on government services for a period of time before they can really like get acclimated to the country and then be like a productive member to the tax base.
Well, and going back into stocks for a second, another reason why diversification is important is because of exactly what happened today. I mean, I know Kris has been talking about going more into REITs and stuff. Look at Realty Income today. I've been screaming Realty Income for a while. It's up almost 2% today.
Well, that's just because the market's going to value. That's all.
12.5% over the past month. I mean, big tech is not the end all be all. And while there's a tremendous amount of earnings growth there, and I do think that there are good value plays there over time, it's important to look at other areas of the market too.
Okay.
That
Last
makes
question for
days
you.
like today easy to stomach.
Kris, go ahead. Okay, never mind. You're muted, Kris, if you don't know.
Yeah, no, I'm in agreement with Steve. I think there's so many opportunities if you're willing to look for them, especially in fixed hard assets that tend to have a lot of debt on the balance sheet. And because they have a lot of debt on the balance sheet, they got sold off. You look at a lot of these people, remember, like literally, maybe I think 9 months ago, everyone was screaming at the top of their lungs, all the regional banks are going to go out of business because the commercial markets, they're not going to be able to refinance all their debt. Now, guess what? With rate cuts incoming, all of these commercial REITs, they're getting benefits from two things. People are going back to the office, working back in the office again. Leasing rates are going back up. And at the same time, you've got rate cuts incoming, means that one, leasing rates are getting higher, vacancy rates are going down. People, the landlords, aka the REITs, are going to be able to get higher values from customers looking for office space. And at the same time, they're going to get that overhang of the ability to refinance well, not the ability, but basically the ability to refinance at a favorable rate is going to go up. That's why you're seeing a lot of great companies like SL Green. They've been outperforming even the tech sector, because a lot of people, they just wrote these things off. They wrote these businesses off thinking, oh, who's going to go back to the office again? And me and Steve, we're in New York City. We see all these buildings getting packed up again. You know,
And
you're
the
seeing
big thing that people seem to forget is just because you don't see people back at the office doesn't mean that the space isn't leased and the checks aren't coming in.
Yep.
So let me ask 2 more questions. This one question is, rate cuts in general aren't bullish. It means things are weakening, but we still feel there is an opportunity for the market to benefit from the rate cut, even if the broader economy doesn't benefit. Is that correct?
Well, it depends on your time frame, right? How long do you think most recessions last? The longest recession that we ever had was the Great Financial Crisis, and all the fallout from that, which was, I think, like what, a year and some change.
Yeah.
All the other recessions are usually what, 6 to maybe like 10 months.
Yeah.
Barely any that last beyond 1 year. So if you think about it, if we enter a recession in the latter half of the, let's say, the officially declared in the third quarter or fourth quarter of 2024, by 2026, we're back in business again, you know.
But my point is, like like Nvidia right now, let's say Nvidia is $100. The Fed cuts rates. Do you think there's a bounce where Nvidia goes to like 130 again right before it really takes a tumble when we get to recession, because the market is like happy we got a rate cut? Or is the rate cut just so bearish for the market and for the actual economy that everything hits the fan?
I'll let Steve answer that one.
I don't think a rate cut matters for NVIDIA at all. Like I said before, the companies that are spending with NVIDIA are not living in the rate cut. A rate cut is more important for the broad market, for companies that are looking to refinance their debt, that have a lot of near-term maturities, and also companies that are looking to expand, because when they tap the debt markets or issue new bonds, they come with a lower coupon, lower carrying costs. And then that money funnels up to all the bigger companies. So a rate cut is bullish for the market, but not for those reasons.
Okay, final question. Thank you everybody for being here and sticking with us today. Hopefully gave you a little bit of value as we were navigating all this. Tom Lee just blocked Meet Kevin on Twitter. So my question here is, what do we think of Mr. Tom Lee if IWM turns out to be one of the worst calls he's made?
I don't think he made a worse call. Okay, let's take a step back. Okay, I think structurally and technically he made the right call in saying that there needs to be some broadening out of this rally, where people are actually moving some money from the big tech side over to some of the smaller components among the market. So I think Tom Lee is absolutely right. It's been maybe like 3 days since he's really come out and said like, oh, IWM is where the opportunities are. And I firmly believe that he's absolutely right. If you think about it, the rate cuts benefit the small caps and the mid caps more than the large caps. The large caps, they don't have debt. They don't have a ton of leverage that they're playing with, nor do their customers operate under the guise of a lot of leverage. So I don't think it really benefits them. But on the other hand, IWM, most of these small caps, they have a lot of debt on their balance sheets, you know? So if you think about it, if you are able to lower the interest rates for them, that means that now all of a sudden that debt to equity ends up getting flipped completely, and now the equity is worth more.
But if we're in a recession, those small caps still get destroyed.
Well, it depends on which small caps you're talking about. So
well, just the index itself. Like at the end of the day, he said the index would go to 300.
Well, here's the thing. When it comes to the small caps, you have to be very selective, because when you think about it, their ability to grow their revenue and grow their market cap is a lot more likely than it is on the mega cap and the large cap side, because it's just when you're a small, nimble company, you can move around in the markets much easier. If you're looking at it on an aggregated basis, I totally agree. I think there are definitely a lot of shitty companies within the Russell, but there are also a lot of great companies in the Russell that are trading at single-digit PEs with forward PEs that are even lower than that. So I think this is where, especially if you're going to delve into the Russell, I wouldn't necessarily just say, oh, buy the IWM. I'd say, do your homework, do your due diligence, and find those companies where there's real value that are going to benefit from rate cuts.
Steve, your thoughts on small caps?
rate cuts normally favor small caps because of larger companies such as Alphabet per se, because I have the balance sheet open. Company with 100 billion in cash and 13 billion in long-term debt doesn't necessarily care about rate cuts from a carrying cost. But small caps, when you have lower rates, the carrying costs on their debts decline, and the lending environment becomes less restrictive, which allows them to expand. So, I think Tom Lee made the right call. And if you look at IWM, that's the market cap.
Yeah,
It's still up on the month. I mean, it's down over the past 5 days, 6.5%, but it's still up over 3% on the month. And when you start getting into rate cuts and it becomes an easier operating environment, I think that can rally. I mean, I don't think it was a bad call at all.
And by the way, what did Beat Kevin say for Tom Lee to block him? Because Beat Kevin might have antagonized him. Otherwise, it wouldn't have done that.
Oh, he definitely antagonized them. I mean, he definitely did that. I'm not sure what exactly he said, but Tom Lee's obviously pissed for a reason to block him. He doesn't block anyone. But my argument here is just, I agree with you, Kris. I think small caps were the right move. The question's like, do they go up 40% like he said? I mean, he made a very tactical argument. He said after FOMC, markets rally 5%, led by small caps.
I'm on the Tom Lee camp. I'm in the Tom Lee camp. The only thing that I'll say about this whole thing is that there are going to be small caps that have a lot more benefit from the rate cuts than some of the other ones. Like, here's the thing, biotech, if you're a biotech company, rates are not going to help you. Like, if you're a small biotech company that's, just trying to research things, rate cuts are not going to make that big of a difference. Maybe if you're trying to issue some debt, it'll help you out a little bit. But I think more importantly, you're going to see a lot of great companies that have a strong business model, but have been basically cut down primarily because of the high cost of capital. They're going to do well. And I think they are going to do so well that you will get a structurally higher move on the IWM. Will it be 40%? I don't know. I personally don't have that in my model. I think it's probably going to be about 20% higher from here. But I still think in directionality standpoint, Tom Lee is absolutely right. That is where you want to be. You want to start looking for value in small and mid caps.
I agree. And the regionals might help with that, even though they're down after they had a pretty good run.
Well, you got big bull thesis for regionals in about 2 months because the number one fear gets taken off the table.
Yep.
You don't have if the Fed actually does cut, which they should, it should mitigate the risk of REITs and private equity that have real estate on the books that were in potentially a shaky situation. That doesn't become a big threat, and you don't have the threat of them handing the keys back over to the lenders and the lenders not being equipped to operate a property and having to sell for pennies on the dollar and take huge losses. That gets alleviated. And I think the market's higher. Look, this time next year, I don't invest for today, tomorrow, or next month. I am not a trader. But when I look at the setup this time next year, I think we're higher than where we are today. And I think there's a lot of good opportunities in there if you have a long-term mentality.
Well, one last question for you, Kris, and then Kris, you can leave. I just want to ask Steve about Intel. Because 2022 happened and we went down basically 35% of the NASDAQ, and that was like a year ago. Do you think that happens again so quickly? Like Amazon goes back to 80 so quickly, right? That crazy drawdown we had. Has it ever happened that quick?
Absolutely not. I mean, absolutely not. Because Amazon, look at the amount of free cash flow Amazon is generating right now. Like, all of these companies are generating so much money that's not going to happen. One of the problems that we had with 2021 is that the general market, there was so much overvaluation. Like, I'm talking about overvaluation to the umpteenth level, especially because of all the freaking SPACs.
Yeah.
Remember, like, all these SPACs had come out at the time. And then also at the same time, just to keep up, all of these mega cap companies, they were hiring like there was no tomorrow. We started to see those videos, like day in the
Day in
life
the
of
life.
a Google, blah, blah, blah. You're not seeing that right now. You're not seeing these companies loading themselves up with a ton of like people and personnel just to keep up with the Joneses. I mean, they're a lot more efficient. They're generating a lot more cash. They're able to kind of redeploy that cash into buying back shares. So I don't think we're going to get a repeat of that again. I do think that a pullback is very healthy for the markets in the short term. It just brings a lot of opportunity for people who have missed out on the mega cap trade to get back in, because I think at some point these companies are not going anywhere. Amazon's not going anywhere. Google's not going anywhere. Microsoft's not going anywhere. This is a perfect time to kind of buy up a lot of these companies for the long term, where you're getting a decent valuation. Like Google right now is trading at a fair market value with a PE of about, I think, 24, with a forward PE of about maybe 19, which is good because structurally they've traded around 23, 24, which means on a forward basis, they're actually undervalued.
It's 21 and a half this year's earnings, 16 and a half 2026.
Well, there you go, which is kind of retarded if you think about it. That means that there's tons of upside for Google right now.
Yes, that is true. That is true. All right, Kris, I think we all appreciate you, man. Chris's Twitter, I'll put it in the chat. Steve, stay on for just a bit. I want to hear about Intel. But thank you, Kris, for being here with us.
I think I'll stay on. I want to hear.
You want to hear
Steve's Intel thesis.
Okay, so Steve, let me set it up for you. TJ and I bought 2,500 shares of Intel at $30 like a month ago, selling covered calls on it.
Mm-hmm.
TJ comes on the show this morning and he says, Amit, I made a decision. And I'm like, what the heck is this decision? He buys another 7,500 shares of Intel at like 24. Intel's at 21. I'm okay with having a bit of a loss on 2,500 shares and navigating that. He wants to make this position not only 10,000 shares, he wants to make it 20,000 shares. So here's my question. Coming from that perspective, we didn't make any more moves because I was like, dude, I have no fucking clue if Intel is like the one we want to go long on this like historic dip, worse since 1982. Would you, if you had the capital, buy 20,000 shares of Intel and go long?
I don't know if I'd be buying. Well, it depends. I mean, it doesn't just matter the capital; it matters what the portfolio looks like.
Well, forget the portfolio. Let's say the money's there. Let's just say he wants this to be a staple of the portfolio at $20. Let's say the average would go to like 23 if you buy another 10,000 shares. What is the bull case? Like, why did you buy Intel today? Why is this? And if you had the capital, would you buy 10,000 shares here? Because you bought the dip. If you had a 200 grand sitting around, would you dump it into Intel?
I don't hate the idea. I want more Intel today. I'm going to show you something. This is what I look at. Before I do anything and look at the numbers, I look at the market share for all CPUs, because Intel is not really in the GPU game. Okay. AMD has been gaining ground, but Intel is still over 60% of the CPU market. There's two main things that have this set up for Intel. The first thing is you have, in October 2025, Windows 10 computers will not be used on enterprise level anymore. Yeah. And on a lot of individuals who understand what the upgrade cycle means, they're going to stop using Windows 10 computers because there's no more security updates. There's no more. Microsoft setting it. It's the same way that they did with Windows 7. So I have a computer that I'm using. I bought a pretty high-end computer 7 years ago or so, and it has an i7 6700K chip in it. It cannot be upgraded. I will be forced to get another computer. Even though I have other computers that are Windows 11, my desktop is not. And that's what I write my articles on, and I will be getting another. You have a lot of people that are going to upgrade for that reason. You then have the next iteration of chips when they eventually come out. I think they're probably 2 to 3 years off, that you'll really start seeing some AI chips that can do things that the previous chips don't do. And I think for some people, you'll get an upgrade cycle on that. The Windows upgrade cycle, I think, is going to be big, and I think it's going to last a little bit of time. And when I look at Intel, I look at a company that's companies that are in the x86 space. And unless the x86 chip becomes null and void, and that's not what computers, laptops, and desktops are based on, then my investment thesis gets blown out of the water. But if x86 is still around, and if that architecture is still what servers are based on, Intel's still the dominant player, and their foundry business, they picked a fight, not just NVIDIA and AMD, but with Taiwan Semiconductor and Global Foundries. And eventually that's going to pay off because they're going to make sure the foundries, they're going to be making chips for themselves and their competitors, and they're going to grow that into a robust business. Do I see a world where Intel goes away in 5 years? No, I don't. And I could be wrong, but Intel at this valuation, I'll buy it all day long.
Why? Why this valuation? Why is it cheap here?
I mean, is that back to where they once were? And what's their market cap right now?
90 billion.
I
They lost
mean,
50 billion today in market.
NVIDIA should just buy them today, is what they should do. And NVIDIA should just buy them. But no, in all seriousness, this is a company that when you look at the financials, was generating tens of billions of dollars in profitability in 2018, 2019, 2020. They can get back there. This is a turnaround story. And if you think the turnaround can work, I think it's a very good value proposition because you could possibly get a 2 or 3x on this over the next couple of years.
What do you think about suspending the dividend?
Great move.
Why?
And that's somebody that loves dividends because Intel needs the cash right now to build out their operations and fight a fight down the road. They can always bring back the dividend down the road. That they don't have cash flow right now to pay a dividend to their shareholders. Their number one thing should be getting lean, pivoting the business, and focusing on what they're good at. And quite honestly, they don't really even need to advertise that much because they're Intel. And I know that sounds silly, but most people that are Intel users, I'll never buy an AMD PC.
So that's my question. Why doesn't AMD eat Intel's lunch over the next, like Apple made their own chip. They stopped using Intel, right? Why doesn't something like that continue?
Well, Hewlett Packard and Dell would be the only ones that you could even worry about that for, or Lenovo.
Right.
But they haven't so far, and I don't know if they're in a position to make their own chips.
The cutting of 25,000 employees, you also think that's a good move?
I mean, I hate hearing things like that because I really hate when people get laid off.
Yeah.
So it depends. If it's because that they overhired and there's too much middle management or whatever it is, that's one thing I need to it. I don't really like hearing about layoffs while they are necessary in a lot of businesses for different reasons. I'd rather look at how they plan on expanding revenue and expanding profitability. And I think that there's a roadmap to do it in this. And I think people are underestimating how big the foundry business can be in the future. So that's why I'm investing in Intel, because I think, 2026, 2027, 2028, this is a company that's a $200 billion market cap.
And the reason they're going after TSM, is that because they want growth or because geopolitically they've gotten a mandate from the United States to do something like that?
It's a number of reasons, but at the end of the day, it vertically integrates them. They're no longer dependent on another company for their own product. They now have...
They're still buying from TSM right now? Intel buys from TSM?
TSM, and I think, Kris, what is it? Texas Instruments? Are there fabs for chips?
Global Foundries, right?
Global Foundries is one of them, producing a lot of their chips.
I think they're making a mistake going into the foundry business. I mean, if you look at AMD, when Lisa Su came in, that's the first thing that she did. She separated the foundry business and the design business. The main problems that Intel is running into is that, number one, a lot of people are moving off of x86, and the people that are remaining on x86 are gravitating towards AMD, which has, basically for the last few years taken a ton of market share from Intel. How they reverse that, I don't know. But I personally am not overly confident in Intel's ability to turn it around as of right now. Maybe that changes in the future, but as far as I can tell, a lot of people are just, they're either switching to ARM, and right now Microsoft is also coming up with another line of laptops that are ARM-based laptops, So, yeah.
So overall, Steve, you are bullish that Pat Gelsinger can get the foundry business to become profitable, and you think this is a 2-3x over the next 4 or 5 years once they actually manufacture their own chips with foundry.
Yeah, I mean, I think this is a company that can definitely get back to where they were. I mean, that's why I'm investing in it. I just don't see a day where Intel is not relevant in the CPU space. A lot of people hated IBM for a lot of reasons for a long time. That went from 115 back up to 180, 185. You know, Intel's been a hated company for quite some time. But if you look at the chart, it's been interesting over the past 10 years. Can you bring it up a bit?
The past 5 years, we peaked at 63 in 2021.
And you dropped down to 25 and then rebounded back up to around 48 or so.
Around 50, yeah.
Listen, I'm going to say something, and I hope I'm an American. I just want everyone to remember this, okay? I'm an American. I love this country.
And you served in the military, so thank you.
And I served in the military, so I'm going to have to say this. One of the tragedies that people don't talk about, and this is something that Morris Chang put out there like a long time ago. If you want good advice on the foundry business, you go to Morris Chang. Okay, Morris Chang is the founder of TSMC. He said the cost and productivity of the American worker is not anywhere close to what you're going to get from a worker in Taiwan. And so if you want to compete against the Taiwanese worker, Americans, we don't have the work ethic. We don't have the amount of talent pool that we need to be in this industry. And I think Intel is setting themselves up for failure. Yes, it would be nice to have a foundry business in the United States, but there are just certain industries that have other people do way better than us. And they've outcompeted us, and which is why they've actually won the business overall. All right. So I think right now with Intel, even going to their foundry business, unless they adopt some kind of miraculous change and they find workers that, are willing to like sacrifice their life to making sure that the output quality of semiconductors is really high, like the Taiwanese do, Intel is setting themselves up for failure.
Yeah, but how much of it is going to be robotics over the next couple of years rather than human interaction with these chips?
Oh, like Optimus and...
I'm not saying just Optimus. I'm just saying like how much of the automated where the narrative, and I'm not disagreeing. I agree that there has been better output from overseas fabs, and that's why the business has been there. But at some point, you got to think that robotics is going to even the playing field in that business.
The demand from the foundry business, that's not going anywhere, right? Like whether it's Intel or TSM, that's lasting.
Going up. It's going to go up. More and more things have chips in it.
So what exactly do you produce from the foundry business? Like, it's not just chips, right? Or that's it?
Yeah, well, here's the foundry business. First of all, it's an ecosystem. Okay, so it's not as simple as, oh, you send them the designs and they make the chip for you and they send it back to you. Like, no, you have, like, if you go to Japan does the best when it comes to the what are they called? The giant ingots of silicon, right? And then they end up slicing them up. So you need to have certain level of yield that comes from that. So the Japanese have really mastered the art of producing that. The Taiwanese, they've done an amazing job of getting the most amount of yield on a wafer possible. And then also, if you look at the lithography, that was the other thing that Intel missed out on with this EUV. All these EUVs and all the technical expertise that comes along with that, a lot of that stuff, a lot of engineers in Taiwan, they know all this stuff. They work their ass off to get all the details that they need to get to the point where their yields are super high. It's not to say that just because you buy a machine from ASML that you're going to get a good yield. No, you need to know a lot of things, and it's more art than science. And the thing is, a lot of it comes down to just a lot of experience. So I think the Taiwanese, they have a huge leg up when it comes to the foundry business. So
we are in extreme fear, folks. We haven't been here since, guess what? October 2023. So it's been a while. But now
is this real that JP Morgan is forecasting a 1% rate cut by November?
They're expecting 50 in September, 50 in November. Dude, The analysts, dude, I looked at the Amazon downgrades today. Like last week, 250. This week, 230. It's like, it's just insane, bro. These fuckers, they throw out anything. And because they work at Bank of America, like it's taken seriously. It's as serious as you or me talking about it, dude. Like it's just like, it is quite hilarious how they put this stuff out.
Insanity.
Yet, once again, I'm going to remind Steve. Steve looked at NVIDIA's forward earnings and said, oh, look, it's cheap based on forward earnings. Yeah, by some no-name asshole who came up with a freaking target. I think all these people, like, especially, okay, I have to say this, and I know Dan Ives has been on your channel, and I won't go after him like too hard, okay?
We know you don't like him. We already know.
I don't not like him, okay? I mean, my biggest problem with Dan Ives is that he comes to a conclusion and then works his way backwards. That's what I don't like about the guy. Where it's like,
explain. What do you mean by that? What do you mean by that?
So right now, if I set a price target of 150 and then like, okay, yeah, I think we can get to 150, and now you're working your way backwards, looking for every justification possible to get to that 150 target. That's what Dan Ives tends to do, in my opinion, where he's very hyperbolic. Like even the clothes that he wears is very like showy.
Are you making fun of his clothes right now?
Yes,
Are you
always, dude. He wore a stupid. Like I'm telling you, he's like the weirdest guy, man.
I love him, dude. I love him. I like. He's been right for a while, right?
I don't like his drip. That's true. I really don't like his drip. For someone who's whatever. I'll stay.
Steve, how do you feel about Dan Ives' 9 p.m. party thesis?
I think it's 7 p.m., not 9 p.m. We haven't even driven there.
I hate Steve too, by the way. So yeah, we don't know. Both Dan Ives and Steve are on my list. You know.
The difference is that I actually like a lot of other things besides big tech.
That's true. Steve owns everything. Like every time I'm like, "Yo, do you own this?" He's like, "Yeah." I'm like, how the fuck do you own every name in the market? Like this is
some of my best plays have actually come from Steve. A lot of people are in there like, oh, Kris is talking about Hershey's. You know who called me about Hershey's? Steve. He called me up. He was like, hey, Kris, I have an idea for you. I'm like, okay, what's up, Steve? Shoot.
He always starts with that, Joe. Whenever he picks up the voice, like, so I have an idea for you. I'm like, what? What is it?
I mean, sometimes he comes up with the craziest things. I just like, nah, Steve, you're good, man. If you want to buy it, you go right ahead. But I think, but he called Verizon absolutely correctly. He called SL Green absolutely correctly, and he even called Hershey's absolutely correctly. So it's not just, oh, Kris is the guy. I tend to be very like the cheerleader for a lot of these plays, but believe it or not, underlying all of that stuff is a lot of the due diligence that Steve does. And then I just tend to layer on my own opinion on top of it and say, you know what? And that's what building a great community is all about, right, Amit? Where you get to discuss and you get to talk about certain ideas that you normally would never get to do. And the other good thing is that someone else can take a look at a stock and look at it from a different angle that you may not be looking at. And that gives you a lot more, what's the word? Like confidence. And yeah, and you can be a little bit objective. I think, who was it? Was it Peter Lynch who said it, that the best way to invest is to do it based on a consensus, where if you get 10 people in a room together, and if you can convince all 10 people to agree on a stock, it's probably going to be like a good one. And if you can't get all 10 to be in agreement with you, it's probably going to be a shitty situation to be in, you know? Yeah. So I think right now, the best thing you could do is look for the best investors, build a circle around them, and then have discuss ideas and say, look, I think this is a good idea. I think this is a bad idea. Right now, I'm in contention with Steve regarding Intel, right? So I think Intel isn't going to do that well. Steve's saying Intel is going to do well. So it's like a 50-50 who's going to be right, who's going to be wrong. But you should start to buy shit when me and Steve both agree on something, you know? So
yeah, and I would go back to, I don't get everything right. Like, I don't want anybody to think I have a crystal ball. I'm a nerd and I do a lot of due diligence. And something like Intel, it could absolutely go down to like 14 or 15. Like that could absolutely happen. And I've said this so many times, and Amit makes fun of me every time I say it. So I'm going to give you a segue, not call tops and bottoms. And Amit always makes fun of me when I say that. But I can't call when a stock is going to bottom, and I can't call when it's going to peak. But when I look at certain things, Intel is something that I think is worth the risk for me here. Probably not worth it for anybody else except for TJ, but it's worth it for me here. And I have the time where I can stay in it for a couple of years. And if I take a loss on it, it's not going to really, because I'm not going crazy with it. But there are some plays out there that I really still like. And I think energy is in a sweet spot. I think utilities is in a sweet spot. And I think there's some really interesting closed-end funds that have some really good fund managers that utilize a little bit of leverage to write call options on utilities that are going to do well. I mean,
do you agree with Kris on Carnival on the cruises?
I hate cruise lines. I don't have an opinion on it.
Why do you not like going on cruises? Is that why?
You will never get me on a cruise.
So that's what you. So it's not about research. It's about like subjective.
It's just not something that interests me. I don't want to look at it. It could be a phenomenal investment.
Look, man, you got the third world. You're paying them below minimum wage. You're charging these Americans high prices to get on a ship, and you're charging. Dude, it is the perfect business model. Do you know how much they pay in taxes? Barely anything. Barely anything. I'm telling you, cruises are
not something I'm interested in. I'd rather be in a boring real estate company like Realty Income.
Nah,
okay,
man,
so
come join me on the boats.
Let's end on this last question. Alexander says, wait, what do you all agree on so I can go all in on this stock? Well, something that all three of us.
No, don't go all in on anything.
Don't go, not financial advice, whatever. But all three of us agree on one stock. Do you guys know what it is?
I think we
Palantir.
So we agree on more than one stock.
Nope.
Kris, it's below 24, 25.
I don't care. No. And by the way, Dan Ives, that son of a, he's the one. Like, I could not, dude, I couldn't stomach being in my Palantir put.
You would have been right, dude. You would have been so right.
Dude, there's this guy, Long Duck Long or whatever, right? This dude had, I'm at 500.
I know he had 200 grand of puts. I want to see his portfolio. He must be up like.
He sold all of them with a $5,000 gain before me, but he sold it. Yeah, because the thing is, dude, when you're in a short,
he was scared, right? He was scared,
bro. It's hard. It's hard being in a short position, especially with all these fucking analysts coming out and giving like $30 price targets and shit. And I'm like, what the fuck am I doing here, man?
You know, like, dude, if you held it, you would have got to talk so much shit. It would have been fun.
I wake up in the morning. There's so many nights I couldn't sleep because these guys, man, I'd wake up in the morning. It's like Palantir been upgraded. I'm like, based on what? Based on what? And then you got fucking Eliano over here taking people to steak dinners and shit. And I'm like, bro, I am so fucked if some whale gets a great meal out of this whole experience and buys like 1 million shares, and then I'm fucked. So I'm like, you know what? Screw this. I don't want to deal with the fucking nonsense with that. So 2 people ruined my Palantir short. One was Dan Ives and his stupid upgrades that made all these people buy in. And 2, Eliano, who basically has been just going around feeding people and like cheering up all this fucking demand. And what's his name?
Chad.
The other guy.
Chad
has been doing great presentations and shit in AIP. So I'm like, bro, do I really want to compete against these guys? I can't compete against them.
Well, dude, on valuation, you were still technically correct. And like, you know,
whatever, dude. Whatever. I'm okay. I've gotten over it.
Okay, so now buy in. Now it's below 25. Now it's time to buy in.
No, I'm good, man. I'm good. I told you yesterday. I don't have the conviction. I have more conviction in the cruise lines, which are sinking right now, rather than Palantir, which is actually holding up. So
I've been known to catch a fight for 2. I'm getting really interested in CrowdStrike. This goes below 200. I'm going to get very interested.
Kris,
I'm going to stay away until the PR changes, man. There's just too much PR headline risk.
Oh, and that's why I'm getting very interested, because look, over the next 3 months, if we get 180, that area, that may be an interesting time to take a long position and wait for the PR to turn around.
Would you rather have Intel or CrowdStrike, Steve, at these prices?
To me, Intel is more of a, not as hard for me to get my brain around, because I don't think that we know how impactful this is going to be for CrowdStrike, and it could still get pretty bad. Yeah. Like, that would be a real big gamble if I take a position in it, but it's warming up to me. And I told you when you told me it at like 260, I was like, I think it's still going to go down. And now it's starting to get in. But I hated the valuation. I told you that. But look, if they don't really lose customers, and if they come out of this, not unscathed, but if they come out of this okay in the next 6 months or so, next year, maybe it goes back to 350. Maybe it goes back to 325. I mean, right now at 217, if it keeps going lower, it's interesting.
It's interesting below 200. I agree. It's very interesting.
It's interesting. I mean, I think the whole industry is interesting at this point.
Yeah.
But my fear is that a Microsoft or an Alphabet, they're just going to, or even an Apple, not saying that Apple would, but some of these large scale companies with the operating systems just decide to do it on their own.
Right. All right. I think that's it. Thank you, everybody, for being here.
Streaming for?
It's been 4 hours, 23 minutes.
Oh, Kris, have you seen Kinder Morgan?
See,
I have
Steve finds a
not.
way. Steve owns Kinder Morgan too, probably.
Of course I do.
Yeah, Kinder Morgan's a great company, dude. It's an MLP. It's recession proof, man. Everyone's gonna use natural gas. I don't think there's any upstream operations, right, Steve?
No upstream. So Kris and I were having a conversation a couple months ago about the biggest natural gas pipeline companies because of data centers. Kinder Morgan is, I think, the number 2 behind Energy Transfer, and I mean, they're up 17.5% this year. They just raised the dividend again. You got 5.5% yield. I think pipelines are very undervalued.
Yeah, look at this, Amit. Here.
Oh, wow. It's up 20%.
Yeah. And the thing is, like, they have almost like a 6% dividend. PE is about 8. So they've got a ton of room for growth ahead. And what's going to happen is a lot of people right now, they're happy getting their 5.25% from their money market funds. What do you think happens when the money market funds are yielding barely anything again?
They go into pipes and they go into real estate.
That's right. And especially old retirees who need fixed income coming in on a semi-regular basis, they're going to be buying companies like Verizon. They're going to be buying companies like Kinder Morgan, ET is another one. So a ton of these companies, like even CCI, which is another one, like Crown Castle,
cell phone towers.
Yeah. This is not going away. And not to mention, like, companies like this have escalators built into their revenue. So basically what happens is right now, it's not only that you're renting a cell phone tower, but what happens is over time, your rent goes up. So even though right now you may only be getting like a 6% yield, the next year they can raise that a little bit higher. The year after that, raise a little higher. And eventually, if you look at it on a let me just show you guys what I mean real quick. Sorry, Amit. I know.
No, you're good. I'm fine. It's up to you.
So if you look at historically, something like CCI, right? Look at this. All right. So you see this all the way from 2000. You could have bought this at $1, and right now this thing is trading at like 114. And the entire time you would have been getting dividends, which grow every single year. So if you look at CCI dividend, they usually grow their dividends every year about 6%. So look at this. These are all the dividends that they've been paying every single quarter going back. So imagine right now in the year 2000, you bought 1,000 shares of CCI, right? And then they started paying dividends in 2014. And then right now in 2018, it was like about $1. That means that you're getting 100% return on that initial capital that you might have put in. So a lot of dividend companies, a lot of people, what they do is they look at the current yield and they all say, oh, look, I want to buy this company because of this yield. What they don't factor in is the yield growth that tends to happen with these companies. So you can see here CCI for the last however many years has been growing their dividend every single year, and to the point right now where their dividend is almost like $1.56 per share.
And the big with these companies is their infrastructure is not replaceable.
Yep.
And I'm fine making a definitive statement like that. You can't replace CCI's infrastructure. You can't replace Kinder Morgan's infrastructure. It's basically impossible unless it's American Tower Corporation or an Energy Transfer. and they just basically get all the permits and build it. But even then, it's next to impossible. That's what's great about these types of companies, hard assets that Kris spoke about before. It's pipeline companies, regulation, capital intensive, zoning, land, expertise. It's a nightmare. That's why there is no new pipeline companies. It's the same ones: Enbridge, Enterprise Products Partners, Kinder Morgan, Energy Transfer, One Oak, and Marathon. I mean, those are really the only big pipelines.
They have solid moats, dude. Like really solid
Huge.
moats that just can't be
Huge.
penetrated. So.
And they don't have to worry about the PR with all the fracking or upstream stuff that Exxon and Chevron have to deal with. They're just transporting the stuff after it's drilled.
Yep, and they're also they don't have to worry about price fluctuation on the underlying commodity either.
Take or pay contracts, beautiful thing.
Yep.
All right, so let's end it off on one final question, real quick. Overreaction, healthy correction, or recession? Out of those three, where do you guys land?
Overreaction.
It's definitely an overreaction, but we could be heading into a recession.
Yeah.
Steve has to be the most political of political people.
How is that a political statement?
Take a stance. Do you think we head into a bad recession, or you think this is overreaction, we bounce back?
I don't think that we can tell if we're going to head into a bad
recession. I mean, you don't take a stance. This is why you own 50 stocks. You're like,
well, because I don't know. Well, there's nothing wrong with liking I own more than 50 individual companies.
I agree. I think it's an overreaction as well. I think we bounce back. It could be a recession, but I don't think this year we see that. Maybe, but I think it's unlikely, given the labor data that we got today. And that labor force participation, Kris, I've never seen that before. That's a hell of a point. Like, we're not firing people. We're just not hiring them as quickly, which is a big difference. And so if the Fed cuts, that should help.
And more people are getting back into the labor market. I mean, one of the reasons why we had such a anemic return back to the office is because we had so much COVID stimulus. And the stimulus took a long time to work its way out the system. And then even towards the end, you still had a lot of people. Like, there are still programs out there that are supporting certain COVID era restrictions, So when you take those things away, what ends up happening? People have to get back to work. And when they have to get back to work, they have to compete against other workers. And that's what's going to cause wages to kind of normalize. So I think AI itself is very deflationary. So we could get back in. Believe it or not, there is a scenario, and maybe Steve, maybe you might be able to dissect this. We could be eventually heading back to a zero rate environment again.
I mean, we may have to at some point.
Yeah.
And maybe not 0 rate, but maybe 0.5%. I mean, we really may have to at some point. I think, look, you guys know I don't like getting political things. I like to keep it about investing in the numbers. But whether you like him or not, whether you would have voted for him or not, Andrew Yang was one of the only people, if not the only person, that has been looking 20, 30, 40 years down the road and really bringing to light a lot of hardships that are going to come with the advancements in technology. And I think that we have to really start looking at some of those things, because there's a lot of problems that technology is going to bring. One of the ways to combat that is going to be having a really inclusive borrowing market to help generate business. I get worried about what a couple of decades is going to do when we look at AI and robotics.
For me, I look at Japan. Japan is like a blueprint for what the U.S. could end up going through with the demographic collapse happening post baby boomers basically retiring and leaving the workforce. So if we have that low population, and the guy in the chat says it right, PK, low population plus AI equals deflationary, debt plus potential dollar printing, inflationary. So it's kind of the battle of the two. I think we're probably in the first one, where there's just going to be a lot of baby boomers retiring, and the national debt is so high that they really need to figure out the national debt situation. And one of the ways that they can solve the national debt issue is lowering interest rates. Huh?
Buying Bitcoin.
Well,
to me, Bitcoin doesn't solve it.
I know.
To me, it's lower rates, and then utilize that time to basically pay down some of that debt, so that this way it's not as big of a vulnerability. Because right now, the interest payments alone should have been a reason why the Fed started their rate cutting earlier rather than later. This way
Yeah.
they can just boost confidence.
Percent. And look, I've always said this about them. There should be a third mandate. In addition to price stability, in addition to maximum employment, making sure that we are not paying a ridiculous amount of our tax dollars toward the interest on our debt. And we have now exceeded $900 billion a year of our tax revenue going to service interest on our debt. And we are almost spending as much as we do defense budget.
Quick
It is
question:
crazy.
if you buy a money market fund and you're getting 5.5%, that's basically the government giving you that 5.5%, right?
Well, money market funds invest in debt instruments, so yes.
So
Yeah.
so so technically our taxes are being used to pay
Taxes
back
are
the
taxes
debt.
aren't being used, but you can look. I guess you could theoretically look at it like that.
Technically that 900 billion, some of it's coming back to people. Like it's going back to Google that has their money in treasury funds, right? The government's paying Google for that, for the money.
Well, the government's paying Google if they're buying T-bills.
Yeah, which most of these balance sheets are loaded up with T-bills, short and medium term T-bills. So yeah, that is absolutely the right way of thinking about it, Amit, where you have a lot of companies that are hoarding cash. They're actually getting money from the US government, but then they're also paying some of it back in taxes. So it's a weird dynamic that's happening. The bigger thing is you're seeing this weird situation where the people who have money are doing extremely well and they're doing it safely. Like right now, if you're a retiree, you're sitting on let's say $2 million, you're getting 5.5% from the Fed. You're good. Like you're not taking any risk whatsoever. And you're able to kind of like get a great return by just keeping your money in a cash-like position. That's 5 years ago, 6 years ago, that was unheard of. So then at that time, you actually had to be in, certain companies to get that kind of return. Like right now, there's a lot of institutional money that's sitting in treasuries and sitting in money market because they're getting such a good return that they're going to have to eventually deploy that capital back into the market again. So.
And for zero risk, like 5% on 2 million to do nothing is a pretty good deal, right?
Yeah. Well, the funny thing is everyone's got to listen to Scott Galloway. I don't know if you guys have been listening to him.
Yeah.
One of the things that the US we have right now is that every one of our systems is built to take care of all the not rich, but take care of all the older people. So right now, the tangible benefits are going towards retirees and people who are about to retire, and all the people who are younger in this newer demographic. They're getting squeezed on all sides. Like all the people like baby boomers and even certain millennials, they own their own homes. They have low interest rates. It's this new generation of people, the Gen Zs. They're coming into the labor market right now and they're being squeezed on all sides. So it kind of sucks, but it is what it is.
Real quick, Kris, last question. A TMF, what exactly is that and what trade have you made on that?
It's a triple leveraged fund that invests primarily in the long bonds, so long treasuries. So what ends up happening is whatever the movement is in the 20-year plus treasury market, it does a 3x move against that. So
why is it up today?
Because everyone's buying treasuries.
So when bond yields go down, this thing goes up.
Yeah. So when you have a higher probability of a recession, people are going to be flocking to safety, right? And when people flock to safety, they're looking for things like treasuries. So why would they want to be in risk assets? Instead, they shift their money to things like treasuries where there's a fixed return, but every time you buy it, you're essentially kind of like competing away the yield. And so the yield goes down. So right now, if you look at the 10-year treasury, why do you think the 10-year treasury right now is lower?
Yeah. No, okay, that makes sense. Real quick, Eld, sorry, I forgot your super chat. $5. Bottom video 125 is now a good opportunity to buy or look elsewhere. Kris would say no. Steve would say yes. We talked about that earlier, but at 100, Steve likes it a lot. If the basic analysis, if you assume $5 EPS by 2025, which is it's asking for a lot, but the street thinks it's possible, then it's cheap. It's trading 21 times. If you assume $3 EPS or $2.50 EPS, then it gets a little expensive at $100. But if you're more aggressive with your growth estimates, then 107 is relatively cheap. All right. This was fun. This was awesome. I think a lot of people appreciated Kris and Steve hopping on. Their Twitters are in the description of the chat. I obviously really appreciate getting to talk to these guys and just get their insight and value, especially on a day like this where these guys have a lot more experience than me in the markets and they're able to bring a lot more value. So hopefully you guys enjoyed. Kris does have a Patreon. It's in the chat as well. I think it's like $10
One thing someone I really quickly they ask, and I want to make sure I highlight this. Triple leverage companies are never, ever meant to be held long term. They're always only directional moves that you're playing in the market for a very short term move. So if you think that the market is crashing, being in TMF is good because you're going to be able to capture that move downward. Yeah. These companies directionally, they tend to really underperform the market. So I would not be in any leveraged plays long term as a hold. Like, no, you typically don't want to do that. So.
All right. Thank you, everybody. This is it for today. No market close. We will have Palantir Weekly at 10 p.m. hour early, and we'll preview Palantir going into Monday earnings. All right. Thank you, everyone. Have a good day. See you tonight. Bye, everyone.